is 9 a.m. on Wednesday, March 24th. This is Yahoo Finance Live. I'm Julie Hyman with Brian Sozzi. You will notice Miles Udland is missing today. He is off for the next few days. Let's take a look at stock futures here this morning. We are seeing some strength in the futures. Dow, S&P, and NASDAQ all indicating a higher open, building on some of the recent strength that we have seen for the major averages, but for the NASDAQ in particular. Forging a new path, Intel CEO Pat Gelsinger unveils a turnaround plan for the giant chipmaker with some help from other tech titans. Day two for Yellen and Powell. The pair will testify before Congress as bond yields drop amidst Powell's reassurances on inflation. This morning, we've seen bond yields bouncing a little bit between up and down. And GameStop, indeed, shares of the video game retailer tumbling as fundamentals matter, at least for the moment. Earnings per share missed estimates for GameStop, and those shares right now are down by 12%. Let's start with that Intel story, though, because it is a fascinating one. Brian Sozzi, you've been covering this closely, and you knew that Intel was making an announcement. We didn't know what exactly they would be saying. Intel has had a lot of push and pull, right, in terms of external and internal forces that have been pushing it in different directions in terms of its strategy. CEO Pat Gelsinger, who had been at the company, returned to the company and actually doubled down on some of what some critics of Intel had been pushing it away from. That is the foundry business, making chips for other companies, at the same time that Intel has also got to fix its own chip-making business for itself. So it's got a lot to get right here in terms of execution.
All right, Julie, it was fascinating to watch this event that started at 5 p.m. yesterday. And if you're an Investor Day geek like me, this was more exciting, I would say, than the reveal of a new iPhone. You had Pat Gelsinger just in the month, the top CEO job here at Intel, in that role for about 1 month. He came on there last night and he was on fire, sounding like an executive that has been at the company really for the past 40 years. Obviously, he left in 2009 to be the CEO of VMware, just returning a couple months ago as CEO of Intel. But the big headline here, Intel investing $20 billion to build 2 fab or chip-making plants in Arizona. And Gelsinger pulled no punches on this call, Julie, last night, saying Intel remains committed to making its own chips. I would say pushing back to a lot of Wall Street critics and also Third Point's Dan Loeb, who was agitating for the company to explore alternatives, which included potentially getting out of making its own chips, outsourcing that business, saving money, and likely plowing back into dividends and boosting the stock price. Gelsinger said, no, that is not going to happen. But Julie, as I was watching this, I was surprised that there were 2 cameos here. Not a lot of people expected it, but Microsoft CEO Satya Nadella hopped on the call last night, as well as IBM's new CEO, Arvind Krishna, both voicing support for Gelsinger's initiatives. Here's what they said.
As chips become more specialized and cloud architectures become more optimized for new workloads, we will need to collaborate to co-design the next generation of systems, from the hardware to the systems to the software.
The technology is driving the next technological revolution. Hybrid cloud, AI, 5G, the intelligent edge, quantum are all together going to help unleash the potential of data and advanced computation that will create immense economic value.
And Julie, I'm looking forward to catching up with Gelsinger later this afternoon. We'll have more from that interview later on here on Yahoo Finance. But not lost in the optics, at least to me, Microsoft CEO, IBM CEO, obviously no Apple CEO Tim Cook. That relationship was essentially ended late in 2020 as Apple is now making its own chips called the M1. Now, Gelsinger did mention on the call, though, he is open to pursuing opportunities with Apple, whatever that means. But I'm really looking forward to catching up with Gelsinger later.
Yeah, one would think he's open to opportunities because presumably it wasn't Intel's decision necessarily to end that relationship. So we'll see what happens. But meantime, the ripple effect that we've seen across the industry has been really interesting, because what Intel is doing with this move, it's going to more squarely compete with the likes of Taiwan Semiconductor and Samsung. We've seen pressure on those stocks. And, if they're building out new facilities, they're going to need equipment. And so we've seen a lot of the equipment makers get a boost from this announcement as well. To your point, sort of illustrating the size and importance of what Intel and ambition of what Intel is planning here, the effect on the rest of the industry.
Right, and worth noting here, it's not all sunshine and roses with Intel, with his day yesterday, mini investor day, I would say. They came out, they said they would beat first quarter guidance because of continued strong notebook demand. So likely you're probably also going to see good quarters out of HP, out of Dell. Those trends continue as we all continue to work from home. But they lowered their full year guidance about 20 cents below where the consensus was as they invest these billions of dollars to build out these manufacturing plants. And there's still a heavy skepticism on Wall Street, at least out this morning in terms of the notes that I was able to read on whether Gelsinger can pull off this turnaround. He's going to spend a lot of money trying to do it. I think Wall Street is open to giving Intel another shot. They've tried this type of turnaround before. It really just boils down to execution.
Yeah, well, so TBD then on that front. Just to broaden it out to bigger tech for just a moment, Brian, because this is obviously something you and I and Miles have been talking about a lot, is about the rotation out of tech and into the so-called reflation or reopening trade, whatever you want to call it. We're sort of at this point now where we're trying to figure out if we're at an inflection point where that's going to reverse, or if we're just going to continue to see some back and forth there. I mean, yesterday we saw some declines for the NASDAQ, but in recent days, it seems to have gained a little bit more traction. And of course, at the same time, yields have stalled out in their upward march. So that certainly doesn't hurt matters. But, you know, I know you read a lot of notes out there. Is there any kind of glimmer of things changing?
No, it has been interesting. The move in tech that you mentioned, Julie, has really been, I think, focused on this pullback in yields. With yields have crept down as you see Fed officials like a Jerome Powell talk down the effect or the impact. We're going to see rampant inflation because of new stimulus plans as they have done. So I think that's where you're seeing tech reawaken. But at the end of the day, I think for a more strong or just a stronger trend here in tech stock, you're going to need to see first quarter earnings because that is when the comparisons for a lot of these big cap tech companies are at their strongest for the year. And it's when you could see the strongest growth decelerations for a lot of big cap tech names. If they could come out here, beat handily on sales, beat handily on earnings, it would go a long way to, I think, reawakening the big cap tech trade.
Yeah, and in a little while here, we're going to talk to Sean Darby of Jefferies, who predicts not only a consumer spending increase, but also a corporate spending increase. Intel, obviously, an example of that. I'm curious, we'll get his take on what that means maybe for other tech companies as well. But speaking of spending, you got a new place to spend your Bitcoin, Brian Sazi. Officially now, Tesla is accepting Bitcoin in exchange for its vehicles. Elon Musk tweeting that very early this morning, Eastern time, 3 a.m. I think that's Eastern there, that timestamp on that tweet. Remember, of course, Musk had said that Tesla would be doing this, and it's actually happened fairly quickly after that announcement they were going to be doing it. One of the most interesting things, Brian, as we've watched different companies take on some Bitcoin on their balance sheets, Musk is saying they're not going to convert that Bitcoin they're taking as payment into dollars. They're going to keep it as Bitcoin on the balance sheet. So I think we're seeing a gain in Tesla this morning and also gains in Bitcoin.
Well, that's two things I don't own, Julie, a Tesla and Bitcoin. But clearly this is made for a very targeted market. But you bring up a good point. Does it Tesla have to convert this into actual currency so it helps power its business? Are they effectively giving cars away for free? It's weird. It's a weird development because the whole thinking I thought would be if they're going to accept Bitcoin, they change it into dollars, it goes on their balance sheet, potentially they make a lot of money. But that's not necessarily what Musk is saying here, Julie. Well,
if they keep it on their balance sheet as Bitcoin and Bitcoin appreciates, which Musk clearly thinks it's going to over the long term, and maybe eventually other entities start accepting Bitcoin more readily, I don't know. There's a lot of dots that have to be connected from here to there. But at that point, Tesla will have two choices. If indeed Bitcoin goes up, right, which is still an if it goes up, they can convert it back into dollars at that point. But given what Musk has said and done so far, you would think that they wouldn't do that. At some point, will Tesla battery suppliers accept Bitcoin as payment? Will they be able to build factories paying in Bitcoin? That future doesn't feel too close to now, does it, Brian?
Julia, you're really painting an interesting picture for the next 45 years, 50 years of Tesla. That is, I'm still not there mentally or emotionally on the fact that Elon Musk is going to pay his contractors to build these giant facilities in Bitcoin. Maybe he knows something that we don't know, which may very well be the case. He's proven a lot of skeptics wrong through the years, but at some point you would think they're going to have to sell some of this Bitcoin, which now Tesla would turn into the whale seller for pressure on Bitcoin prices. But they have to sell that Bitcoin just to keep their just to keep their business operating. But maybe that's just me. Maybe that's just me being a fundamental analysis guy.
Oh, there you go again, Brian. Can't believe
Sorry to keep
it.
bringing it
Meanwhile,
up. I just have to.
I do want to
keep beating the drum.
one other thing to mention. There's an interesting piece in Bloomberg Business Week just talking about Volkswagen trying to really take some of that market share in the electric vehicle market from Tesla. And as we know, there are a lot of competitors coming down the line for Tesla. So we'll see how that dynamic shakes out in the coming 45 to 50 years as well. All right, we're going to take a quick break, but before we go there, just want to get a check on shares of GameStop. We mentioned them in the open. Their shares are falling by more than 10% this morning, and that's after GameStop shares missed analyst estimates in terms of their earnings per share. They're also changing up their executive suite a bit, but that didn't seem to overwhelm the news on the miss, as well as the news that the company might be selling some shares. So we're going to dig more into that a little bit later with Joe Feldman of Telsey. But for now, we'll take a break. When we come back, more on Yellen and Powell.
Economic watchers are out in full force this week as Fed Chief Jerome Powell has a second day of testimony in front of lawmakers today, along with Treasury Secretary Janet Yellen. That's in addition to speeches today from Fed Governors Barkin, Daly, Williams, and Evans. Let's bring in Oxford Economics Chief U.S. Economist Greg Dacko for some analysis here. Greg, good to see you as always. We've heard from Jay Powell yesterday, his continued talking down of a prolonged increase in inflation. Do you think that's the case? Do you think any inflation that we see over the next 3 to 6 months is in fact transitory?
Well, I think what is right is that we will see inflation firm over the coming months. It's undeniable that we're going to get three factors pushing up inflation. We're going to get base effects because the comparison to last year is going to be quite favorable. We're going to get a push from energy prices, and we're going to get a push from stronger economic activity on under that fiscal impetus from the American Rescue Plan. So we will see inflation likely reach levels that we haven't seen in the recent past. We're likely to see headline CPI inflation around 3.5% over the spring, core PCE inflation close to 2.5%, and that inflation will be to some extent sticky through the rest of 2021. But I don't expect spiraling inflation. So in that light, I'm in line with Powell's view and the Fed's general view that we won't see persistently higher inflation and inflation spiraling out of control.
Where are you, Greg, where are you most concerned that inflation may increase at a faster pace than some of those increases you just mentioned?
Well, it all depends on the rotation of the U.S. economy. We have seen a very strong demand for goods, and reflective of that, we saw very strong price increases in the sectors that were in high demand. As we see a rotation towards more service sector spending, we're going to see some increased price pressures on those fronts. But overall, that price pressure should be fairly gradual and not something that spirals out of control because there are natural checks in a way in terms of inflation dynamics. And in particular, I would note the fact that demand tends to be endogenous. So, in a sense, if prices rise too much, that will put a curb on demand and in itself limit the upside to inflation. And one key factor that we have to keep in mind when we look at the inflation trends is inflation expectations. Those seem relatively well anchored despite the rise in goods prices, and we should see those continue to remain anchored going forward, and that will be the key anchor that prevents spiraling inflation.
Greg, some of the places that we have seen inflation thus far have been in places that the Fed doesn't count, right? Things like energy and food. Um, Forget about the rates perspective for a moment, but from an economic perspective, what tends to happen when we see increases in food and energy prices? Is there then a pullback on spending on those items? Is there a pullback in spending on other areas? What tends to happen?
Well, I think the reason why the Fed tends to be a little bit cautious with its perception of how food and energy prices evolve is because those tend to be quite volatile. So we know, for instance, that energy prices tend to have big swings on the upside and big swings on the downside. In order to avoid changing policy to these types of swings, the Fed prefers to look at a core measure of inflation. That being said, higher energy prices, higher food prices do have an effect on the average household, and in particular on the lower income households. And the Fed is very much concerned about the impact of the dynamics, more to say, in terms of the spending patterns for these lower income families. So it is still watchful of the trends in terms of food prices, in terms of energy prices, because in some cases, those are essentials that you cannot go without. And therefore, they do tend to affect how you spend on other categories of goods, not necessarily food and energy, but other types of discretionary spending. And that would be also something to monitor closely going forward.
Yeah, definitely. Greg, you've also been monitoring the trend of coronavirus globally very closely as it relates to, of course, to the economy. Particularly in Europe, where we're seeing new shutdowns, it seems to be having a negative effect. What about here in the US? I mean, we're still seeing high case counts, but it doesn't seem to be, especially as more people get vaccinated, it doesn't seem to be having a negative effect.
Well, we're in this race between the vaccines and this spread of the new variants across the US. We've seen a number of places see a plateauing of the number of new cases, and that is something to be watchful of. But it's very encouraging that at the same time, we're seeing a steady rise in the number of daily vaccinations. We're currently trending around 2.5 million doses per day, and we're seeing the rates of vaccination really rise rapidly. We anticipate that by the end of April, we'll have vaccinated, or at least, sorry, given a first dose to half of the population over 15 years old in the US, which is a steady improvement over the past few months and more than we had expected initially. So, this improvement in the health situation will no doubt be supportive of economic activity, but there will be bumps along the road. I don't think we should expect a smooth recovery. It will be a bumpy one. We will see months where data is weaker. We will see months like in March where data is very strong with the help of fiscal stimulus and with improving health conditions.
Greg, hard right turn here. I was watching your Twitter feed, and I believe you tweeted something on digital currency. And Fed Chief Jerome Powell, he played that down. He doesn't seem inclined to push forward with a digital dollar. Do you think a digital dollar, it's just inevitable, and it's something that's going to happen in the next decade because it is more efficient?
I think it will happen. The question is when and how. I was hearing the conversation you were having earlier around Bitcoin. The key issues with cryptocurrencies is that their use as storage of wealth is not the best because the value of that Bitcoin tends to change quite a bit. And furthermore, in terms of transactions, you don't know who's going to accept that currency. Whereas if you have a central bank digital currency, that would tend to be accepted by all. And would be something that would perhaps be actually increase the efficiency of fiscal stimulus, for instance, something that Julia Coronado has highlighted in the past in terms of helping stimulate the economy more rapidly via this central bank digital currency. So I think it will be something of the future, but the Fed and Fed Chair Powell are very careful about the development, and they know that the dollar has this reserve currency status, so they want to preserve that and make sure that any development of such a digital currency would be backed by significant research and well prepared instead of launching it too early and risking any negative influence on the value of the dollar.
All right, so maybe within the next 25 years. All right, we'll leave it there. Greg Dacko, Oxford Economics Chief U.S. Economist. Always good to see you.
Thank you.
All right, as long as everyone is in a spending mood, it pays to buy stocks. That's the message from our next guest. Stick around.
This is Yahoo Finance Live. We're looking at a higher open here this morning as indicated by the futures. The title of the newest note by our next guest is spend. I think there are 8 Ds I counted in the title of that spend note. Part 2. Sean Darby is the Chief Global Equity Strategist at Jefferies. He's joining us from Hong Kong. And certainly this is a theme we've been talking a lot about, Sean. What's interesting in your note, you talk not just about consumer spending, which we have talked about quite a bit. You also talk about corporate spending, which I think has gotten less attention we talked about earlier. Intel's one example of that this morning. They're talking about $20 billion of spending this year on new facilities. How is that spending going to look for corporations, and what are they going to be spending it on?
Well, it's a really fascinating time because just about every balance sheet within the economic system, central bank, household, and now government with a 1.9 trillion and possibly another 3.3 trillion package. And we estimate that at the end of last year, US companies had somewhere around about 2.5 trillion of cash on their balance sheet. Remember, corporates globally raised the most amounts of money in history from the credit and equity markets. And what we feel is going to happen is that we're going to have an accelerated capex cycle. And the recent Philadelphia Federal Reserve survey showed that business capex intentions had melted up once again. So I think we could end up with this money being deployed not only as capital investment on both equipment and R&D and physical assets, but also in the form of share buybacks and increased dividends. And so far, the announcements year to date show that companies are already going through buyback programs that will be somewhere on the average of what they were over the last 10 years. So this whole spending pulse is going to be one of the largest in history if you look at all the balance sheets coming together in 2021.
Sean, over $2 trillion on corporate balance sheets. That's a lot of money. And I hear your point on capex and buybacks, but just in terms of dividends, what type of percentage increases in dividends are you looking for?
Well, I think the interesting thing last year was that despite profits dropping for the S&P somewhere between 18 to 20%, dividend per share was pretty much unchanged. It was an incredible period, in fact, that companies didn't go out and cut dividends that dramatically. So looking at the sort of dividend side, I think the payout ratios can actually move up 5-10% over the course of the next 12 months. And again, blended with buybacks, what we call the running yield, dividend plus buybacks could amount to about 3.5% of your overall running yield for companies, which would actually be extremely strong given the context of the cycle that we've been in. Just in 1 year, you've almost seen a huge change in both buybacks and dividends at the same time.
And Sean, I'm curious in what sectors you expect this spending, not just the spending to happen, but it to help the stock price. We've been having this debate about whether we are going to see any kind of rotation back into tech, or at least a stalling of the rotation out of tech. And so I'm curious for that sector in particular, what the spending is going to look like and whether we'll start to see it benefit these stocks. Maybe it's not going to happen this year. Maybe it'll be more next year.
Well, the good news is that we've already front run a little bit of the cycle so far with the housing market being so robust. So housing has already taken off over the course of the last 9 months. Our indications are that the cyclical industries, utilization rates and capacity utilization rates are also melting up. So this isn't just a technology story. Certainly tech spending in itself has actually been growing above trend. It's an enormous catch-up of other industries at the same time. I think you were earlier talking about some of the difficulties in meeting semiconductor demand at the moment. But if you actually look in the chemical sector and petrochemical sector, there's the same problems also appearing as well. Nylon for the airbags for cars is in short supply as well. So the supply inelasticity in the system in a lot of the old economy in itself is going to see quite a large reinvestment cycle. And I think one thing that we've also noted is that this is not just a US theme. If you look globally, the global capex cycles and CEO surveys are also all showing the same level of desire for investment. So for the S&P 500, the sort of industrials and material sectors which tend to benefit the most from this is actually going to be a really, really rosy environment for profits as we get this second derivative of spending coming through.
Looking at the opening bell soon here on Wall Street. DigitalOcean is celebrating its IPO today, and there you have the opening bell on Wall Street. And we see CEO Yancey Spruill, who is ringing that opening bell. DigitalOcean, open to public markets. Sean, it's not just companies out there spending potentially on buybacks and dividends. It's also consumers. I've been tracking across a lot of data suggesting that consumer spending has started to pick up in a big way this month. What consumer names do you like?
Well, that's a very good question. In fact, if we look just like yourself, we've also been tracking both the flow side for consumers in terms of real wages and also the asset side, and net worth and is actually being close to record highs as well. So from our side, when we've analyzed the vaccine rollout and its influence on consumer sentiment, if you look at the Michigan survey or the Conference Board consumer surveys, they're very, very highly sensitive to the changes in the vaccine rollout. And the stocks that tend to do the best in that environment are consumer discretionary. In fact, your hotels, your casinos, the very high end of spending tends to benefit the most as you get that big upswing in consumer confidence. And certainly if the data is, as you've been alluding to in terms of the vaccine rollout, proceeds according to plan towards May, then I really do feel that the high-end consumer discretionary names are probably going to be the biggest beneficiary of this change in this sort of sentiment towards lockdowns and so forth.
And Sean, on that note as well, some of the surveys that have been coming out on what people plan to spend their stimulus checks on, some of them are saying they plan to still save the money, which is interesting, given that's what we saw the first two tranches of stimulus go to in large part. Does that also, though, sort of hint at a more protracted increase in consumer spending? In other words, we could see some waves of increases as things start to reopen up, as people do say, okay, well, maybe now I feel safe enough to shift some of that saving into spending.
Well, I think it's very much related, that savings bias has been within the US economy really since the GFC. And perhaps one of the untold stories is that actually the household savings rate in the United States was at its, I think, decade highs just as the pandemic struck. So in many ways, the household balance sheets were in much, much better condition to deal with the pandemic than they would have been at any time over the last 20 years. So I think a lot of that, how should we say, discretionary saving is just related to the employment markets. And again, the good news there is that job vacancies are starting to rally, and again, companies are complaining about the ability to hire skilled workers. So, in one sense, that there is a potential for a more protracted rundown of that savings bias once the employment employment conditions start to firm up.
Sean Darby, Jefferies Chief Global Equity Strategist. Always good to get some time with you, Sean. Appreciate it.
Thank you.
Let's dig a little more deeply into the opening bell action at the moment. Indeed, we have an increase across the board here, about 0.4%. As stock trading gets underway, our Jared Blickery is here with the details. Jared.
That's right. It's neck and neck for the majors. We got each of them up about 45 to 50 basis points right now. Russell 2000, a standout, up over 1%. That's after a nasty loss yesterday. We'll take a quick look at that. We can see a steep sell-off there. I think it was about 2.5%, 3% by the close. But let's take a look inside the NASDAQ 100. And with the 10-year T-note yield just about flat on the day so far, not a lot of big outstanding winners and losers, but we are seeing some excitement in the chip space. So let's just kind of go over there. We have Intel. We've been talking about them. They've been doubling down on their fab strategy here. They're up 4.5%. ASML is up 5%. Applied Materials up 7%. We've seen this sector be a perennial winner at various times throughout the COVID rally, and they've come back lately. So let's keep an eye on them today. Also checking out the sector action, the big winner here is energy. That's up over 2%. That's as crude oil bouncing back after falling into correction territory yesterday. Also seeing some movement in financials and industrials, materials, discretionary, all of those outperforming. So it looks like a day for the cyclicals here. Now, pulling in the rear, we have the defensive plays that were actually the winners yesterday. We got staples, utilities, and real estate. Those are the biggest laggards. So we got to check in on GameStop. So some interesting news. They missed on both their top and bottom lines, but I think the news for me is that they're becoming a black box. They're not giving any guidance, not going to report comps, I guess, throughout 2021. We'll have to see how that plays out, but kind of just revamping their entire strategy and keeping it under wraps for now. $164. I think that's the lowest in several weeks here for GameStop. Got to check in on the travel sector as well. We see lots of green there after some pretty steep losses yesterday. United up over 3%, and Carnival Cruise Lines up over 5%, guys.
And Jared, good point there on GameStop. We're going to talk a little more about their lack of disclosures with Telsey Advisory Group's Joe Feldman coming up. But I do want to talk about ask you about the Suez Canal because a ship there got stuck. By all indications, it is still stuck, and there you're seeing that ship right now. What are you seeing in some of these transport stocks here this morning?
Well, let's take a look. Here are the Dow Jones Transportation stocks, and this is populated. Some of the biggest winners here we were just talking about in the airlines, but the railroads, a lot of these companies have been at record highs very recently. We got that bid for Kansas City, and also I think Norfolk Southern has also been at record highs recently. Transports have really been booming here. And, you get back to Dow theory. It's always nice to see the Dow Industrials and the Dow Transports making record highs at the same time. And that's the situation that we're in right now. So transport's really confirming a lot of the strength that we've been seeing in some of the other indices, Brian.
Yeah, and also we should mention that you mentioned the XLE is the top performer in the S&P. That's the energy sector ETF, and oil prices also rising because can't move any oil through the Suez at the moment. We'll see how long it takes. Maybe we should start a poll. How long is it going to take to get Ever Given, I believe is the name of that ship, out of the canal? Any guess? I have no shipping expertise.
Neither do I, but I'll say 5 days. Yeah.
5 days. Sazi, you got a guess there?
Yeah, I'm going with 5 days here, guys. 5 days. You have to refloat that big ship, probably lose some weight. That's just me. Educated guess. I know you don't like predictions, Julie, though.
I don't.
Julie,
like
you got to go with
$1.
Come on.
This feels like consensus, though. 5 days. All right, we're going to take a quick break. Thank you so much, Jared. Appreciate it. When we come back, we are indeed going to dig more into those GameStop numbers and the lack of predictions the company is giving. We'll be right back.
GameStop shares are getting pounded right now after the Reddit target came up short last night with its fourth quarter profits. The company also hinted at a possible share sale, which would come at the expense of existing shareholders. Joe Feldman covers GameStop at Telsey Advisory Group, and he is here with us now. Joe, good to speak with you again here. How disappointed are with you just with the optics of the overall quarter? Sure, they missed, but the earnings call, no Q&A session here, lack of disclosure overall. They made no reference of the stock price performance, except they buried in the middle of their annual report. Have you talked to the team since the report, and how do you model the company's earnings moving forward with its lack of disclosure?
Yeah, I mean, look, it's been a challenge modeling really everybody. I mean, to be candid, most retailers this year have not been giving a lot of forward guidance, just given how confusing it's been with COVID and the comparisons year over year. So I understand, maybe being a little more opaque on that front. However, the company didn't even take questions on the conference call. They usually make themselves more available after the conference call to at least give a little more color as to what they're thinking, what the trends might be. Didn't get any of that from them. So it's been really quite frustrating. And I think for all those investors in the stock, they've probably been pretty upset just that there wasn't a lot of new information to come out yesterday. Certainly nothing transformational out of the company that people were hoping for.
And Joe, the company did see an increase in sales of certain metrics, right? Digital sales went up, same store sales went up. I mean, in as much as you can read the tea leaves here, what does GameStop look like in 6 months or a year? I mean, let's say nothing changes. Let's assume there's no transformation, because they haven't told us there's going to be. What does GameStop then look like?
I think GameStop's on the path that they were on before Ryan Cohen got involved and the RC Ventures, his company. They've been trying to, do things to make the store more inviting, improve the merchandising within the store, make it more of an experiential customer experience, trying to get, the better customer service, improve the technology, improve fulfillment options. That's what they talked about that they're going to do for 2021. That's the plan. And all along, we had the new console cycle had launched, right? The new Sony and Microsoft consoles that happened this year. That was going to be the big driver for this year. That's what we all were expecting. You'd see a return back to positive sales growth, and that, the holiday season in 2021 would be better, and there'd be more availability of the product. And the demand is there for it. So, that all is true. It's what's happening. And, in that scenario, we thought things would look pretty decent for the stock. But then it just got crazy with this whole run up with the Reddit investor base that's gotten into it, and the short squeeze that happened. And so now, the fundamentals are completely divorced of what the stock price is doing right now. So we still have an underperform rating on it and a $30 price target.
So, Joe, do you think GameStop is in fact fixable? There continues to be, at least from the outside looking in, this view amongst traders that GameStop will become the next Chewy because of Ryan Cohen. But newsflash here, GameStop still operates over 4,800 stores. It's not a Chewy. Chewy just is an online retailer that sells really great products for adorable puppies and kittens there, and you can constantly order that. There's no need to go to GameStop.
Yeah. Yeah, well, absolutely right. No, I understand what you're saying. I still feel like there's a place in the ecosystem, the video game ecosystem for GameStop. Now, maybe you don't need as many stores. And fortunately for GameStop and for all the landlords, actually, their average lease term is around 2 to 3 years. So really within 3 years, GameStop could theoretically close every one of their stores at no extra cost just by walking away from the leases. So I'm not overly concerned about that. I think the issue is you just need a more inviting experience, and they need to be able to participate on the digital side a little bit better. But, look, when you talk to the video game manufacturers, like Take-Two and EA, they need GameStop. GameStop still plays an important role in that ecosystem. I understand there's Best Buy and Walmart and Target and Costco and other places, Amazon, you can buy this product. But GameStop is still the leader in the space. They still have potential to be that hangout for that core consumer and make the stores more fun. And that's really where their heads were at prior to this whole thing, and trying to become the next Chewy's, which really what makes Chewy's work is I get a bag of dog food once a month because I need to feed my dogs. That's the recurring revenue stream that they get out of it. I don't know that you can get that out of a GameStop situation.
That's a good point. In the conference call that they have, it was abbreviated, like you mentioned. They said they were exploring options for that European business, and that European business is about 954 stores. Do you think they might exit Europe entirely?
Yeah, that's what we were thinking, that they might actually exit Europe. I mean, it's been a tough market for them. It's not been great. I know it's been tough for everybody because of COVID, and the closures that have happened there. But really, it's not the most profitable business for them, and they could walk away from that. I think that there's some hope, that with the Ryan Cohen and the transition to digital that they're talking about. I mean, in theory, the company has a very strong balance sheet. They could try to buy a game manufacturer. They could try to get more into esports side of video gaming. So there's definitely things that they could do to become a more digital business. And maybe that they will ultimately do that. But it does feel like that the business is going to be different. And if you noticed also in the press release and on the conference call, they talked about improving fulfillment options in the US. It wasn't necessarily a global discussion of the supply chain. It was much more about the US supply chain. So it does feel like they're maybe going to try to skinny back down to that core US business. Although Australia was probably the best market. So, I don't think they're walking away from Australia anytime soon.
And the saga rolls right along. Joe Feldman, Senior Managing Director at Telsey Advisory Group. Good to see you this morning. All right, coming up, there could be a COVID-19 vaccine blockade in Europe. More on that straight ahead.
Check on what's going on in European markets and business news as well right now. Oscar Williams-Groot is joining us. And Oscar, it looks as though in the latest sort of vaccine development over there, that Europe is not going to be exporting vaccine. This is something that's been happening in the US as well, by the way. But it's really interesting, these tension points around the globe on distribution of vaccine.
That's right. The European Union have today taken a aggressive step to potentially put in place export bans if they feel necessary. The New York Times reported overnight that the EU was drawing up new rules to allow them to throttle exports if they thought that they were unfairly being cut out, essentially, of supply that was developed in the bloc but then shipped elsewhere. This was confirmed today, just within the last couple of hours. The EU said the new rules would introduce the principles of reciprocity and proportionality. Essentially, what that means is exporters will now have to show that the destination country doesn't have export controls itself going back towards the EU. And crucially, the EU will make a judgment on whether the destination country has the same sort of epidemiological situation as the EU. Essentially, that means if a country with a better vaccine record, better vaccine coverage than the EU, they may not get any more supply. Now, that is a big blow for the UK, which, of course, has been very far ahead of the EU up until now, and involved in a bit of a row with the EU over supply of the AstraZeneca jab. This was developed in partnership with the University of Oxford, so the UK feel that they have quite the claim to this, but the EU feel that AstraZeneca are shortchanging them on the deal for a vaccine supply that they have done in the past. UK is the number one export destination from the EU with about 10 million doses sent to date. EU officials have, just over the weekend, raided a factory in Italy connected to AstraZeneca, fearing that doses were being stockpiled there to be sent to the UK over the sort of EU's head. That remains to be seen how that will develop. But the EU said that these new measures are targeted, proportionate, transparent, and temporary. I'm sure the UK would disagree quite strongly with that, although at the moment we've yet to have any announcement on official bans per se, just the threat of them. In the backdrop to all this is stocks are lower today as it points to increased tensions over the vaccine supply and growing fears about the third wave across Europe. This is despite the fact that we had better than expected PMI data across the Eurozone and the UK, showing a big rebound in March. That looks like that's going to be quickly revised away as we move into this third wave fears. Back to you, Julie.
Oscar, thank you so much. Our Oscar Williams Group in the UK, breaking down what's going on there for us. Coming up next, more data on how people are spending their stimulus checks already. Some early numbers. We'll be right back. Well, today, Brian Sozzi is training those laser eyes on spending, stimulus spending specifically. There we go. Brian, we've been talking about this all show long. We've got a bit of a theme developing here about spending, about where the spending is happening and whether it's happening. And you were looking into some credit card data that already shows us that it's happening.
Yeah, hat tip to the folks at JP Morgan who obviously are tracking this because they have credit and debit cards. So the data they have compiled here showing that consumer spending this month is not just picking up in a big way, perhaps a big way. The numbers here for the last 7 days ended March 19th, spending on Chase cards skyrocketed 23.9%. Now, from January up until the latest round of stimulus checks, those increases were only about 10%. So we're getting a next level of spending here as the new checks arrive directly to the households that needed it. And where the gains are occurring are obviously in supermarkets, wholesale clubs, and discount stores. The biggest increase highlighted in this report is from wholesale clubs and discount stores. So I would take that to be a Costco, a Walmart, or Target. JP Morgan noticing a 23.7% sales increase. And you can see some of those increases in that chart right now on the screen. But I do want to note here, Julie, we recently ran a Yahoo Finance Harris poll, and it continues to show a lot of these households, even though they're getting this in cash infusion, they continue to struggle here financially. That is why, in many respects, they are getting these stimulus checks here. Worth noting, most Americans said in our recent Yahoo Finance Harris poll survey that compared to before the pandemic, their household finances remain unchanged, about 52%. And so you have a lot of households that are getting these checks, and it's not out there. They're not necessarily out there buying footwear and new things to wear out to the restaurants. In many cases, they're just doing it to pay for their daily necessities like food.
Yeah, that's a really good point, and that obviously evident in where they're spending. Although, these stores do have some discretionary items, it's mostly necessities. I'm also really curious, Brian, once we get more insight and more transparency into where this money is going, to our earlier point that we were discussing, how much of it is going to be saved by Americans? Because I think there's, it's really sunk in with people that now that this has happened with the pandemic, now that people went through the financial crisis, this stuff happens, right? And people maybe want to be a little bit more prepared than they were before.
Right, you get this, at least from the data, some of the data we're getting here early on, Julie, it's consumers haven't learned their lesson necessarily. They're out there spending these checks. So they're, by design, they're doing what they're supposed to be doing. Check in, money out into whatever stores. Economic growth picks up in the first half of the year. But to your point, it would be good to save some of this money for a rainy day if households are able to do it. I was thinking back to our editor-in-chief, Andy Sorrell, just talked to Susie Orman. She suggested people save their stimulus checks, and that makes a lot of sense.
Not surprised that Susie would recommend that. All right, we are going to take a break. When we come back, another check on the markets, and we're going to be digging into the recent action in tech stocks. Also, Robinhood filed confidentially for its IPO. We will discuss. Just after 10 a.m. on Wednesday, March 24th, this is Yahoo Finance Live. I'm Julie Hyman, along with Brian Sozzi. Miles Udland has the day off. Let's take a look at stocks here about a half hour into the trading session. And we've been seeing all three major averages higher until now. The NASDAQ is now off by about 0.25%. We did just get the U.S. manufacturing PMIs coming out from market, coming in very slightly below estimates for the March preliminary read at 59 versus the 59.5 that analysts and economists had been predicting here. The services PMI coming in bang in line with estimates at 60. So both of those signaling pretty strong expansion. Remember, 50 is the dividing line between expansion and contraction. The prices paid gauges in both of those, it looks like at the highest levels that we've seen in quite some time. Services, the highest since July of 2014. So that pointing to more, at least temporary inflation, which is something that we have been talking about, and the Fed, of course, has been flagging. Well, NASDAQ had been rebounding this morning. Investors, though, are trying to assess whether the sell-off is going to resume. We're going to talk big tech with Brent Thill of Jefferies in just a moment. And you're looking at Robinhood there. Its hotly anticipated IPO is coming. The company filed a confidential S-1, but will the debut result in tendies for buyers of the stock? And speaking of IPOs, wholesale car auction platform ACV goes public today. We'll speak with the CEO about the auto market generally and the chips shortages effect on it as well. But first, let's get to our discussion of big tech here because, you know, as we have been watching, Brian, there's been a lot of debate. There's been a lot of consternation on the part of folks who bought big into tech during the pandemic and have seen it pull back. Brent Thill is with us now of Jefferies. He's the senior analyst there who looks at a lot of these big tech stocks. So Brent, how are you thinking about tech sort of broadly here in terms of where we are in the cycle for the stocks? Not so much the fundamental cycle, but where we are in the cycle for stocks, and how long do you think this sort of turbulence could last?
Good morning. Thanks for having me. I would just say that I think we've called it a timeout in tech. I think right now many of the tech stocks have overextended. They had a massive run as we worked from home last year, and investors flocked into these stocks, and multiples went higher than on average we've seen. So in software, you saw 40-50% move in valuation last year, and where we were seeing single digit or low double digit multiple returns year on year. So, it's the analogy we've had is if you bring your Suburban to Costco and load up the Suburban with food, you have to digest that food. You can't just keep going back. And I think we're in a digestion kind of timeout period around big tech. It's absolutely amazing to see Adobe blow away the numbers. Stock's not even moving up on an incredible raise and acceleration of their revenue growth, and gave a great overview that S&Ps are coming back to spend. So I think that's a direct signal that tech is off limits right now. You're seeing money go to travel stocks. You're seeing money go to airlines. You're seeing, the broadening of money move out. And our strategists at Jefferies have been calling for this. They've been right, that we would see a broader flows outside of tech. And I think money will come back. It's just right now, I think valuation combined with the names aren't working. I think it's frustrating a lot of investors. A lot of these hedge funds have gotten turned upside down, and they've had to rethink their positioning. So right now, again, I call it more of a timeout. Fundamentals are really healthy. So as a fundamental analyst, are things good or bad? They're really good. Valuation is just high.
All right, what do you need to see to lift your timeout? And when you do lift that timeout, what names do you like?
So we don't have a timeout across the entire sector. We have a framework of names that we really like. We've been highlighting in internet. Facebook is a cheap name, and FANG, when FANG names are down and out, those are the ones to buy, right? Google a couple of years ago, Amazon a few years ago, right? And they tend to cycle, and so the playbook has worked where, in the Facebook, Amazon, Netflix, Google, when one name is out of favor, you typically buy because these companies aren't going anywhere, right? They're long-term great franchises. So Facebook, we called out at the beginning of the year, started down, high single digits, and now, the stock is up about 6% year to date. So that's a great example of a name that we think is cheap. $15 of earnings power, put a mid-20 multiple on it, you're at $350, $375 on the stock. So you got a lot of upside still in Facebook, and the sentiment's terrible. We like that. In mid cap, we like Wix. And then if you move over to software, we like names like Intuit and Microsoft, just the big, stable, steady eddies. Intuit's got this incredible defensive engine with tax and an incredible offensive engine with small business, and they're buying the stock back after a big acquisition. So they're back buying their own stock back. So we like Intuit's recurring revenue, 12 years of positive returns. Microsoft is a steady eddy. We still like Adobe and Salesforce as well. And then in cybersecurity, we're a fan of what's happening with Palo Alto Networks and Varonis. So we have a basket of names that we still like. Again, I think it's, in terms of the timeout, I think we're very selective, more so than I would say in past years when tech is all down, and it tended to move up as a pack last year. And now it's being a lot more selective. And again, we're in agreement with our strategists to go outside of tech and look at other sectors as those sectors are going to open. So the opening trades right now are dating, Match, and Bumble. We love. People are going to date like crazy in the second half of the year. Restaurants are open and theaters, and we think that's going to happen, right? Travel, Airbnb is our favorite growth name. Booking.com would be our favorite value name. And then when you look at rideshare, Lyft will benefit. People are going to get on more cars than they have. I've been in a Lyft for 7 months. So we'll start to get back into cars versus using our own car. So we think those are kind of the three areas inside the internet that are kind of going to really blossom and open. And I really like the dating space. I think that's going to go crazy in the back half of this year.
That is a lot to choose from, Brent, even if you're being selective, giving people a lot of ideas there. There's one name that we haven't mentioned so far, I don't think, and that's Amazon. And there was a little bit of news this morning on AWS that Adam Selipsky is going to be the new head of AWS. He had run Tableau, then sold it to Salesforce, and if people are going to be dating, cloud, there presumably is going to be demand for cloud services from some of these other plays you're talking about. But how are you thinking about Amazon right now, and what do you think of the pick of Selipsky to run that business?
I don't think you could have found a better pick. The reason why is he spent 10 years plus at Amazon and then left to become a CEO and run Tableau, which was a great tech company, but was going through a business model transition. And I think he did a phenomenal job of leading that transition, then ultimately selling it to Salesforce.com as one of their largest acquisitions. And the feedback on Tableau from the end user checks is very positive. So I think if you look at the kind of the trajectory of him learning the AWS business, then running his own company, taking a troubled asset out of troubled waters into an incredible outcome, and bringing him back to run it, I'm not sure you could find a better exec to do it. And again, Jassy obviously is the CEO of the company, worked with them, he knows them, they're very close. So I don't think you could have found a better pick. And in terms of AWS, they're absolutely crushing it. I mean, it is a runaway freight train, 60% market share when you combine the top three. Microsoft's at 30% share, and Google's at 10%. So when you look at the market share numbers, it's just Amazon's got a huge gap, and no one can catch them. Every single private company we interact with is on AWS, and most of the public companies are moving to AWS. For example, Intuit, the nation's taxes are on AWS. And to put tax data inside a public cloud like that is a proof point of how amazing AWS is. So I think this is one of the most enduring franchises in tech that we see. They've had incredible backlog. They've disclosed in their filings their backlog's growing 50, 60%. And I think investors are waiting for the revenue growth, closer to 30 to inflect with the backlog growth. So all signs are fantastic on AWS. I really couldn't find a better franchise that companies are continuing to flock to.
Brent, finally, I have to ask you about the hearings that are scheduled to happen tomorrow. These are on disinformation happening before Congress. Zuckerberg, among others, is going to testify. None of these things have been really material, right? There's all this talk about things that are going to happen with big tech. Is there going to be a breakup required? Are there going to be more antitrust actions? Nothing is really materialized. What are you looking for from this hearing or any hearing to see if that's actually going to change? Oh, Brent, you still with us?
Yes, sorry. I'm here. Sorry, we had a glitch. I think ultimately the bottom line is that regulatory is not going to have a big impact on tech. We continue to say this and have said this for years, and I've followed Microsoft for 20 years. Even during the EU investigation in Microsoft, it was effectively nothing happened, and the stock just went higher. So the point is, anytime there's regulatory pressure on these stocks, as an investor, you buy. Is this important? Is this something we're watching? Absolutely, we take it very seriously. So I'm not trying to dismiss the importance of this, but we do not believe it has any relevance to investors, because ultimately, if these companies were broken up and we're wrong and we don't think there's a breakup, but you want me to be wrong, these stocks are going higher because the sum of the parts are greater than the whole. You break up Google, the sum of the parts is better. Amazon, you break off AWS, it would probably have one of the biggest multiples of any software company on the planet. We've got Snowflake trading at 45 times revenue. Like, what's AWS going to trade at? It's not trading at 45 times revenue right now and embedded in the belly of Amazon. So ultimately, I think you're going to see, ongoing. This is good, right? The government and the regulators are trying to do the best thing for all of us as consumers. We all use these products. The tech companies are trying to innovate and do the right thing to bring innovation and excitement to our homes. And there's a middle ground. And I think they can find this middle ground together rather than having to be broken up. And so we again, if I'm wrong, again, it's the best situation. You want me to be wrong, because if I'm wrong, then tech's going a lot higher.
Win-win. Brent Thill, great to talk with you. Thank you so much for spending some time with us this morning, Brent Thill of Jefferies. And there's one other hot stock. You could call it a tech stock, you could call it fintech, that is planning to go public. That, of course, is Robinhood. It filed confidentially to go public. This is something we have been waiting for. Jared Blickery is with us to chat about this a little bit. Not sure why we were showing Mark Zuckerberg, but Vlad Tenev perhaps would be the guy of the hour when it comes to Robinhood. And it seems to me Robinhood, Jared, is it is treading a fine line between being hot right now because people are talking about it a lot still, and sort of drawing unwanted regulatory scrutiny. It's kind of got a delicate balancing act here.
Yeah, well, brings to mind Tesla. Elon Musk has been here before, but under very different circumstances. Robinhood has been in regulatory crosshairs for a while. They paid a $65 million fine last year. They're currently under a DOJ probe. It looks like SEC has been looking into GameStop and looking into them in particular. They've faced multiple congressional hearings now. And guess what? They're going to go public. So I think that's a vote of confidence, at least from the street, saying, all right, these guys have a chance. They're going to get over their regulatory issues. Maybe this can be kind of swept under the rug, pay a fine, whatever. But just to give a little bit of background about the way these things work, we don't have any details on the filing yet. Robinhood confirmed that they had filed confidentially with the SEC, but it's going to be probably another month, 2 months at least before we actually get that IPO, because they have to go through a review process. They're going to submit multiple amendments. Usually in about 1 month's time, they file their real S1 instead of the confidential one. At that point, things become public. We can look at their financials, and there's going to be a lot of scrutiny there because you have risk factors. That's going to describe what could go wrong with their business. They have legal disclosures, and there could be quite a few there. They have a class action suit against them currently. They'll have to disclose some details about that. But all in all, this is a pretty popular company, despite the fact that a lot of their customers were not able to access their platform for hours at a time, days at a time, in critical moments when the GameStop was, going to $450, almost $500 per share. I kind of pull the sentiment on the street, and people still like Robinhood. So if they're not facing backlash from their customers and they're still popular, why not? Cash in. You got to have that liquidity moment.
Yeah, very interesting. I'm going to be really curious to see if your poll proves correct and if people want to actually buy the stock as well. Thank you, Jared. Appreciate it. We're going to take a break. When we come back, we will be talking about U.S. Treasury Secretary Janet Yellen as well as Fed Chair Jay Powell, both of them testifying now before Congress, and we will be digging into what they have said and what they yet may say. We'll be right back.
Hi, Ms. Sidhu. We'll check in with you during the next break, so you can stay on mute for now.
Sounds
Thank
good.
you.
Markets are eyeing day two testimony from Fed Chief Jerome Powell and Treasury Secretary Janet Yellen in front of lawmakers. Yahoo Finance Fed correspondent Brian Chung is here along with Claudia Sam. She is a senior fellow at the Jane Family Institute and a former Federal Reserve economist. Brian, let me start with you. Janet Yellen has just begun speaking. What do we know so far?
Yeah, Brian, well, this is the second day of back-to-back days of hearings with Chairman Powell alongside Treasury Secretary and former Fed Chair Janet Yellen. They did speak at the House Financial Services Committee yesterday, and both seemed pretty optimistic about the economic recovery. Yellen telling Congress that she could see the economy returning to full employment as soon as next year, but Chairman Powell saying that for the Fed's part, they will continue to provide the economy with the support that it needs for, quote, as long as it takes until it gets to that point. But an interesting focal point about the hearing yesterday was climate change. Democrats and Republicans were both asking questions about how financial regulators are approaching the issue, and both Yellen and Powell saying that they were prioritizing that, which is very interesting. Again, the hearing kicking off right now in the Senate Bank Committee. Will be interesting to see what the duo says today.
And Claudia, you're a former Fed staffer, and you talk in a recent column in the New York Times about your views on Jay Powell and sort of how he has built up this Fed and built up this Fed's credibility. And it's a really great piece. I encourage everyone to go read it. You also talk a lot about the employment part of the dual mandate. And it sounds like you really think the Fed is going to prioritize that. And that's part of what is letting the Fed ride through this transitory inflation period, if I'm reading it correctly.
Well, what I think is that the Fed is, after over 40 years, bringing its maximum employment mandate that it got from Congress on par with its stable price mandate. So I don't think that the Fed is prioritizing one over the other. I think they're trying to get both, right? Like, they never hit their inflation target in the entire time since the Great Recession. So this is a Fed that is trying a new framework, and we're going to see it tried out here pretty soon. And I think what's hard for people who watch the Fed like I do, or in markets, is we are in uncharted territory, both in what the Federal Reserve is trying to do and what the administration is trying to do in Congress. So it's going to be a bumpy ride. I think we are pointed in the right direction, and we are still short 9.5 million jobs. Like, we need people pulling for employment.
Claudia, Brian Chung here. It's great to speak with you again. And one interesting aspect of the new framework is trying to reduce the shortfalls of employment has also involved the Federal Reserve paying more attention to the racial wealth gap, climate change, issues like that, which I think the central bank has been kind of shy to want to delve into in previous Federal Reserve, I guess, structures. So what do you think led to that change? And do you think that's going to lead to any sort of political headwinds that could be challenging for the messaging from the top, let's say Jay Powell, in the future?
Well, one thing that I try to do in my piece is to lay out the history that I don't think is appreciated. The dual mandate, the maximum employment mandate, came out of the civil rights movement. And Loretta Scott King, Martin Luther King Jr.'s widow, was standing at the signing of the Humphrey Hawkins Act that brings brings the Federal Reserve Chair twice a year in front of Congress to report on how you doing on that mandate, right? And this is something. So there was a racial equity, a racial justice within the labor markets. That is why the Fed has this mandate. So I think it's appropriate and long past overdue for them to have this conversation. And then it's also about that mandate, right? Maximum employment means basically that everyone who wants a job has one. And the last people, sadly and tragically, in this country who get back into the workforce, they tend to be people of color and other marginalized groups. So if they're going to achieve their mandate, they really do have to pay attention to what's happening in labor markets, and particularly those who are most on the sidelines.
And Claudia, you mentioned in your New York Times op-ed that this Fed under Jay Powell is becoming a more Main Street Fed. And I imagine part of that is reflected in them improving diversity within the Federal Reserve itself. Where is the Fed in those internal diversity efforts, and how would you grade their performance so far?
They're trying. No, I think, and one thing in the piece, like, we're seeing a lot of the fruits of labor and introspection that's been happening at the Federal Reserve since just a few years after the Great Recession, because we understood as a staff, and Federal Reserve officials understood, we missed it, right? There were signs of the financial crisis brewing, and we missed it. And we don't want that to happen again. There are a lot of pieces to that, thinking about financial stability. And, I could go on and on with the ways the Fed has learned. You see that in the framework, and you see that with them having a degree of comfort, though it's a long way from really looking comfortable, talking about race in the economy and labor markets and how they interact. And so I think we need to be there. They're trying very hard. My grade of them is, moving from a C, maybe up to a B minus. But I think we're going to actually do better in terms of the policy. We're seeing the policy already. Diversity and inclusion amongst the staff is really hard. Right now, there are no Black economists at the Federal Reserve out of the 400 at the Board of Governors that work on the economic forecast and like anything that goes into monetary policy. They understand this. This is not something that they are comfortable with, and they've done a lot to improve more junior ranks. But like that's bad, right? But they're working on it. So I applaud their efforts, but I really want to see it in terms of policy. How we affect people outside of the Fed is so much more important than anything else the Fed could be doing.
We appreciate your transparency on that. Let's leave it there. Yahoo Finance Fed correspondent Brian Chung, he will, I'm sure, continue to monitor this testimony down on Capitol Hill, so we'll probably hear from you shortly. And Claudia Sahm, senior fellow at the Jane Family Institute and former Federal Reserve economist. Good to see you.
Great. Thank you.
Thanks. All right, coming up, we'll chat with one up-and-comer in the mobile banking industry. Stay tuned.
Technologies is one of the many, many companies that went public through a SPAC deal earlier this year. What makes the company unique, however, is that public debut made its founder, Loveleen Sidhu, the youngest female founder, CEO of a public company, and Loveleen is joining us now. This is a mobile banking company, Loveleen. So if you could just walk us through it a little bit, first of all, what BM is, how it's different, and what is a very competitive landscape right now for fintech and mobile banking. What makes BM BM?
Sure. Thanks so much for having me. So BM Technologies is one of the largest digital banking platforms in the country today. We have over 2 million account holders. And really our mission is, how do we utilize technology to create a better banking experience for millions of Americans, especially around affordability, transparency, more consumer-friendly products, etc. And so for us, we have a unique way of delivering our banking services where we actually work with partners to be able to access new bank account holders. So for example, we work with 725 campuses across the country where we now get to offer banking services to 1 in every 3 college-bound students. We've also partnered with T-Mobile to launch a checking account to their customers to better attract, engage, and retain them. And that product is called T-Mobile Money. And we're also now working with Google to launch a Bank Mobile Googleplex account later this year. So that is our model to work with the best brands and really companies as well as institutions that want to create the best banking experience for their students, for their customers, and we're there to enable them to do that.
And Loveleen, I believe you guys are EBITDA positive. Do you guys have a banking charter? And talk to me about the business model that allows you to get cash flow positive.
Yeah, so we are, as you mentioned in the beginning, we were one of the first, if not the first, neobanking fintechs to go public this year. And we are one of the only, if not the only, that we're aware of that is EBITDA positive. And what has really helped us create a profitable high growth model is what we consider our B2B2C strategy, or banking as a service. So this is what I explained, where we work with partners that have entrenched customer bases already. And by able to leverage their customer bases, we actually lower our customer acquisition costs. So today, we're acquiring customers at less than $10 when a typical bank is spending $300 to $1,500 to get a checking account. And the beauty of this is that we can then pass on those savings to create a better experience for our customers around the technology, the UX experience, and making it easy to use, and of course, affordable banking.
Loveleen, do you accept Bitcoin yet on the platform?
We don't. Today, we are starting with the primary banking experience. So checking account is the anchor product, offering savings accounts, offering a full suite of lending products, including student refinance, personal loans, credit cards. And the next iteration is really to get into investing and being able to expand that into cryptocurrency investing as well. So we believe in a full digital banking platform. You no longer can just have one slice of the pie, a checking account, and think that that's it. But that is the anchor foundation product where you get that stickiness of that direct deposit coming in. You build the emotional connection, you build the trust from there, and then layer on a full suite of banking products to be able to serve someone throughout their lifetime. And that's what we're focused on doing.
When you say investing, do you want to also have a component of the company going head to head with a Robinhood?
Yeah, for us, firstly, there's a build and buy component. We have technology. We're a technology company first. So we're API enabled. So there's some things that we build ourselves and create that experience. And there's other times where it makes sense to partner with someone. So whether that's, Acorns or a Robinhood, we have the opportunity to plug, players like that into our ecosystem and work in partnership with them. And so, yeah, for investing, it's on our roadmap. We have different paths forward to be able to come to fruition. But for our mandate is to, Americans are paying $34 billion a year in just overdraft fees. A third of Americans, these same Americans can't, are living paycheck to paycheck. 50% of them don't have enough to pay for a $400 emergency. So we're really focused on being able to leverage our partnership model, where our customer acquisition cost is so low that we can create the most affordable and best technology experience and offer a full suite of banking products, either that we build or through partnerships that we enable through our API technology.
Loveleen, thank you for being here. It's great to meet you. Loveleen Sidhu is founder, chair, and CEO of BM Technologies. Appreciate it.
Thank you.
Well, coming up, we are going to be talking about wholesale car auctions. This amidst a very interesting time in the auto industry between migration to EVs, shortages of chips. We'll talk to the head of ACV Auctions next.
Wholesale car auction platform ACV Auctions debuts today over at the NASDAQ. The company saw sales surge 95% last year, $208 million, but it did start up a $41 million net loss as it continues to build out its online platform. ACV Auction CEO George Chamoun joins us now from the NASDAQ. George, congratulations on the listing here. We're still waiting for that opening price there, but for viewers not familiar with your business, what part of the auto industry are you trying to disrupt?
Yeah, thanks, Ryan. ACV is on the wholesale side of the automotive industry. So dealers purchase around 20 million cars a year to then in turn sell 30 million cars. And ACV is the most transparent and trusted way for dealers to buy a vehicle to then in turn retail it.
George, it's Julie here. Talk to me about the demand and what you guys have been seeing, especially given some of the dynamics in the auto industry right now, with the chip shortage going on that's affecting the supply of new vehicles. Is some of that demand transferring to used?
Yeah, certainly. I mean, the used vehicle marketplace is extremely hot. But by the way, it's been growing for years. So this isn't just a current theme. If you look back over the last 10 plus years, used car sector continues to grow. And part of what's going on right now that you're referencing is there just aren't enough used vehicles. So consumers are out buying these vehicles, dealers need them. And what ACV is doing is providing a more transparent way where dealers can buy these vehicles with more data than ever been before.
How would you characterize the pricing environment for used cars? Are prices inflationary, the prices that consumers are paying?
I mean, at the end of the day, price is obviously relative to demand. And what you're seeing right now is, consumers need, I would say there's also just generally trust. So as consumers have trust buying used vehicles, we're seeing an increase in prices, but I just think it's relative to demand.
And when you're talking about demand for these vehicles, talk to us about, I mean, you guys are a little bit more of a mature business here that's coming public. What's the profitability picture look like?
So investors can learn about our profitability by studying our unit economics, both at a territory and at a cohort level. So we've provided a lot of information, both in our roadshow video and in our S1. And investors can see right through that our unit economics are very strong. Once we build a territory, a local area, around year 3, we turn profitable. So what you're seeing is yes, overall, we're losing money, but that's really because of the massive investment we're making in expanding our territories, as well as our investment in technology.
So year 3, you say you'll be profitable. What do those profits look like? What do the operating margins look like on a business like yours?
Well, what I was referencing is year 3 in building a new territory. So think geographically, we look at the United States as a little over 160 territories. And we're showing investors a long-term path to profitability of EBITDA margin targets of 30%, but that'll be many years out as we grow a very large business.
Speaking of many years out, I want to come back to the electric vehicle and sort of hybrid vehicle question, because we're really seeing what automakers are telling us anyway is going to be a big changeover in the supply of vehicles they're putting out in terms of technology, in terms of transitioning to fuel-free vehicles. How is that going to affect the used vehicle market? Are you going to see higher demand for gas vehicles, or are you going to see all of the used demand also start to transition?
Well, I think it's important to really understand how large and complex the used vehicle industry is. There's demand for all types of cars. So as the new electric cars come out, yes, there will be demand. Whether new demand will be 15 million units a year or 18 million or anywhere in between, we'll see demand for new, but then none of these used cars go away. And if you think about the demographics within the US and around the world, each and every price point is important, and you're also seeing used vehicles on the road longer and longer. So one way to really think about as we move towards electric, as we move towards self-driving, is cars just won't go away. As we see this recycle, it's really about having transparency and trust on the vehicles you are buying.
All right, ACV Auction CEO George Shimon, good luck in your public company journey. We'll be talking to you soon.
Yeah, thanks so much, Ryan. Thanks for having us.
All right, straight ahead, Yahoo Finance's Sabine Marcells is here with a look at food insecurity in America and how one company is trying to solve the problem. And we'll be right back.
Welcome back to Yahoo Finance Live. Food insecurity has really skyrocketed as a result of the pandemic, and also because millions of Americans have lost their jobs. Malnutrition has also gotten worse. I spoke to the president of Doled Packaged Foods about the impact on the country and also the world.
Food insecurity has increased not only in the US, but around the world. Today, there are more than 2 billion people globally facing food insecurity. And even more dramatic than that, which I think is an epidemic issue that we face today, is the fact that 1 out of 3 Americans suffer from chronic diseases from malnutrition. So it's a combination of both having food insecurity, but at the same time, not having the right food, the good food that we believe is a human right.
How exactly do you define malnutrition?
Malnutrition is about not having the essential nutrients that you need to thrive during the day. So we believe that when you eat excess amount of sugars, when you eat excess amount of saturated fats, when it's all about intense processed foods, you end up destroying or breaking the molecular structure of foods that come with the natural nutrients of all the goodness of the earth that certainly are not helping you from a health perspective. So malnutrition is about not only eating wrongly, but it's also about not eating properly. So it is an issue that is well documented out there.
And the U.S. government has kicked into high gear that $1.9 trillion stimulus package, which includes that 15% boost in SNAP benefits. Pierre, how much of a difference do you think that makes for low-income families?
Well, I hope it helps. There are so many food deserts in America today. People have to walk miles and miles to get a good grocery store that has good food and fresh produce. And we are working hard to give that access to people, both in terms of affordability and availability in America, in cities like Baltimore, in cities like Jackson, and certainly is an area that we are quite committed to at least help somehow by creating systemic change. We're driving everything we can in order to improve that access to good nutrition. As I said before, it's a human right. It's a tragedy today. I mean, you see the kind of diseases that we see today for malnutrition that are fundamentally creating more than 675,000 people dying every year. And this is just as tragic, if no more, than what COVID has been so far. So I hope these government programs can provide more of that good food to kids in schools and to those that really need it today.
And as you've mentioned, there's been a rise in malnutrition. So what are some of the barriers to good nutrition for everyone?
Well, first of all is availability. I mean, you take the city of Jackson as an example. For 165,000 people, there are only 20 grocery stores. People have to walk miles in order to get good food. And sadly, only 10% of those 20 stores actually have some fresh produce and good food. There are 70 fast food restaurants and 150 gas stations all selling junk food, sad to say. And I think that kind of infrastructure issue that we see in America, sadly, is happening in many cities across the country. So we're trying with our Sunshine for All program to create a model whereby collaborating with customers like Kroger and many other partners, both in the public and private sector, including the mayor of these cities, we can sort of bring education, we can bring that kind of availability that people need. So it's really deep into the roots of the issue in America that we see right now.
And as you mentioned there, so Dole launched the Sunshine for All Investment Fund, which provides $2 million annually for food access, sustainability, and waste. Now, how much of this money is actually going to the U.S. and how will it be deployed?
Well, the U.S. is our biggest market, and it all depends on the kind of organizations that will be approaching us to drive these kind of programs. So the fund is about giving access to good nutrition to 1 billion people around the world. It's also about creating or preserving the current planet conditions. You know that as though we have committed to become carbon neutral by 2030, to actually get out of plastics in 5 years from now, and also to help communities like farmers and many other stakeholders that are working with us So the idea is to have as many startup, founders, companies have been out there, NGOs and others, to work with us to create that systemic change that we need in our business to provide that access across the world. So obviously, America for us is the biggest market, and we hope that the majority of these funds will actually go there. But it's a global program, Sybil.
And having to do with sustainability and waste with food, can you dive a little bit deeper into that, into what are the issues there that you're trying to address?
Yes. Well, I call it a nutritional paradox. Sadly, the poorest people are the most obese, and that's correlated with statistics. It's not just me saying that, but it's a reality that we see in numbers. Second, there is a lot of waste of food and also starvation. And we believe that junk food is the food that sadly is killing people. So I think that what we need to do is to find the ways to educate as many consumers as possible. The malnutrition campaign that we have sent out is creating that awareness that people should be sort of like looking at the labels, understanding what they're buying, and sort of take care of themselves. So we're a drop in the ocean, but we believe that by creating a company, a business model that does good financially, but also from a social point of view, others will sort of join us, and hopefully together as an industry, and also working directly with many other entrepreneurs, we can drive that change.
And you made a very powerful statement there, saying that junk food kills people, unfortunately. Can you dive a little bit deeper into that?
It's not just my opinion. I mean, you look at whatever it is in terms of not just on calorie contents, but saturated fats and everything that comes with very cheap available food that unfortunately is a fraction of the cost of a good salad in any city in America and in many other cities around the world. So of course, when you are facing food insecurity, you're just looking for calories, but the question is, what's the quality of those calories, and how can we actually provide more of that good nutrition that comes with the goodness of the earth that can certainly help people to live longer and have a longer health span, as we call it. So it's not just about living longer, but also ensuring that the quality of your life improves as well. So I think that food companies need to really commit, as much as we're trying to do, and I say this with lots of humility, to understand what kind of food profile are we providing out there. Are we just doing good business, or are we sort of feeding a problem that has been endemic in the country and beyond for so many decades? And I think that's the commitment that we're trying to establish ourselves, but also as an industry as well.
And there you heard it from the president of Dole Packaged Foods, Pierluigi Sigismondi, saying that the food industry's role is not just to do business as usual and focus on profits, but also to help customers be healthy. We'll be right back.
going to close out the show where we started it, with Intel. Remember, we talked about how Intel has unveiled this ambitious new plan to turn itself around, build out more fabrication capacity for other chip makers, as well as improve its own execution. The share is not up as much now, Brian Sozzi. What's going on?
Yeah, Julia, it's not a bad day for Intel, but anytime you come out somewhat out of the blue, as Intel did, and say, you know what, we're going to invest $20 billion to build 2 giant chip-making factories in Arizona, I think that caught a lot of people on the street by surprise. And it's something now they're factoring into their estimates. That level of CapEx investment, we're already starting to see free cash flow estimates go down on Intel for this year and next. So I think it could just be the market realizing what Intel exactly said yesterday.
Interesting. I mean, we should also note the NASDAQ is the worst performer of the 3 major averages. The Dow now has really gained some steam, so could also be reflective of some broader moves in tech to some extent. All right, on behalf of myself and Brian, thanks for joining us over these past 2 hours. Akiko and Zach going to take you through the next 2 as we head through the trading session. Stay tuned.
Welcome in to Yahoo Finance Live here, everybody. Happy Wednesday. I'm Zach Guzman alongside Akiko Fujita as we have the Dow now up right now at more than 300 points, the NASDAQ and the S&P in the green, as well as we continue to track the testimony from Fed Chair Jerome Powell and Treasury Secretary Janet Yellen back in front of Congress today. We're also seeing Intel shares giving back the majority of a 6% pop after its new CEO said the company was back with a $20 billion investment in its chip-making abilities. We'll break that down and what analysts might be second-guessing about that confidence statement. Plus, the founder of the world's largest hedge fund, Bridgewater's Ray Dalio, sits down with our editor-in-chief, Andy Serwer, his new warning about bonds and where he sees inflation going from here. But first, As I said, Treasury Secretary Janet Yellen and Fed Chair Jerome Powell back in front of Congress again, this time in the Senate, delivering their own inflation and economic forecasts. In yesterday's House testimony, the duo reiterated their expectations that a strong economic recovery should continue into the year. Powell, for his part, beat back fears that the latest $1.9 trillion relief package would result in runaway inflation, but that was not all we got from them. So let's kick things off today with Yahoo Finance's Fed reporter Brian Chung here to break down what else we learned. Brian?
Well, another day of Jay Powell and Jay Yellen on Capitol Hill, this time in the Senate Banking Committee. This is following yesterday's hearing in the House Financial Services Committee. This only kicked off about an hour ago, and opening remarks took up the first half an hour. So we haven't gotten too much commentary yet. But in that first 30 minutes of substantive question and answer, we did get some little nuggets from their conversations with the senators, notably from Janet Yellen, who had said that she is kind of backtracking a little bit on her concerns about the U.S. debt that she had put out there in 2017 when she was the head of the Federal Reserve. She said, quote, "My views on the amount of fiscal space that the United States have changed somewhat since that point in time." She said that, yes, even though the debt to GDP ratio has increased because of low interest rates, thanks to the Federal Reserve, the amount of interest payments themselves are essentially unchanged over that period of time. But she did say that increasing revenue will be important in managing the debt here in the United States over the long term, which could be a hint at maybe teeing up what the Biden plan might be on raising taxes, specifically on those making more than $400,000 a year. Now, for Fed Chairman Powell's part, he was saying he doesn't see inflation running away despite that brightening outlook, adding that if that were to be the case, if prices were at a level that would be alarming, the Federal Reserve has the tools to address that. So some interesting commentary as the Senate Banking Committee is undergoing that questioning right now. We'll obviously have the full updates of that hearing right here on Yahoo Finance.
All right, Brian Chung watching the latest for us there today. And as we've been discussing, we're going to be bringing you the headlines if there are any more. Brian's going to keep us posted. But as we've been discussing, we've obviously been watching the yield on the 10-year, those jitters sprinkling through here on the market front as investors continue kind of this rotation that we've been talking about for a while away from tech into cyclicals. For more on that, I want to bring on our next guest here, Sean Snyder, Citi U.S. Wealth Management Head of Investment Strategy. Sean, good to be chatting with you again here today. I mean, you're kind of pointing out something that we've heard from a few that have been through this before. When we talk about a steepening yield curve coming out of a recession, what do you maybe look at in putting this back into historical context for where we're at right now?
Sure. First off, thank you for having me. I appreciate being on the show. It's really interesting. I think, people seem to be almost surprised by rising bond yields. But if we look back at the last 4 recessions, when we exited those recessions, the yield curve steepened every single time. And if you look back and you take the difference between the 10-year yield and the 2-year yield, which is what we define as the yield curve, the spread eventually peaked at about 2.4% during those past 4 recessions. Right now, the spread between the 10-year and the 2-year is about 1.5%, a little over 1.5%. So, I think that implies that we still have a ways to go here, and that the 10-year yield could eventually climb higher to maybe 2.5%, over the next year or two. So, I think the sheer velocity of how quickly bond yields kind of caught up to where the market was caught everybody off guard. And we have richly priced technology stocks, so it's causing them to reassess. But this is not a new phenomenon.
2.5% on the 10-year yield over the next year. I mean, that points to significant upside. What does that mean from an investment standpoint?
Well, if you actually look at the same 4 recessions and you go back and see what happened to the stock market during that time when the yield curve was steepening between the exit of the recession or the end of the recession and then the eventual peak of the yield curve, stock market continued to climb. They took about 18% gains in the S&P 500, about 20% gains in the NASDAQ over that period of time while the yield curve was steepening. Now, it took about 22 months on average from when you exited the recession to when the yield curve actually peaked. But, so it's not 22 months from here because we probably exited the recession maybe in the third quarter of 2020. So we've already seen the yield curve steepen, pretty markedly. So some of it's already probably done. But I think maybe you get another 8 to 10% gains in stocks from here, even though the yield curve will continue to steepen. But I think the main message here is that the pace of gains are likely to slow. We've already marked the 1-year anniversary of this bull market. I think the second year will probably be positive, but probably not as positive as the first year.
Yeah, which means people are going to have to get smarter in chasing those returns. And through Q1, I mean, we've seen financials and energy stand out, much more of the cyclical trade here, as we were talking about. I mean, do you expect that to continue? What's your advice to clients if it's going to be a little bit of a less exciting, maybe expectation out there for the market writ large? How are you kind of framing the way clients should be looking to invest now?
Sure. I think you make a couple of good points there. Energy and financials are two sectors that are positively correlated with rising yields. So, we've seen a sharp run up in both. So maybe investors maybe missed a little bit of that. But I think if you consider the yield curve continuing to steepen, then that's going to benefit financials. And I think energy prices have, taken a hit over the last week or two. But I think there's still opportunities there. Maybe you see crude oil in the range of 70. So I think those are both viable options, things that will probably continue to do well if rates continue to rise. Again, the pace of the rate rise may slow from here, may start to stabilize, but over time, as the economy recovers, we expect it to continue. So I think both those sectors make sense. The other thing is I would also look outside of the US. I know we tend to be home biased and we only focus on the stocks we know. But if you think of like UK equities, they're a prime example of a value play because they trade at about 14 times earnings. They're about a 40% discount to US shares. And the indices, particularly the FTSE 100, is chock full of energy and financial companies and does not have a lot of exposure to technology. So if you think that this rotation into value has some room to run, which we do, maybe not, we've caught up a lot, but we still think it has some room to run, then that makes sense to maybe look elsewhere.
Yeah, tough to not be homebodies after we were trained for so long in this pandemic just to love our own homes. But Sean Snyder, I appreciate you coming on here to chat with us, Citi U.S. Wealth Management Head of Investment Strategy. Thanks again. I want to shift over to one of the stories we've been watching today in Intel shares opening 5% higher after we got the update from their new CEO, Pat Gelsinger, talking about investment plans, $20 billion going into their chip-making abilities. Giving the update, the company is going to be working with 2 new chip factories at existing facilities in Arizona, relying more heavily on third-party chip-making partners, and once again exploring the opportunity to make chips for customers like Apple and Qualcomm. That pop, though, today, basically given all the way back to trade now flat, as analysts maybe dig into how true some of those things might be. And for more on that, I want to bring on Vijay Rakesh, Mizuho analyst here who covers Intel, to break it all down for us. Vijay, good to be talking with you again here. Talk to me about maybe how much should be teased out of what we're hearing from Pat Gelsinger in this update and the confidence he's exuding. I mean, we've talked about Intel's struggles. How big of a change and how much do you believe what he's telling investors now?
Yeah, I think it's definitely a big pivot for Intel. I think this gives them a huge market opportunity. It's $100 billion foundry opportunity out there. If they can be a strong third player in that market, it's almost 25 billion incremental to the top line if you look out. And it's borne out with the fact the U.S. government, the federal government, the Department of Defense all want a domestic manufacturing partner, and also the customers, right? I mean, they lined up Ericsson, Amazon, Microsoft, Qualcomm, IBM, all wanting domestic manufacturing source. So I think the roadmap is pretty clear. It's a pretty smart move, very incremental, almost 25 billion to a 70 billion top line that they have currently. So, I think this makes a lot of sense. It's a smart move here.
Vijay, we've seen a huge swing in the stock, as Zach alluded to, up about 5%. Now we've seen it give back a lot of its gains. How much of that do you think is about investors really realizing that the high price tag that's going to come with what is really a long-term project here?
Yeah, I think talking to the price tag specifically, I think there'll be plenty of tax incentives. There'll be the DoD and the government federal funding as well, and so and you have customers lining up already. In terms of how the stock is performing, obviously it's had a huge run, right? It's up 30-35% for the year, has outperformed the stocks, the S&P, and even the energy side, I would think. But again, you're seeing a little bit of softness in the tech patch overall today. But again, this is very undrawn on the street. I think it's a pretty strong move here from Intel in terms of a long-term roadmap. I think there's much more upside on this name as you look out. So.
Specifically on the foundry business, you said customers are already lining up. What are potential partnerships you see, and how significant is that market potential right now for Intel?
Yeah, I think they announced on the call that they were getting pretty positive interest from on the major customers on data center side, so Amazon, Microsoft, Qualcomm, Ericsson, IBM. And so those are the who's who of who in the data center and enterprise side. So I think that sets up pretty strongly for them, because if you look at foundry today, 60% of all foundry manufacturers in Asia. So it makes sense that from a national security standpoint, from the Department of Defense standpoint, that they want domestic manufacturing source. And this has been something that's been in the works for the last 12, 18 months now. So you start to see that roadmap accelerating here. So.
Yeah, I wondered how much of that 20 billion might signal kind of wanting to gain whatever political favor there might be there. I mean, we know that this chip shortage is going to take some time to square away here. I mean, how much does that maybe boost Intel's positioning here? As we know, President Biden has announced his own kind of efforts to solve this. Where do you really put Intel in that chip shortage as a big player that can play its part here back in the U.S.?
Yeah, I think there are a couple of parts to that story, right? If you look at the chip shortage, a lot of it is in the automotive side. But in general, what you are looking at is, you have leading edge technology capacity shortage at TSM. And also a lot of these OEMs have to go abroad to get their foundry lined up. So I think that is part of where a second source, a strategic second source in the US comes in. But also it's a good timing, a smart move, because obviously the US has been looking to insource production. They don't want to be captive to supply chains or hostage to supply chains in China. Have an Asian ODM can develop IP more, protect their IP better in the US, can develop much advanced IP here. So all that plays very well. And who better not than to go to Intel, who has been the leader on the manufacturing side in the US for a while now. So, and I think if you look at the Department of Defense, they have been the incubator of some of the most advanced technologies in the world, right? And it's everything from Intel to Pentium. So I think, very strong partnership from the federal government to the Department of Defense, very strong customer response. And I think it suits them, not just on the foundry side, but they can obviously cross-pollinate a lot of the technology to the core CPU, data center, PC side as well. So.
And Vijay, we should point out Intel, it had dipped into the red. It's sort of toggling. They're trading pretty flat right now. 63.51 is where it's trading at right now. You've got a price target of $72 a share, so much more upside as you see it. Walk me through your thesis.
Yeah, I think this stock here, obviously, like we said, at least if they get even a third number 3 strong market share at 20-25%, you're talking 20 billion plus of incremental revenues over the next 4 to 5 years. Plus, this is trading about 14 times forward versus the peers like NVIDIA or AMD trading at 40 times forward. And if you look at the foundry OEMs like TSM or UMC, they're trading at 19, 20 times, even 27 times forward. So definitely you're getting something at a 50 to 60% discount to the peers. Pretty new roadmap here. I think new management, they're bringing in some of the old technology guys back from Glenn Hinton to Sunil Shenoy. So I think it all pushes them well on this upturn. So.
Vijay Rakesh, Mizuho analyst. Good to talk to you today. Appreciate you stopping by. Let's turn our attention to another tech stock that is on the move in the session, and that is Amazon, just up about 0.5% there. Former Amazon executive Adam Selipsky now being named the new head of AWS. We should know Selipsky is the current CEO of data visualization software maker Tableau, but he is returning to familiar territory. He was the vice president for sales and marketing of AWS until 2016. He, of course, will be taking over what is the biggest moneymaker for the tech giant, AWS accounting for about 45% of the cloud services market overall. And of course, as we've been covering, former head of AWS, Andy Jassy, named stepping down, or actually stepping in, I should say, to the new CEO role for Amazon if Jeff Bezos takes a step back in the third quarter. Coming up, alternative investments is what we're talking about, a boom in the sports trading card business. The CEO of Panini America will be joining us on the other side of the break. Sports trading cards are experiencing a bit of a renaissance. In fact, returns on sports card investments are now outpacing the S&P 500. The boom hit a new peak recently when a 1952 Mickey Mantle card sold for $5.2 million, setting a new record. Let's bring in the CEO of Panini America, Mark Warsop. Mark, we have seen an incredible surge. It seems like every week we're hearing about a new record, but what do you think is fueling the surge?
I think there's many things fueling the surge. I mean, the trading card category in itself has been growing over the last 4 or 5 years. But the main thing that's fueling the surge right now is that simply that the demand far outweighs supply. And we have, a lot of equity in the brands that we're producing. And, you can't overproduce those brands, and the demand is just far, far outweighing supply.
We're showing what you guys work with here, the world's largest licensed sports and entertainment collectibles company, official trading card of the NFL and NBA. And the NBA, interesting because we've been talking a lot about NBA Top Shot, kind of the digital trading card company on the blockchain. And when you think about demand and supply, I wonder how much of it is just because there's a limited pool. At least some might think there's a limited pool of collectible investors out there. I mean, how much of NFTs are maybe a threat to your business versus a boom? Talk to me about how you look at that space as it continues to explode.
Well, I mean, we've been following, obviously, NFTs quite carefully. We launched our own NFT platform in January of last year. To date, we've been selling individual digital trading cards across multiple sports on our own sort of private blockchain platform. And then towards the back end of May and moving forward, we'll start selling pack product in the form of NFTs, very much similar to the way that we retail our physical products. So, obviously we're seeing it as a changing space. We've been doing digital trading cards for 2 decades. The new essence, if you like, is the fact of blockchain and that verified ownership through NFT.
Does it maybe surprise you then how quickly it's exploded in that space? If you guys have been doing it for so long and now all of a sudden you add blockchain to the mix and apparently it's gasoline on a fire, I guess. I mean, what's your reaction to that?
Yeah, I think obviously the current sort of timing of NFTs has worked out very well on the basis that the trading card industry in itself and collectibles are in sort of an all-time high and in boom. So I mean, it's almost like NFTs have entered the market at the perfect time. How long that will last, I don't know. But I mean, obviously, one of the key components of the NFT and blockchain versus digital products in the past is that you can now verify ownership through the smart contract on the blockchain. So, you can know for sure that you are the owner of that asset and quantify exactly how many of that asset there are based on the smart contract on the NFT.
Mark, you alluded to the supply-demand dynamics that are in the market that have pushed the prices of these cards even higher. There's a lot of theories out there about how much of this is pandemic related, how much of it is about the stimulus checks, how much of it is about new Bitcoin millionaires. I mean, what are you seeing in terms of the new investors that are coming online bidding for these cards? Is there anything that you can tie that theory to?
I think it helped, but the market was already in a boom prior to the pandemic. I think what the pandemic possibly did is gave people a lot more time at home, and they were looking for ways to perhaps make some additional income. But even prior to the pandemic, the boom had already started. The NBA rookie class, fueled by Zion Williamson, had really set things on fire. And in the physical sense of trading cards, there's only a certain amount of assets available to build the product. And by assets, I mean player autographs, player-worn game equipment that we embed into these cards. So there is a finite volume of the cards that you can actually build, even more so by the fact that we stick very strictly to a numbering system on the card. So obviously, if you say you're only going to make 10 of a card, you can only ever make 10. So if you only have 50 people that want that 10 card, and then all of a sudden there's 1,000 people that want that 10 card, obviously the price for that card is going to go up purely based on demand. So I would say the pandemic helped, but this was already, on its way to becoming a boom.
Yeah, Mark, just to go full circle here, I mean, Akiko pointed out how much this boom has kind of lasted here and where we're at relative to stocks, other assets out there. When you look at the interest, though, in the space, is it all NBA, NFL, stars right now that are catching interest? Because it seems like it's across the board. What are the big ones you're watching right now?
Yeah, I mean, the two really large ones are football and basketball. Baseball is also doing very well. And the other sport that we've seen a massive insurgence on in the US and particularly Asia is soccer. And we have quite a large portfolio of soccer rights. For example, on our NFT platform right now, we have La Liga digital cards on there. So it's a global phenomenon right now. And I think that is also what's fueling some of this demand, because the world is now taking interest in trading cards and their US style product trading cards. Again, it's just fueled this sort of global demand versus the amount of supply.
Very interesting times. Mark Warsaw, Panini America CEO, appreciate you coming on here to chat with us today. Be well. We're going to take a quick break here on Yahoo Finance Live, but when we return, a discussion with the founder of the world's largest hedge fund, Bridgewater founder Ray Dalio, sits down with our editor-in-chief, Andy Serwer, his warning about bonds and where he sees inflation going in the quarters ahead. Stay with us. Welcome back to Yahoo Finance Live. In this week's episode of Influencers, Yahoo Finance's editor-in-chief, Andy Serwer, sat down with the founder of the world's largest hedge fund and Bridgewater Associates founder, Ray Dalio, to get his take on everything from the future of Bitcoin to his reaction to the recent $1.9 trillion relief package in D.C. Take a listen.
If the pulse of the economy goes down, then the policymakers, like doctors, rush to the patient and inject it with a whole lot of stimulation. And so what they did is they wrote out a bunch of checks, and they're writing out a lot of checks, which are about 7 times, 5 to 7 times the size of the hole. And they got that money out. And what that did was, of course, the government doesn't have money. They can't print money. So they have to borrow that money. But the Federal Reserve can print money. And so the same thing that is happening like on March 5th, 1933, is the same thing now in terms of that big stimulation. So the way it works is real interest rates are so bad, money's so cheap, and it's so abundant that it changes a lot of financial assets, and it causes those financial asset prices to rise. And when they rise, future expected returns go down to start to approach those of bonds and the risk-free return. And so that's what we've gone through. So you see it domestically, you see it also in the currency, in the dollar, you see it in other assets, gold, Bitcoin, and so on. So the world has got a lot of liquidity. And now we're in a spot where we're going to have the supply-demand question. The big question is the supply-demand question, because we're going to have to sell a lot of debt. And I don't know if you want me to go into that, but we're going to have to sell a lot of debt. And then the question is how that goes. Will the demand be there, or will the Fed have to monetize more? That's the dynamic.
Yeah, I do want to get into that debt question, but first of all, I want to go back to stimulus, which maybe is before that. And am I to understand then that you think there's too much stimulus coming from Washington at this point, Ray?
It depends, like you say, too much for what? Too much for the supply demand? Mm-hmm. Yes, probably. Okay, we'll get into that. Too much because like fast, a lot of people needed to get a lot of money. Okay, if you look at the needs and a lot of things like, okay, err on the side of too much. There was, we have a big wealth gap. We have a big opportunity gap. We have big gaps that are issues. We see it here. I work, my wife, particularly in the state of Connecticut, works with disengaged and disconnected students, high school students in poor neighborhoods and so on. And you see their conditions and what the budgets are. There are a lot of needs. So I'm not saying the needs are not there. I'm saying just the way the machine works, the reality of it is, you're making this big supply demand move, but that it's not like it doesn't have risks and costs associated with it. So from the market's point of view, it's a real big deal.
Yeah. So does that mean you sort of flood the zone to mitigate and obviate these sort of social problems, and sort of by definition you're going to overshoot, and then we have to deal with those consequences?
Yeah, because like debt, at the end of the day, it's going to be one way or another. It's either going to be when somebody borrows and you're using that debt, is that going to produce productivity so that in hard money terms that money can be paid back in a way where, okay, it paid off in a productivity increasing way? Or is that not going to be paid off? And somebody's always going to pay, but it's going to be the bondholder, it's going to be the cash holder who is going to pay if that doesn't come back with real productivity. And right now, it was an emergency situation with COVID mixed with a political situation to disperse a lot of money. And that's what we have. But it's not ending there, because that's the new policy.
So can I infer then that you're suggesting we're going to have an inflationary period ahead because of this, what you're just outlined?
There are two types of inflation. Okay. Let me just clarify. There's supply demand inflation, like if demand is pressing up against capacity to produce things, and maybe that's labor, maybe that's capacity constraints and so on and so forth, prices rise because of that. And then there's monetary inflation. And monetary inflation is because the currency and the value of money goes down. And so you can see, like in the 1970s, stagflation. You could see inflation is not coming from the first of those types of inflation. It is coming from the second of those types of inflation. And the way that would occur is because people don't want to own bonds. To me, it's pretty crazy to want to own cash or bonds. Okay, we can get into why that is. But if you have that movement out of like that type of financial assets to other assets, which we are seeing, then that has the effect first of causing financial inflation. In other words, an investor shifts it to another investment and they go up in value. And then that wealth effect has an effect on those items that those people who acquire the money want to spend on. So maybe it's on penthouses or maybe it's on something else, but it depends how that's spent. I'm more worried about the monetary inflation, which would look something like a currency defense. It means that what happens is, as money, let's say people don't like bonds, and then they start to sell bonds, and bonds then go down in value because they have a capital loss, and they don't offer anything in interest rates, negative real interest rates, and so on. They don't like that. Then the Federal Reserve or other central banks are faced with the choice of either rates rise, and that is bad for financial asset prices and it's bad for the economy, or they make the purchases. They make money and they make the purchases of that. And that then produces more of a monetary inflation. So it's the second that I'm more concerned with. But the supply demand of debt will be, I think, the big driving influence.
And you can catch the full conversation with Ray Dalio on influencers tonight. That's on Yahoo Finance at 4:30 p.m. Eastern. Coming up, some relief in Egypt's Suez Canal as a stranded ship blocks the key shipping route. Plus, a big reversal over in Germany. Why the government is now taking back those COVID-19 lockdowns it just announced yesterday. That's coming up in our Worldview after the break. In our worldview today, traffic along Egypt's Suez Canal is expected to resume soon after a stranded vessel blocked the key shipping route for more than a day. Reuters reports the giant container ship has now partially been refloated and moved to the side of the canal bank. That ship ran aground on Tuesday with high winds and a dust storm limiting visibility. That led to more than 100 ships getting stranded on each side of the canal. We saw oil prices climbing on supply concerns. The Suez is a key artery for ships traveling between Asia and Europe, with roughly 12% of world trade volume passing through the canal. Israeli voters could be headed to the polls for the fifth time in 2 years. Prime Minister Benjamin Netanyahu's Conservative Alliance failed to secure a parliamentary majority in the country's election Tuesday, extending the political gridlock in the country. Neither side gained the 61 seats needed to form a majority coalition government. Netanyahu has touted the country's success in tackling COVID-19, but he's been marred by long-standing corruption allegations. Official final results are expected on Friday. And Germany's reversing its latest COVID-19 lockdown just one day after announcing it would impose restrictions during the Easter holiday. Speaking at a press conference, Chancellor Angela Merkel said the lockdown measures were announced with the best of intentions to slow the third wave of the virus, but she now realizes it was a mistake. Merkel faced heavy backlash for restrictions that would have shut down most businesses over a 5-day period. It comes as public frustration grows over the slow rollout of the coronavirus vaccine in the country, and support from Merkel's conservative coalition falls to its lowest in more than a year.
All right, well, let's check back in on today's market action as we're seeing a big pop in the Dow, up by about 300 points, being led by transports. And for more on those moves, I want to bring on Yahoo Finance's chart master, Jared Blickery, who has the latest. Jared?
That's right. We got the industrials and the transports popping. So let's take a look at the transports, where we're really seeing some strength in some of the airlines and also railroads. So you take a look at the upper right here. We got Delta Airlines up about 3%, United's up 3% as well, and Union Pacific, that's up 3% as well. Don't talk about the transports maybe enough, but of course, this is the stuff that we use to ship everything that we're buying and ourselves at times. Guess what else is kicking today? We got some bank stocks. JP Morgan, Goldman Sachs closing in on record highs. Once again, JP Morgan up about 1.5%. Wells Fargo and Morgan Stanley each up more than 1% as well. And then we got to take a look at the energy sector. Kiko just talking about crude oil. That's bouncing back, and we're seeing some nice gains in this space today. ExxonMobil, Chevron, BP, ConocoPhillips, each up about 3%. We did see some big losses in BP and Royal Dutch Shell yesterday, but clawing those back. Just taking a look at the sector action, we got energy up the biggest today. That's up 3%, followed by industrials, materials, and financials. So we're seeing that value and cyclical play once again reassert itself here. No coincidence that we have the 10-year T-note yield slightly higher and the yield curve expanding. Well, we got to take a look at the NASDAQ 100. We can see a mixed picture for the mega caps, more red than green. Apple's down 0.5%. Facebook down 1%. Amazon up slightly, and Alphabet up 91 basis points. Some of the biggest losers here, and we've been seeing this again over the last month, are some of these Chinese names, Pinduoduo, Baidu. Those are each down 6%. Zoom having a nice day yesterday, giving it back today. That's down 4%. And then the worst off, Peloton, that's down nearly 7%. You can see that stock is down 30% year to date, Zach.
All right, Jared Blickery bringing us the latest there. Appreciate that. Coming up, we're going to be digging into one company that has also seen a big boost here as we emerge from the pandemic. That would be Jack in the Box, putting up the numbers, the best numbers that company's seen in nearly 3 decades. In its latest quarter, we'll be chatting with the CEO of Jack in the Box right after this. Stay with us. Welcome back to Yahoo Finance Live. One space that caught a serious boost in this pandemic was the fast food space. Want to spotlight shares of Jack in the Box, up about 12% since the company reported earnings last month, when the fast food chain put up some of its best numbers in nearly 3 decades. System-wide same-store sales increased 12.5% for the quarter, compared with less than 2% growth in the year-ago quarter, boosted by a big jump in digital orders as well. And for more on that, happy to be joined by the CEO of Jack in the Box. Darren Harris joins us now. Darren, appreciate you being here. I mean, obviously, the first question is that growth, not just for you guys, but fast food really seeing a pop. Inevitably, maybe if that goes away as restaurants come back on board. So what are you seeing since you put those numbers up, and how should investors be thinking about that when it comes to Jack in the Box?
Yeah, I think for us, we'll continue to do a lot of the same things that we've been doing, which is we made changes early in the pandemic to focus on the safety of our guests and our employees, and we'll continue to do that. But it enabled us to really focus on off-premise, whether that's mobile and digital or even drive-through. And by focusing on that and listening to our guests, we learned that they wanted a better experience from those off-premise opportunities. But they also wanted from us more premium items. So we were able to continue our product innovation and give guests what they wanted, which, as you stated, led to the best quarter we've had in 27 years.
Huge growth in digital sales, as you highlighted, doubled in the first quarter. You're still looking at roughly 7% of overall sales, if I have the numbers down correctly here. How do you increase the usage of the app? What kind of features are you thinking about?
Yeah, I think for us, we're at the early stage, especially when more people in the industry are adopting, or more consumers are adopting the digital experience. So for us, our next level is to continue to put the delivery service providers in our app and let them have accessibility through our application, but also launch a loyalty program. That's the biggest next step for us, as well as capturing data on our guests so that we can serve up, a better marketing experience, a one-to-one loyalty marketing experience, and that's what we're hearing from our guests that they want more of from Jack in the Box.
Yeah, I guess that would be another question here. How much kind of a retained experience you're expecting? I mean, if people came to you first time in a pandemic, really leaned into fast food, I imagine that would be a stickier experience if you have them in apps. So talk to me about that relative to maybe some growth spurts you may have seen pre-pandemic.
Yeah, a lot of the work that we did was focusing on listening to our guests during this pandemic and really doing a lot of research around guest segmentation and understanding what they wanted from us. And so as we continue to gather that data and understand it, it enables us to offer up a better experience and a better ongoing app, whether it's digital, whether it's delivery. That's our focus, is giving the guests what they want from Jack in the Box. And so mobile is just one environment for us to do that. We'll continue to focus on it and build that data so we can continue to offer to guests what they want from Jack in the Box.
One of the key initiatives you put your efforts behind since you've come on board in this role, relaunching the franchise redevelopment initiative. You've talked about a lot of interest already from franchisees, but ultimately, when you look at where the demand is right now, what kind of expansion are you thinking about new stores coming online through franchises?
Yeah, this year we're planning to open 20 to 25 restaurants, and our restaurant averages for Jack in the Box locations over the last 3 years have been greater than our system average. So that gives us a strong economic model to build around. But beyond that, by relaunching our franchise strategy, we went on a hiatus for about the last 10 years as we refranchised units and sold them to existing franchisees or great operators. The switch in this strategy is really attracting new and existing franchisees to expand, not only in our 21 markets that we're in today. Just in those markets alone, we have the ability to add 1,200 locations, but also in new markets in the West, the Midwest, and the Southeast, by attracting operators or people that are looking for a great business opportunity.
Darren, we've also been watching inflation in this environment here. You guys actually saw your margins increase. You said food and packaging costs as a percentage decreased 150 basis points in the quarter because of some of the changes you made to your menu. Talk to me about what you're seeing on the inflation front, if costs maybe start to rise, or if they already have. What are you seeing there?
Yeah, I mean, we're focused on, like I mentioned earlier, is taking care of our guests. And during the pandemic, by offering our guests things like snackable add-ons or craveable products like tiny tacos, we saw the typical check move from 3.7 items to 4.2. So just that alone helps improve margins by, more products per order. And so if that's what our guests want, we want to continue to offer them the type of products that'll drive that checkup or, a better experience. And that lets us focus on the right things versus just how do we improve margins. Many people in the industry are talking about minimum wage. The way we think about it is, let's focus on, really serving our people and our franchisees well. And by doing that, we'll have engaged employees and we'll make sure they're taken care of. So in turn, they can really focus on the guest experience.
You got us thinking about tiny tacos now, Darren. Perfect for lunchtime as we both get hungry. Darren Harris, the CEO of Jack in the Box. It's good to talk to you today. Appreciate your time. Coming up, we are taking a closer look at shares of GameStop, down nearly 20% on the back of the company reporting its latest quarterly earnings. Inez Ferre is going to walk us through the numbers after the break. Welcome back to Yahoo Finance Live. We are seeing a mixed picture across the three major indices in the market right now. The NASDAQ, the one laggard, down about 0.4%, and the Dow seeing the biggest gains in the session so far, up about 283 points. Let's bring in Inez Ferre, who is taking a closer look at some of the big movers today. And GameStop, a big one, all for the wrong reasons here. We're seeing a big sell-off in the session.
Yeah, that's right. GameStop down about 20%. You can see that on our Wi-Fi interactive board. The company reported its quarterly results yesterday, a miss on the top and the bottom line, though e-commerce sales improved year over year. But the company didn't really give many details on its expected transformation, this transformation into digital and tech. It did announce a new COO, Jenna Owens. She's a tech veteran formerly from Amazon and Google. But the company not not providing much guidance. Also, the conference call was 22 minutes long. It was at full capacity on the web. You could still get on it through the phone, but no mention of the GameStop frenzy during the conference call. No real details about that transformation plan, and no Q&A session afterwards. That was very disappointing and frustrating for analysts. In their 10K SEC filing, the company said it is considering whether to sell stock to help transformation initiatives in the future. But again, analysts frustrated at the lack of details on its transformation plans going forward. B of A reiterating their underperform rating, a price target of $10 on the stock, much less, of course, than what we're seeing it trading at right now of $146 a share. Akiko, Zach?
Yeah, analysts frustrated, investors probably frustrated with that 20% drop. Fitting, though, that we're seeing that play out as we also got news of a Robinhood IPO and the latest filing there, and seeing as it was the platform that a lot of people use to trade GameStop shares. But what do we know about the plans there for Robinhood to access the public market?
Right. And the timing of the headline that came out just minutes before GameStop reported its quarterly results was very interesting yesterday. The company saying that it filed confidentially to go public. That means that they filed their necessary paperwork. Their S1 statement will not be public until the SEC reviews it and approves it. And also, the company has reportedly selected the NASDAQ to go public. There's been, of course, so much scrutiny on Robinhood over the last several months because of that short squeeze on GameStop in January, because the company had restricted buying on GameStop and some other stocks. But even though it did receive backlash at the time, there was a note from JMP Securities basically saying that in one day, some 600,000 users signed on in a single day. So certainly there's a lot of popularity for Robinhood, and also trading apps in general. You've got Coinbase, which reportedly has moved their IPO to April, that it will be going public. You also have eToro that will be going public via a SPAC. So a lot of these trading apps, the moment is for these trading apps to be going public now. Zach, Akiko?
You can bet there's going to be a lot of eyes on that S1 whenever it does become public for Robinhood. Thanks so much for that, Inez. We've got much more coming up in our next hour of Yahoo Finance Live, including a conversation with Intel CEO Pat Gelsinger. The company, of course, making that big announcement yesterday about a $20 billion investment in new plants. So we'll have that conversation on the other side of the break. Much more ahead. Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Zach Guzman. It is noon Eastern here in New York City, and we are seeing a bit of a split picture in the markets. The NASDAQ continuing to see some pressure right now, down about 54 points. The Dow seeing the biggest gains, up 200 or more than 270 points. The reopening trade back in favor with travel stocks recovering some of their losses in the session. And oil seeing a big bounce back here. WTI and Brent crude both up more than 4%. We are seeing bond yields holding steady with Fed Chair Jerome Powell and Treasury Secretary Janet Yellen testifying before Congress for a second straight day. And Bitcoin seeing a pop as Tesla officially begins accepting the cryptocurrency as payment. We are speaking to one company raising capital in the midst of the Bitcoin frenzy. The CEO of blockchain.com joining us a little later in the show. We begin this hour, though, with some new economic data out this morning. New orders for durable goods fell for the first time in roughly a year, down just over 1% to $254 billion as manufacturers face supply chain challenges. Let's bring in our first guest for the hour. We got Michael Sheldon, RDM Financial Group at Hightower, CIO. Michael, it's good to talk to you today. When we're talking about durable goods orders, it is still up more than 3% over the last 12 months or so. I'm just curious how you look at this most recent dip and how big of a concern it is for you.
Sure. Well, it's good to be with you. Thank you. Today's durable goods number, we're a little bit on the soft side. That's absolutely true. The manufacturing side of the economy has really been the strong spot of the recovery so far. If you look at, for example, the Philadelphia Fed manufacturing report, which is one of the regional reports that came out last week, that was the strongest since 1973. And if you look at the national index, for example, some of the subcomponents like new orders, those have been rising quite nicely. So today's report on durable goods was certainly a setback, but it could have been due to supply chains or maybe the weather. And I think it was probably somewhat temporary.
Yeah, and it's tricky to kind of, suss out this data and look at the consumer strength as well. But when you kind of back up and put us, in the context of this being March, a lot of months to go, with a lot of stimulus coming through here in this recovery, where do you put us in terms of the health of it now moving forward as we're seeing more and more, local economies open up and businesses start to look to the future?
Sure. Well, I think it's important for viewers to step back and say that yesterday was the one-year anniversary of the market bottom. And back in March of 2020, things looked pretty bleak. If you looked at the outlook for the economy and the markets, there was a lot of uncertainty. And you fast forward to today, we've seen a dramatic change. We had vaccines that were developed in record time. The Federal Reserve took very quick action, decisive action, and we've had a lot of stimulus. So if you put all three of those together, that's helped sort of set the groundwork or the blueprint backdrop for a more positive economic environment going forward. Now, we've already had a pretty large advance in the equity markets over the past year, but I think as you look ahead, we're still constructive. We looked at some of the data going back to World War II, and in the second year of a bull market, equity markets typically advance about 11%, and they've been positive about 86% of the time. So I think there's still more positive news ahead for the markets, but it may be, the returns may be a little more moderate than we've seen over the past few quarters.
Yeah, we had a guest on earlier who said he expects about an 8 to 10% upside going into the rest of the year. When you look at equities overall, how much more upside do you see?
Well, we try not to put a target on the S&P 500. It's very difficult to say where the markets will be on a certain day. So we try and look at the economic fundamentals. And if you look at employment, for example, we're currently at about 6.2% on the unemployment rate, and that could fall maybe below 5% in the next year or two. Corporate profits are currently forecast to rise about 25% this year, and currently forecast to rise another 15% next year. I think one of the missing ingredients so far has been the consumer, and the consumer may be held back because of jobs. So the weekly jobless claims at about 770,000 are still pretty elevated, but I think as we go through the next few quarters, consumer confidence should start to rise, and consumer, by the way, is currently over 20% versus an historical average of about 6.5% going back to 1990. So there's a lot of, it seems like there's some pent-up firepower for consumers, but they just have to feel more confident, and that we think will start to happen in the next several months.
Yeah, Michael, I mean, when you step back and look globally, obviously this is a pandemic. The U.S. not the only country dealing with this here. We've been talking a lot about opportunities across the pond for investors as well, but it seems like the vaccine rollout and the situation there is a little bit more shaky. When you look across the pond for opportunities, is that being reflected properly in terms of valuations right now, the risk reward in your mind, or should investors mostly stay here in the U.S.?
Well, that's a great question. And we as a firm have largely been overweight the U.S. for the past decade or so. And I think many other U.S. investors have probably taken the same approach. In our opinion, it seems like the tide is maybe starting to turn. And it's a little early to feel totally confident about that. But valuation levels are more attractive overseas. Dividend yields are more attractive. And Europe actually is finally getting its act together. They passed a European stimulus package in 2020, which surprised a lot of people. So they have more upside to catch up with us. They have been slower in sort of rolling out the vaccine. But I do think for the first time in several years, investors should start to maybe look at adding a little bit of foreign exposure if that's something they've been light on.
Yeah, it seems like a common theme among a lot of our guests. Michael, it's good to talk to you today. Michael Sheldon is RDM Financial Group at Hightower CIO. Let's turn our attention back to the oil markets now. We are seeing a rebound in this session, both WTI crude and Brent up more than 4%, almost 5% right now. But new data out from the EIA fueling oversupply concerns yet again. Inventories rose last week by 1.9 million barrels. Meantime, traffic appears to be close to resuming in the Suez Canal, providing some relief to delivery concerns. Let's bring in Stephen Schork. He is the editor of this Schork report. Stephen, what does the demand picture look like for you? It seems like on the one hand, there's a lot of optimism in the markets on the expectation of economies around the world reopening, and yet it seems to be this push and pull, concerns about oversupply, sort of capping the gains we're seeing in the session today yet again.
Well, we have to keep in mind that from a demand perspective, things look rather impressive given how far we've come in a relatively short amount of time. Last week, we had the latest batch of numbers out, and we see that wholesale inventories of petroleum products, that ratio relative to retail sales is back within historical norms, of course, after falling off a cliff last summer. So the market has done an excellent job of rebalancing. That rebalancing has come as producers, both OPEC, Russia, and here in North America have done a good job of curtailing their output. So with regard to supply, the market is more in balance. Yes, we are in the midst of a strong rally today, but that's only comes on the heels of a massive sell-off, a $4 barrel sell-off yesterday. So the market's in the process of balancing itself out. Keep in mind that we've rallied from about $30 a barrel before the winter to upwards of, we knocked on the doorstep a couple of weeks ago, of $70 a barrel. So we've had a terrific run over this one season. We're now at a level 57, 58, the high 50s, low 60s, which is more or less where the market was trading in 2019, i.e. the year when the economy was strong, no one heard of COVID. So we've rallied right back up to that level. We might be a little overheated, might be time for a pullback. We are at a time of the year, refinery maintenance season. When refineries do go offline, they retool, they refuel, so forth to get ready for the summer. So the refineries, the only people that actually really buy crude oil in the market to use are not buying as many barrels as they normally will come a month and a half from now. So from a demand perspective, we're at the nadir of the season. But as the weather warms, we move towards Memorial Day, the holidays, so forth, demand will pick up, and this certainly should add more support to the market going into the summer.
Yeah, and Stephen, I mean, I remember talking to you earlier on in the year. Obviously, this was before kind of that surprise sustained cut from Saudi Arabia. We were talking about $55 maybe being the top price range here. Obviously, it's been a while, but you got Goldman calling for $80 a barrel later on in the year. I mean, where do you see the long run, I guess, price target maybe investors should be looking for in the back half of this year when all these kind of supply demand issues square away into where you see us settling in?
Yeah, fine, Zach. Yes, and as the old saying goes, yesterday's resistance becomes today's support. So we are looking at a level. We're now hovering right around that level where we traded for the better part of 2019. The Dallas Federal Reserve Bank just came out today with their survey of the oil patch. That is the 11th bank district, incorporates Louisiana, Texas, and New Mexico, i.e. the oil patch. They're looking at break-even oil prices that will keep their wells operating at $38 a barrel. And even on the high end, what these E&Ps need to see to make money in the new year, the highest case we're looking at is $58 a barrel. So I have no problem now seeing that as support in the market. So that is to say, the current pullback we're seeing over the past couple of weeks, should it continue, we're going to run into support, I do believe, in that high $50, mid $50 range. Going forward, as demand picks up, and look, I do think that there is a tremendous amount of latent demand in the market. Now, the macroeconomic headlines that are going to come out, the Chicago Fed National Activity Index, and the latest rash of numbers are going to disappoint because they're going to incorporate the February numbers. And as we know, the economy ground to a halt, especially through the mid-continent. So those are going to be one-offs. But certainly, I do think there is a tremendous amount of demand. If we just look at the supply chains, the automobile manufacturers holding back production because of a chip shortage. Well, if they're holding back production today, that's just more production that's going to hit the line once these supply chain snafus work out. So there's a lot of demand in the market. So yes, I think another run back towards 70, this is WTI, back towards 70, and in that low $70, mid $70 range is a absolute reasonable target as demand picks up this summer. And that would translate low to mid 70s. WTI would translate to high 70s, potentially $80 for Brent oil on the global market.
Is that with the summer surge baked in? I mean, you mentioned that we're likely to see a big surge in activity more in the summer, especially when you consider, for example, in the U.S., the vaccination supply will already be there. Europe going through some hiccups, but potentially able to accelerate their vaccination rollout as well. How much of all of that surge in activity down the line has already been baked in?
I think a significant amount has baked in, and hence why we are getting that pullback at the weakest time of the year. But I think we're just reloading the gun at this point. To your point, look, everyone's fed up. We're not going into the draconian lockdowns. I just don't think here in North America, Europe, Asia, so forth, people have had it. So we've already seen a nice rebound in gasoline demand. Now, to your point with being baked in, what the really positive to come out of COVID is the consistently strong demand for diesel fuel. Now, diesel fuel is your primary industrial fuel, and that never really took a significant hit. It obviously took a hit at this time last year when everything took a hit, but it was the first energy market to rebound, and it stayed strong, and we're at very high levels. So to me, when we look at industrial commodities, this is your best leading indicator. So whether we're talking about the movement of petroleum, the movement through air cargo, trucks, barges, so forth, the latest numbers that have come out are very positive. So there is that the psychology of the market, shall we say, has been baked in. Now we're just waiting for the fundamental confirmation for it to be baked in. So we've had the run up. We'll have the pullback now in the spring months when demand's at its weakest. But if we are correct, we don't go into another set of COVID lockdowns like last year, that demand certainly should be enough to propel us back above that 70, even with Brent in that towards that $80 range.
Well, Stephen, we always appreciate getting your insight in on the oil market. Stephen Short, the editor of the Short Report, is good to talk to you today. Let's turn our attention back to shares of Intel, now dipping into the red in the session after seeing a huge pop on the back of the company's announcement of that $20 billion investment plan. Yahoo Finance's Brian Sozzi just spoke with the CEO of Intel, we should say the new CEO, Pat Gelsinger. He has said Intel is back, that they are back on track here. What more did he have to say about the timeline and how significant the foundry business especially is likely to be?
Right, Akiko. Just finished talking with new Intel CEO Pat Gelsinger. His timeline, it's going to take some time to turn the giant ship that Intel is around. They're putting a lot of cash to make that happen, $20 billion to build out 2 new factories in Arizona to help increase their capacity. But there's a lot of other facets to the story on Intel. One is the freight relationship with Apple, which really deteriorated last year to the point where Apple and Intel are really no longer working together as Apple starts to make its own chips. So I asked Gelsinger, what's the status of that relationship moving forward? Take a listen.
You know, we've certainly said that to Apple. I've talked to Tim and Microsoft and Qualcomm and Jensen and so on. You know, we're very much interested in winning their business, building their confidence, building their trust, and really having them know that we have world-class technologies that they can take advantage of for their business as well.
So Kiko and Zach, this is going to be, it's not going to happen overnight where Intel wins back business from Apple. And frankly, it may never happen as Apple continues to improve its M1 chips that are now powering its Mac computers. But the conversation does appear to be more open under Gelsinger, a tech industry veteran, as compared to prior Intel CEO Bob Swan. But nonetheless, another situation to monitor going forward as Gelsinger tries to turn the company around.
All right, Yahoo Finance's Brian Sozzi bringing us the latest there in his discussion with CEO Pat Gelsinger. Appreciate you bringing us that, Soz. Thanks again. Also want to check out what's going on here before we go to break in the Bitcoin space as Elon Musk tweeted out sending his confidence through the market, saying that you can now buy a Tesla with Bitcoin. After he tweeted that, we saw about a 2% pop in the price of Bitcoin. He also said that purchases made will be retained in Bitcoin, not converted to fiat currency, which is something we've seen from prior companies accepting Bitcoin as a payment for transactions. Elon Musk also tweeted after that saying that it will be expanding that capability outside the US later this year, and that the company will operate Bitcoin nodes directly, which is interesting because that's something a step further than most companies out there too, just kind of showing how invested Elon Musk is in the Bitcoin space. Coming up, though, we're going to be discussing with a big company that's capitalizing on a lot of enthusiasm in the crypto space. That would be blockchain.com. The CEO and co-founder of that company will join us on the news that it's raising $300 million in its Series C. Stay with us. We'll chat with him right after this. Well, in this week's Crypto Corner, I want to point out the fact that Coinbase isn't the only crypto company cashing in on Bitcoin's big boom with their public debut planned for next month. London-based blockchain.com, not to be outdone, which counts 31 million verified customers across 200 countries, announced a significant $300 million Series C funding round to reach a $5.2 billion post-money valuation. The round comes just a month after the company raised $120 million in what's been an incredibly hot time for the crypto space, with Bitcoin holding above $50,000 a coin. And for more on it, happy to say we're joined here by the CEO and co-founder of blockchain.com, Peter Smith, with us today. Peter, thanks for coming on here, man. I mean, talk to me about the growth that you guys have seen to kind of justify the fact that you want to go out and raise $300 million. Sounds like a lot of money here. So where are you guys at in your growth stage, and what have you seen as institutional investors have poured in?
Yeah, well, thanks for having me today. I appreciate it. You know, I think we've seen the business, really double in size in the last 2 months alone. And that's across our retail business, but even more interestingly, across the institutional side of the business, where we're one of the top prime brokerages in the market today. And I think one of the reasons we wanted to go out and raise a lot of capital is to increase the trust that our institutional customers have in us as a business. I think as you're seeing increasingly large institutions come into the space, folks really want to see a deep and very secure balance sheet behind the company.
Peter, I think it's worth stressing how significant the capital raise is. The third largest capital raise in the crypto space. This coming just 1 month after you raised $120 million. So you have really been able to raise at a very rapid pace. And to Zach's point, I'm curious what has really shifted from a fundamental standpoint in this space. No question you are attracting a lot of investors, but it also feels like the long-term case for crypto has really shifted because of so many institutional investors getting in.
Sure. And we have raised a lot of equity in the last 2 months. In the last 12 months, between debt and equity, we've raised over $1.5 billion across the USD and debt markets. And so we've really been scaling our balance sheet at a really fast pace over the last year. I think that's really driven by the fact that experienced and sophisticated investors are seeing for the first time, not just consumers in the crypto market, but institutions as well. And when they see a business like ours that's profitable on both a consumer basis as well as an institutional basis and extremely profitable overall, they want to be part of that growth story.
Yeah, I mean, there's a lot of reasons as to why, but you guys specifically, talk to me about your revenue streams and where you're seeing kind of the most case for excitement here, because it's shocking to see how quickly some of these companies have been able to build out the financial institution side of this and lending and all the other key aspects. So which one has you most excited?
We run 3 businesses today that are at scale and a 4th one that's new. The 3 that are at scale are our consumer business, which is really a brokerage experience. That's our most profitable business and our largest business today. Our second business is our institutional business, which is really a prime brokerage that offers custody, execution, structured products, and credit. That business is our second most profitable business at the company, and probably the second most profitable institutional business in crypto today. And then our third business is our exchange, which is also on its own quite a profitable business. And then we also run an asset management business that I'm pretty excited about. I'm spending most of my time today inside of our institutional business, just because that business is scaling really rapidly. And I'm spending a lot of time with clients trying to figure out what they're going to need over the next 2 or 3 years to become long-term active participants in the crypto market.
You've got roughly 31 million verified users across 200 countries. Where are you seeing the biggest growth right now, or most significant growth outside of the US?
Yeah, so most of our business is actually outside the US today and always has been. We're really rest of world focused. And so we continue to see the growth outside of the US right now. Our fastest growing markets are, in the EU, parts of Latin America, and then, basically Eastern Europe, former sort of Soviet bloc. And we're seeing really rapid growth across those markets. I think, one of the most interesting things about crypto is that everyone gets to be a part of the same market, whether you're a giant institution or a retail customer, in Poland. And that's really interesting. And that's one of the core focuses of our business, is making sure that everyone has equal access to the market. We never sell your data. We never prefer one type of customer over another. We're very much about meritocratic access to the crypto market.
Yeah, when it comes to the regulation piece of this, obviously, if you're dealing with that many countries, I imagine it's going to be a little bit trickier than maybe one that focuses solely here in the U.S. But how big of a question mark is that now here in 2021? Because the space has matured quite a bit, but regulation always seems to be hanging overhead. So, I mean, what's your estimation of the main threat facing the crypto space and blockchain.com and what you guys are trying to build right now?
Yeah, so we've been in the space a long time, and part of our commitment inside the space is to work with regulators and policymakers to come up with, practical rules-based approaches that protect consumers and institutions as they become participants in the crypto market. And I'm, proud to say that we've worked with dozens of countries and regulators around the world, and we're going to continue to do that work. But it's going to be a long process. Recently, we had a new board member join, one of the most experienced people ever from Washington, D.C., Jim Messina. And he's going to be a huge part of that effort over the coming years.
All right, lastly, Peter, before we let you go, now you just raised $300 million, so probably not any rush to the public market here, but Coinbase lined up to do so. So when you look at it, if you want to tap when things are still hot, Bitcoin's still above 50K, what's the timeline for you guys in maybe going public?
Listen, Zach, we haven't needed to raise capital in quite a while because the business is very profitable. But we continue to be very active about thinking about the best way to position the company for long-term success. And that may, involve going public soon.
Okay, we'll leave it at that. We'll have to check in with you again, Peter, to see whether we're a little closer than we think in terms of blockchain.com coming to market. Peter Smith, blockchain.com's co-founder and CEO. Great to talk to you today. Coming up, we are talking about the huge growth we have seen in online learning during the pandemic. The chairman and CEO of online tutoring startup Nerdy joins us after this short break. Well, the closures, school closures during the pandemic have led to huge growth for online learning platforms, online tutoring marketplace Nerdy, no exception there. Recently releasing numbers for their fourth quarter, online revenue growth accelerated, up 87% year on year. Gross margin expanded to 68%. And then paid sessions there, a big bump there, 167% growth year on year as they saw their number of active learners also jump about 60%. Let's bring in Chuck Cohn. He's Nerdy founder, chairman, and CEO. And Chuck, of course, we should remind our viewers that you are coming to the markets through a SPAC deal expected to close at the end of the second quarter. But just give me a sense of where things stand, because early on in the pandemic, no question, so much disruption in the education space. Now you've got schools starting to reopen. How are things looking for you as you look to see this new normal, not post-pandemic just yet, but no question, the growth maybe not going to continue at the rate you've seen over the last year?
Well, first, thank you for having me on, Akiko. I really appreciate being here today. And, you know, one of the, I think just to jump right into your question, so at Nerdy, we're aiming to seamlessly connect experts and learners in any subject, anywhere, and at any time across multiple different learning formats. And so over the course of the past year, we really wove together 4 different ways of learning into a cohesive destination. And kind of contrary to what was implicit in your question, we actually saw significant headwinds when COVID first hit, and we had to innovate our way through it. And so what you'll see in our numbers is that we actually accelerated throughout the course of 2020, and a lot of that momentum now is carrying into 2021 because it's product driven, because it's about bringing together 4 different learning formats, enhancing that experience, improving brand awareness, and then building relationships with consumers. So we actually feel really good about the momentum in the business today and the opening back up of the economy.
Yeah, and Chuck, let me just back up too. When you think about Nerdy and Varsity Tutors, the brand that maybe some of our viewers out there would know of yours, talk to me about how this company is positioned differently than some of the other online learning companies we talk about. To you, one of those companies that's been on before, focused more on the college space. How should people look at Nerdy and say, all right, this is what this company does very well and the opportunities ahead?
Sure. So we are focused squarely on consumers. So we are a direct-to-consumer internet platform. We have a very different model than some of the companies that you referenced. We actually bring together 4 different learning formats into a cohesive destination. You can learn any of 3,000 different subjects, and you can do so online. And we believe we're providing a higher quality, lower cost, and more convenient experience that really appeals to consumers.
And so, Chuck, where are you seeing the biggest growth right now? Is it among university students? Is it among professionals who are looking to upskill in some way? Where's the growth?
Well, we can help people in 3,000 different subjects. And we kind of think about our audiences, the people that we help, in a few different buckets. So K-8, high school, college, graduate, and professional. And we're actually seeing really strong growth across all of those different segments. So it isn't one particular group. And we take a platform and product-oriented approach to really enhancing that experience, personalizing it, delivering it at scale, and providing something that we think is markedly better than anything else you can get either online through another company or alternatively offline. And so we're really encouraged by how high the consumption levels are, how high the engagement levels are, and the fact that we're seeing growth across really all audiences at this point.
Yeah, it's interesting. I mean, when we think about where we're at right now in this pandemic and how far we've come in the last year, I mean, what's maybe the biggest thing that stands out to you when you look back on it, since it's now been a year since most of this started, how you guys are positioned right now as a company versus where you were back then?
Well, we really had 2 big goals for ourselves in 2020. And those were to weave together the 4 different comprehensive learning formats into one place that would allow us to extend relationships with customers, help them in more ways, and build something we thought was very differentiated that fortunately we are now seeing consumers do in fact love and appreciate. And then separately, the second goal was to actually demonstrate that we could be self-sustaining as a company and significantly improve our unit level economics. And so we've made dramatic strides there. We were adjusted EBITDA positive in the fourth quarter, and we saw 87% online revenue growth, and we feel really good about the momentum in the business. And I should also mention, we also added a really important set of new products over the course of this past year. So we launched an expanded online small group classes where we can help people in, call it 5 to 25 on one settings. That allows us to go beyond one-on-one. We also have large group classes. These are often celebrity led. So anywhere from 500 to 50,000 people in the same class. And then lastly, adaptive and machine learning based diagnostic testing. And so we've been working on these for the last 18 to 24 months or so, but we really wove them together in a way that it delivers a fundamentally different experience than was the case a year ago.
Oh, it's not always the case that a global event will just trigger everyone getting comfortable with what you offer here in online learning, but we all had to kind of jump in last year now. But Chuck Cohn, Nerdy founder, chairman, and CEO, appreciate you coming on here to chat the business with us. Be well. We're going to take another quick break here on Yahoo Finance Live. When we return, the latest there with Demi Lovato, the pop singer, telling all in a new documentary, as that one comes back to YouTube after her last documentary notched more than 30 million views. We'll chat that with the director behind the film and what it means for YouTube right after this. Welcome back. YouTube shelf plans for a Demi Lovato documentary after the pop singer's 2018 drug overdose. And now the pop singer is back in the spotlight, ready to reveal what really happened. She's turning once again back to YouTube, which was also the home of her 2017 documentary, Demi Lovato, Simply Complicated, which got over 36 million views. And Yahoo Finance's Sabine Marcellus spoke with the director of Lovato's new documentary, which was just released, for what it means for her and for the platform as well. Take a listen.
I think she was ready to tell the story. I think there's nothing I could have done if it wasn't time. I think when she really decided that she wanted to have this cathartic experience and speak her truth and talk about what really happened, because she stayed quiet on it for quite some time, and there are all these stories coming out in the press, and I think it's easy to think, oh well, why don't you say something at the time if it's one story, two stories, 10 stories, but when there's hundreds, thousands, she's obviously got such a huge following, and there were so many headlines, and she was really working on herself at that point. So by the time she had done a lot of the self work and wanted to write the record, it was my job was really to create a safe space for her to do so. And I think that it was the most bizarre of times, 2020, and into 2021, making this film, but we were able to navigate it, and she was working on herself and having those revelations in real time. And as such, it made for a really powerful film.
And in the documentary, Demi says that she believes she was misdiagnosed as bipolar and that she should have gotten a second opinion. How important is it for Demi to continue to be a prominent advocate for mental health?
I think what's most important is that she's not put on a pedestal or made the poster child for anything anymore. I think she's a human being, and I think for much of her life, she was the poster child for this or that. I think she's talking about her unique experience and her unique journey. And the very fact that she's willing to talk about those dark moments in her life and be so vulnerable is admirable in of itself. And the message to get out there is to speak about things and to spark dialogue. And that ultimately will provide a safe space for people to feel not so alone. So whether it's mental health or any of the other issues talked about in the film, I think that Demi isn't telling others how to live their life. She's simply sharing her unique journey and saying it's okay not to be okay, and go seek help if you can.
And as famous and successful as Demi is, when you watch this documentary in her own words, you realize that stardom is not always a fairy tale. So why was YouTube the right platform for her to tell this story?
Well, I think, at the end of the day, Demi is, amongst many other things, she's a massive global musician, and YouTube is, the biggest home for music content. And it made a lot of sense to create this. We wanted this film, this multi-part series, to be seen by the masses. And this film will be available globally for free, right? I mean, there's obviously extra content and whatnot behind the paywall for premium, but the fact that this will be available all over the world and it will be accessible to the masses because of those subjects that we've been discussing, and because I do think it has the ability to help people, we wanted to do it on a platform that there was access and people could actually get to.
And this is not the first documentary that Demi has done for YouTube. She did a previous one that debuted in 2017 called Demi Lovato's Simply Complicated. So how did, Michael, you get her to work on this one with you? Did YouTube approach you? How did you strike a deal with them? Or was it the other way around?
So actually, Demi had seen Justin Bieber Seasons, which I had directed and produced. And I think she appreciated the storytelling and Justin's willingness to share his story. And obviously, like I said, hers is a completely unique journey, two very different stories, but saw the impact that had and was interested in doing, her version, her own documentary that was extremely truthful. I think, she has openly talked about that when she did Simply Complicated and other docs, she was trying to tell the truth, but she wasn't even there. She wasn't in a position to really, she was, it was the tip of the iceberg. So I think when she saw that, we got together to talk about the potential of doing this doc together. We had known each other, and we had worked together on a Pretty Big Deal with Ashley Graham. She was on an episode of that show, which I directed and we produced, and she was phenomenal on that. And I remember thinking when I directed that, wow, there is so much more here. She's an incredible person with so many passions, and she just touches the lives of so many people. So when she wanted to meet, I just jumped at the opportunity. And it was a natural home, given what I had mentioned about the access and global feel of a YouTube. Plus, I had just done a project with them. Plus, she had previously made a documentary with them. So there was a lot of synergy there.
And in doing this documentary, what did you learn about Demi Lovato's music career and the music industry in general?
She's going to be back in a big way. I mean, her new album's phenomenal. I think as a musician, if you can tell a story, you can really touch so many people and connect with your fans. So not only does she have the documentary coming, she has this album that just tells a story. So I think it's going to be really exciting. And, you know, as far as the music, we've done a lot in music over the past 5 years. And I love making projects that have, you know, the music component and then also obviously tell a story. And this one is a prime example of that.
We are off for a quick break here, but on the other side, we're going to be looking at some of the main travel stocks. We've seen a big move in this session there, particularly among cruise lines. Jared Blickery will walk us through the numbers after this short break. Welcome back to Yahoo Finance Live. The Dow extending its gains in this session, up more than 300 points now, while the NASDAQ, the only one dipping into the red, down about half a percentage point. Let's bring in Jared Blickery for the big market movers. And Jared, I know you've got your eye on some of the travel names, especially the cruise lines.
Yeah, and we got some exciting news on that front, and we'll get to that in just a second. I want to take a look at the markets overall. We just had European markets settle about 20 minutes ago. You can see the FTSE in London's up about 1/3%. Paris just barely in the green. The DAX in Frankfurt down about 1/3%. But here in the U.S., tech can't catch a bid, but the Dow can, and so are the transports. And you mentioned those cruise lines. Well, they're part of that group too. And let's get to our travel heat map here, where we see a lot of green. Royal Caribbean up 4%, Carnival Cruise Lines up 5.5%. And this comes from news that the CDC is being petitioned by an industry lobbying group that would be the Cruise Lines International Association. They want to push the CDC to issue guidelines that would give a path towards, quote, a phased resumption of voyages from the U.S. ports. And they want that to happen by the start of July. So lots of green right there. But let's go back to that NASDAQ 100, where we are not seeing tech stocks, especially the mega caps, easily catching a bid here. So Apple's down 1%, Facebook and Tesla and Nvidia each down 1.5%. Again, the 10-year T-note yield under a little bit of pressure here. So kind of a reversal from the trends that we've seen in previous weeks. Now, here's our sector look, and we can see energy is in the forefront here, up 3.5%. That blockage in the Suez Canal giving crude oil a boost after it sunk into correction territory yesterday. We got industrials and materials and financials. Those are all outperforming as well, guys.
All right, Jared Blickery bringing us the latest there. Appreciate that. We're going to take another quick break here on the show, but when we return, digging into the card data that shows American consumers spending a bit more here as those stimulus checks come through, as well as the big boost that Bank of America sees in the ready-to-drink cocktail space. If you're drinkers out there, maybe you had a few of those in the pandemic. We'll chat about those things right after the break. Stay with us.
Welcome back to Yahoo Finance Live. We've been looking at a number of notes out over the last few days, Zach, about what life is going to look like once we all get vaccinated. Of course, that's a hard timeline to point to, but some new data out seems to suggest where a lot of consumers are spending. We've had so many guests talk about that pent-up demand, but let's start by looking at this report out from JP Morgan. This came out yesterday, but looking at Chase card spending, they've seen a jump there with the latest stimulus checks out, of course, earlier this year. Consumer spending up 24% from a year ago, but it is still down 4.4% from pre-COVID spending. The big question here, where are they spending their money? And Zach, I have to say, we're still talking about the staples here. Not a whole lot of excitement, difference from the pandemic. Wholesale clubs and discount stores, a big one, at least among Chase card users. Restaurants and airline spending at the very bottom here. Gas stations, another big one. And then an interesting note here in terms of one of the charts they have on who's actually doing the spending here. No surprise, possibly millennials and Gen Xers. the biggest spenders there, baby boomers at the bottom. And there's a UBS note that sort of supports the thesis as well. They've been looking at, who's actually likely to spend more coming out of these COVID restrictions, and what categories the top spenders are going to be in. Groceries and gas at the top of the list again, vacation and travel really at the bottom, although at the very bottom is live sports and entertainment, which is going to take a little longer to resume.
Yeah, and millennials and Gen Z are spending more. I mean, we've always talked about how a lot of their spending is not really necessarily discretionary when they got to spend a lot just to kind of make ends meet as they have less in savings. So maybe not surprising to see that shake out. But when we talk about opportunities out there as we return to normal, it's interesting to see Bank of America out with a note talking about the ready-to-drink cocktail space. You and I, of course, talked to the founder of Cutwater, one of those companies focused on that space. When we chatted with him, we were talking about people drinking at home. Maybe, if you're drinking in the pandemic, maybe you've had one of those drinks where you just don't have the energy to put a cocktail together, so you buy a can. And you think about returning to that. Bank of America says when you get to that space, you could start to see some big improvement to purchases on that space. And that's what Youssef Cherney, the co-founder of Cutwater, told us just a few weeks ago.
You're seeing us in places that are demanding the product, and we're going into stadiums and large venues, and the sporting industry is just a huge venue for us to, kind of capitalize on that convenience of the can, getting it out into people's hands without having to mix cocktails. When you're standing in line 20 deep, you can just be handed a can, at an event. It's a huge thing. So hopefully we get that market back, as COVID hopefully gets away from us here.
Yeah, so Bank of America says that they could see some pretty extreme growth there, 9 to 12 times perhaps what it is right now, 400 million in terms of that category of sales. We'll see if that happens, though, as bars and restaurants continue to open up. That'll do it for me and Akiko in our hour. Stay tuned, though. We got much more coming up here in today's trading session as the NASDAQ remains the lone index in the red. Stay tuned. Much more after this.
It is 1 p.m. here on Yahoo Finance Live. Let's look at today's top headlines. Now, in good news on the coronavirus front, the U.S. is set to triple its vaccine production this month. But worryingly, globally, the picture is not as bright. New mutations are causing continued waves in Europe and South America. We've got an ER doctor here to go through all of those concerns in just a couple of moments. Now, today is Equal Pay Day. Now, that is the day into the new year that women will have to work in order to earn what men made in the previous year. So in other words, for anyone doing the math at home, women have to work more than 15 months to earn what men earned in just 12. We'll be chatting about this with Barnard College President Dr. Sion Beilock. Now, I want to look now at today's market action. The NASDAQ, the lone index right now in the red, down about three quarters of a percentage point. The Dow and the S&P 500 are in the green. We are seeing some sectors rebound. For example, travel, that had sold off yesterday amid rising concerns about some of these rising cases of coronavirus in the United States. Again, we will be addressing that very shortly with that ER doctor. So I want to turn now to some of those concerns about the coronavirus pandemic. We've got Yahoo Finance's Anjali Khemlani here with us to give us all of the latest updates. Hi, Anjali.
Hey, Kristen. Yeah, so like you said, we do have some good news here in the U.S. at least, noting that at least 70% of seniors are now vaccinated and many more to go in the general public still. But what we're learning out of the communities that are vaccinated so far is that it is helping prevent more infections, of course, the point of vaccinations, but also to keep down sort of the national count of cases and keeping people out of the emergency room, which has been the goal this whole time. We heard from the White House Coronavirus Task Force earlier today with the senior advisor, Andy Slavitt, noting that the output of vaccines is definitely going to be increasing, which is something that they had already targeted for the end of the month. Listen to what he had to say.
This means that in the 62 days since taking office, we've more than tripled vaccine output from 8.6 million doses to 27 million doses per week.
But we also know that there are also more than 150 million doses to date that have been administered. Meanwhile, all of this is important as we look at the global context of what is going on with variants from not just Europe, but also Brazil, as well as the South Africa variant continuing to be of concern. We also have 2 domestic strains that everyone is looking at. Health experts are still trying to determine if they are just strains of interest or should be escalated to strains of concern in New York and California. So all in all, we know that there are still there's still a lot of pressure out from the outside for this virus and for the potential of the pandemic to continue. A recent study did show that with the variants also putting pressure, the vaccinations are increasingly important. With the idea of herd immunity still being very, very much top of mind. If 60% of the U.S. is vaccinated, we would still see a lot more cases. But if 100% are vaccinated by the end of fall, it could actually end the pandemic. So a lot of pressure still on health experts to make sure that vaccine hesitancy is overcome in order to help curb the pandemic. Kristen?
All right, some really good data and statistics there. Thanks so much, Yahoo Finance's Anjali Khemlani. Let's talk about this more. I want to bring in Dr. Anand Swaminathan. He's an emergency medicine physician in New Jersey. Doctor, always great chatting with you. So let's talk about some of these variants, some of these mutations. We're seeing that vaccine production is speeding up. I'm wondering, are we in a place where we no longer need to worry about those variants, those mutations, at least here at home in the United States, because the vaccinations are somewhat outpacing those variants, or are these still very much capable of almost knocking us off of the path that we're on right now?
I really wish that I could say we didn't have to worry about them, but we clearly do. What we're seeing is already some spikes in cases in the Northeast, New Jersey, New York, where we're seeing a real expansion of the numbers of patients. We're rising instead of the fall that we saw coming from January until now. And I think the variants are definitely a part of that. We know that the UK variant, which is becoming predominant in this country, is easily transmitted or more easily transmitted. I think that's a big part of why we're seeing a surge now. So we still have to be worried about those variants. And what we also have to be worried about is as we vaccine up, if we allow our public health measures to lapse, we're going to get new variants that's going to be emerging. And some of those variants might actually be resistant to the vaccines or make our vaccines less effective. So we really do have to be cautious about this, which means that we have to continue those public health measures. But that's not what we're seeing. We are seeing, again, those variants spreading. We're seeing some pandemic fatigue. But I think more than the pandemic fatigue is the mixed messaging that we're getting from our local government. We have, on one hand, our governor saying we're opening indoor dining to larger numbers. You can gather in larger numbers. And then on the other hand, they're saying, but keep masking and don't go indoors. And that lack of consistency of messaging is very difficult for the public to take and understand what to do with. If the restaurants are open, then we're going to go because we've been waiting a year to go out to eat. So we need to start buckling down a little bit more as those cases rise and say, if we're going to suppress this rise and make sure that it doesn't become another huge surge, the way to do that is to stop those gatherings.
Okay, so then I'm just going to ask the straight up question. If we have the mutations and the variants, if we continue to stop wearing our masks or do like we're doing, as you mentioned, go to bars, go to restaurants, go to concerts, just gather with each other, go to parties, go to clubs, do we ever get out of this pandemic? As we are right now, as it stands right now, does this pandemic ever end?
I don't think we can really end this without both coupling those public health measures with vaccinations. As vaccinations are ramping up, like you said, we have a lot of supply. A month ago, we were saying we should be targeting 3 million doses a day. We're at that mark already. We're already beyond 3 million or at 3 million doses a day. So we're ramping up the vaccines, but we can't loosen those restrictions and get back out there until the vaccines have been delivered. And remember, it's 2 weeks after your second dose for the Moderna and the Pfizer, and 2 weeks after the J&J before you're fully immunized. We have to continue to keep that tight, or else we're going to see another surge and another one after that. And the more these variants spread again, the more we'll get more mutations. So I can't say that we'll never get out of it, but I think unless we tighten down and keep those public health measures in place, we're not going to get out of it anytime soon. And the worst case scenario is that we render our vaccines less effective, in which case we're going to be going down the same path we were going down a couple of months ago. We're going to see huge spikes as well as peaks in hospitalizations and deaths.
Okay, so what would we have to do in order to render those vaccines essentially ineffective or perhaps even useless? And are we doing some of those behaviors now?
I think what we would see is more spread and more as the virus spreads, it mutates more, we get more variants. I think that's really what we have to be trying to avoid. And we're seeing some of it already. If you look at New Jersey, we've been having a rise in cases consistently. And yet we are expanding what we're allowing for indoor dining and things like that. Now, we haven't had recent expansions, but we also haven't pulled anything back from the restrictions that were lifted a couple of weeks ago. So while we still have universal masking in place in public, we are allowing up to 150 people to gather for weddings outdoors. We're allowing almost unlimited gatherings for funerals, religious services, and then that indoor dining issue. We talk about ventilation being so important. These restaurants don't have the ability to ramp up their ventilation and ensure the safety of everybody. And it's getting warmer anyway, Kristen. So let's just wait a little bit longer and let's do outdoor dining. Let's do outdoor events, but let's keep them small until more people are vaccinated. We just have to hold off a little longer, which is what Dr. Walensky has been saying for weeks. Just hold off a little longer. We're getting there. We were talking about not having enough vaccine for everybody until maybe the middle of summer a couple of months ago. Now we're saying by May 1st, everyone's going to be able to book appointments. We just have to wait a little bit longer. It's a little bit more patience, which I'm not saying is easy. And I'm not blaming individuals for this. This is really where the government has to say, you know what, we need to have these restrictions in place. We need to wait a little bit longer. So let's not open up everything. Let's keep things a little bit tighter until we're in a safer place.
We just heard Anjali Khemlani saying that it would require 100% of people to get vaccinated in order to declare this pandemic officially over, which seems pretty unlikely that we can get 100% of Americans to do anything. Honestly. So then do you imagine realistically, and I know that you don't want to just come out and say, Dr. Anand Swaminathan says pandemic will never end, but let's be realistic about this. Do you imagine that this pandemic is going to continue, perhaps not as badly, perhaps we can still gather with our friends, go to work, but that we are still going to have to talk about and think about and consider coronavirus, or rather COVID-19 specifically, for several more years to come.
I think that's probably true. And I'm not sure exactly what the number is that we need to get to. I don't think anybody knows. Dr. Fauci has said it, Dr. Walensky has said it. We often throw around 70% for herd immunity. It might be higher than that. We don't really know. We're nowhere near that number now. So it's almost this idea in front of us instead of a reality. Do we need to get to 100%? 100% will be great. I think it's very, very unlikely that we get there. But I don't know that this will be forever. It will probably be in a very different kind of a picture than what we're seeing right now as more people get vaccinated, as people are safer. And we still think that there may be boosters down the line as new variants emerge. So yes, I think we're going to be talking about COVID-19 for a very long time, but I don't know that we're going to be seeing it in the same way that we're seeing things right now as vaccinations get a little bit more uptake. But Kristen, really what you're talking about is this messaging that we need to get to. It's great to have 60% of people vaccinated, better to have 100%. And how do we do that? And it's part of this is vaccine hesitancy. That is a major part of this. But a lot of it really is about access and logistics. There are a lot of people who want vaccine who can't get it. And so we need to address those issues as well. And as far as vaccine hesitancy, what we need to be doing is really partnering with local people who are respected, whether that be priests or rabbis or whatever it is, whoever are the local respected leaders. Let's partner with them to get better messaging across. And what I found as we're doing vaccinations in our emergency department is a lot of people are skeptical until you sit down with them for about 2 or 3 minutes and answer a couple of quick questions. And all of a sudden they're saying, how quick can I get this shot? So I think we just need to do a little bit more outreach. We need to talk to leaders and really partner with them to get this messaging through.
All right, doctor, I have one more quick one for you. I have like 30 seconds. I know we're already running a little bit over time, but I want to ask you about the global picture because we're seeing cases rise in Europe. We're seeing cases rise in Brazil, even if we do things well here in the United States. And I know you're saying it's not too rosy here in the US either. What's the global picture going to look like going forward?
We absolutely can't beat this pandemic without working with our partners globally to fix that. And the Biden administration has worked really hard to get more funding and more vaccines out. But what we really need to do is as our supply ramps up, as we're getting to the point where we have enough vaccine for everybody, we really need to be pushing more vaccine outside of the US, getting it to other countries where there's very, very low vaccination rates. We've got about 25% of people in this country with at least one shot in the arm. That's far higher than almost everywhere else. And there are many places that are below 1% or below 0.5%. So we need to take some of the vaccine that we are producing and start getting those to other places, really start working to see what are the logistics of delivery to harder to reach places. Without that, without partnering globally, we cannot beat this pandemic. So this is the time to start pushing more of that vaccine abroad so that we can help our neighbors and help everybody so we can fight the pandemic.
All right, Dr. Anand Swaminathan, emergency medicine physician out of New Jersey. Thanks so much for joining us. And Yahoo Finance Live will be right back after this quick break. Welcome back to Yahoo Finance Live. The Paycheck Protection Program, that is a tongue twister, also better known as the PPP program, that's going to be expiring at the end of the month unless Congress acts. Now, the House already passed a bill to extend the program by 2 months, but the Senate hasn't taken it up as yet. We have Yahoo Finance's chief political correspondent, Jessica Smith, here with us. She chatted with Senator Marco Rubio, that's of course the top Republican on the Senate Small Business Committee, about this earlier today. Hey, Jess.
Hey, Kristen. Yeah, Senator Rubio was really key in crafting the Paycheck Protection Program, he and Senator Ben Cardin. And I talked to him today about this extension, and he says he is concerned about the administration making changes beyond what Congress intended. You'll remember the Biden administration did make some changes to the program last month. So he is going to propose an amendment to restrict what the administration can do, how they could make changes without Congress. We'll see if that actually passes. And you have to remember that the House has already passed an extension, and if the Senate makes changes, the House has to take it up again. Still, I asked Senator Rubio if he thinks that this will get extended before it expires at the end of the month, and here is what he had to say.
I do, simply because it's very popular. It's helped a lot of people, and I don't want us to punish, some small business out there that needs the help because of political fight over here. But I go back to the common sense, and that's one of the things that's missing in American politics today, right? We analyze everything through ideology, through political talking points, through getting attention in the press, but common sense is increasingly absent in some of these decisions. And the common sense here tells you don't punish thousands of businesses because of one or two bad actors. I think that's true when it comes to the fraud in the program, which clearly existed. And I think it's true when it comes to some of these political flashpoints. But look, it's an important point because these funds were never intended to help organizations like Planned Parenthood or others, who may become eligible as a result of these changes they're trying to make unilaterally.
Now, the timing on the Senate vote is still a little unclear, but it could happen as soon as tomorrow. We are expecting it to happen at some point this week. Kristen, we'll keep you updated.
All right. Thanks as always to our chief political correspondent, Jessica Smith. I want to turn now to our Funding Our Future segment. Prudential has done a survey on the financial wellness of Americans, and they found that nearly half describe themselves as financially struggling. So we're joined now by Janella Frias, Prudential Retirement President. So Janella, I want to start on that statistic there. 45% of Americans describe themselves as struggling, and that's an increase from the 22% that described themselves that way in May of 2020, May of last year. But we keep hearing, the economy is doing so well, it's strengthening, people are doing better. So where then is this disconnect as we see an increase of folks say that they are really still struggling?
Well, hello, Kristen. Good afternoon, and thanks for having me. And you're right. And look, there's no doubt it's been a challenging year for all of us. So given that we are 1 year into the pandemic, Prudential wanted to check in and get a better understanding of exactly how Americans are doing. And that's the point of this report. So today we're releasing our findings on the 2021 Financial Wellness Census Report. And as you stated, it paints a stark picture that really varies profoundly across demographics. And among our top findings is the one you just stated. Nearly half of Americans now describe themselves as financially struggling. Household incomes are plummeting, with 36% of households now under $30,000 in annual income. And also 24% of those surveyed said they're falling behind on their bills. And so, Kristen, this really does have an impact on long-term financial goals like saving for retirement. And almost half of responders said that their confidence in meeting their financial goals has decreased, with confidence especially decreasing among women and millennials. And there is a disconnect. And we have seen an improvement in the economy, but yet people are either A, having more expenses because they have childcare and caregiving needs, and also they have lower wages. They have perhaps hours that have been cut, or they can't work as much because of other demands.
Now we have another statistic here. 24% say that they've fallen behind in paying bills. That's compared to 11% that said that in May. 9% say that they've missed a mortgage or rent payment. Now, this seems incredibly worrying for our economy. And it seems as if people are going to be forced into bankruptcy, perhaps, or foreclosure. Do all of this data, does all of these statistics that you've gathered in this survey really point to a need for further economic help, another stimulus package?
Well, it points to a need for a number of things. And one other finding I would highlight, which is related to this, is that 61% of folks told us they're finding it increasingly difficult to keep up with their bills despite having a job. So those are the ones that are employed. And again, this is due to pay cuts or higher caregiving costs. And also, we found that unemployment is higher among people of color. So 29% of Latino Americans and 26% of Black Americans say they're unemployed versus 19% of white Americans. So, just because things are getting better and we have stimulus doesn't mean that everyone is employed. And the employment or the unemployment stats really matter depending on demographics. But the other thing that we have to keep in mind is that we don't just need stimulus, we need other support. So another key area in our research has really put a spotlight on how this pandemic is impacting caregivers. So the closure of schools and daycares has really imposed greater childcare demands on families, as well as the need to care for those who have fallen ill. So 26% of those surveyed told us they have left the workforce in the past year due to caregiving needs. So even if they want to work and they have a job, they're leaving the workforce because of these needs. 38% said they're struggling with caregiving demands, and that number goes up to 49% for working parents. And let's keep in mind that caregiving has disproportionately fallen to women. So we see 1 in 4 women considering either downshifting their career or leaving the workforce. So some of this is just that people are leaving the workforce not by choice, but because they have to. And one key statistic was that about 80% of responders said that they want the government to step up and really to prioritize more solutions for caregiving and to help with more access to paid family leave. So this is not about more stimulus necessarily.
Right.
That may be a key factor, but other support is really necessary as well.
Janella, I do want to ask you about retirement very quickly. It says that 18% of people are taking on debt. Many are borrowing or withdrawing from their 401ks, their IRAs, their life insurance. Are we creating a generation of folks or a large number of folks that are going to be tapped out once they do retire or essentially force it so that they can't actually retire?
We're absolutely, we're in a place where when people struggle and they need to find liquidity, they borrow from their future to pay for today, right? So a lot of the statistics I shared are about challenges today, which just exacerbate the challenge in the future. And, I think this is about resiliency and the path forward. And American workers are struggling. And we've seen a bit of a recovery, but millions still remain out of work. They've used up their emergency savings, so now they have to tap into the longer term savings. And of course, that will impact their ability to retire on time or their ability to retire at all. So we have a lot of work to do, Kristen, around emergency savings, around caregiving.
Yeah.
Caregiving challenges will be here a long time. Equal access to financial advice and opportunities. And at the end of the day, we have to help Americans get back on track toward their long-term financial goals.
Absolutely. The economic scars will definitely continue for quite some time. Janella Frias, Prudential Retirement President, thanks so much for joining us for today's Funding Our Future segment. And as a reminder, Funding Our Future is an alliance of organizations dedicated to making a secure retirement possible for all Americans. Coming up after the break, we will be hearing from Bridgewater's Ray Dalio. That's next. Welcome back to Yahoo Finance Live. Billionaire Ray Dalio spoke with Yahoo Finance's editor-in-chief Andy Serwer about inflation concerns, the markets, and more. Let's take a listen.
What's happened is that a lot of new ideas, new technologies, new things come along, and they make fabulous revolutions, and they grow things, and that's great. But there's a tendency of investors to extrapolate the past and and not pay too much attention to price. And when that happens, you start to emerge as somewhat of a bubble. By our measures, the bubble is not as what it was in 2000 and not what it was in 1929, but it's kind of like halfway there if I look at the types of qualities. In other words, and so what that means from a value point of view, if you're calculating, what can I realistically expect? Its expected returns shrink relative to the others. However, the kind of the meat and potatoes type of companies didn't benefit as much from those, and they're fairly stable and so on. And so that's why you're starting to see that kind of rotation. Now that can change, it can come and go in these phases, like when people get stimulus checks and then, they might be hot on, the exciting things and they run up again and so on. But that's going on. And of course, there's Bitcoin and other things that are going on. However, the big thing is plenty of liquidity and ridiculously low interest rates. Now, you ask about the 1.6%. I think we have been in a 40-year bull market in bonds. So now you look at that 1.6%. That's a negative 1% about real. Okay, so you're guaranteed. And you ask yourself, if you're going to hold a bond, any investment, the only purpose of an investment is so you can sell it to buy something you want. And so when you look at what is the length of time it's going to take me to get my money back, if I give an investment nowadays in the United States, I'm going to have to wait about 50 years to give back the buying power to start, and then I'll start earning money. If I'm in other countries, some Europe and Japan, I will have less. And if I measured in all those countries in real terms, I'm going to have less money. So basically what that means if I just bought anything that didn't depreciate in real terms, if it just matched inflation, I'd be better off than to have those things. And so now, I don't think those rates will only stay down there, I think, if the Federal Reserve does what it did like in the 1930s in the war period, which is to put a cap on rates, to make short-term interest rates low in relationship to the cap. Like back in the 30s and the war years, they made 1% was the short-term interest rate and 2.5% was the bond yield. So it was profitable to buy those bonds, funding it with 1%, and you got 2.5%, that could put a lid on it. But because those two assets, cash and bonds, were such bad investments relative to other things, there was the movement to those other things still, and then the government outlawed them. I mean, things like gold, they outlawed gold. That's why also outlawing Bitcoin is, a good probability. And that they also established foreign exchange controls because they don't want the money to go elsewhere.
Let me jump in, Ray, because that comment you made about Bitcoin, I mean, so it's a two-part question. Is that in a bubble? Maybe three-part question. Is it dangerous? And what do you think the likelihood of the government outlawing it is? And is that even feasible?
Bitcoin has proven itself over the last 10 years. It proved it hasn't been hacked. It's by and large, therefore, worked on an operational basis. It has built a significant following. It is an alternative, in a sense, storehold of wealth. It's like a digital cash. And those are the pluses. Bubbles are financial assets that have imputed value. It's an asset that doesn't have intrinsic value. It has imputed value. It's whatever we think it is. And if you look at some of the bubbles in the past, a great book is Extraordinary Popular Delusions and the Madness of the Crowds by McKay, 1845 or something. But he talks about the South Sea bubble, and he talks about the Mississippi bubble and so on. It is when people love it. It's the dot-com bubble and so on. And that could be. So when you look at Bitcoin, it's a possibility. It's an alternative because there aren't many such assets. There are not so many assets that might have intrinsic value that can't be messed around. As far as the government allowing it, the history was, banks always used to exist. And then with the Bank of England, they decided that it was in their interest to have a monopoly on banking at a country. And so what we did is every country treasures its monopoly on controlling the supply and demand. They don't want other monies to be operating or competing because things can get out of control. So I think that it would be very likely that you will have it under a certain set of circumstances outlawed the way gold was outlawed. And you're watching that question arise in India today.
And you can listen to that full interview with Ray Dalio on yahoofinance.com. Coming up, we talk about new initiatives aimed at helping Black real estate developers. That's next. Welcome back to Yahoo Finance Live. Now, gaining access to capital and funding is difficult for Black business owners, and it's no different for those in real estate development. That's a field that remains overwhelmingly white. But there's some initiatives that are being designed to change that. So let's bring on Harvey Yancey, owner of the construction firm H2 Design Build. Harvey, great to have you with us. So I want to first talk about the situation at hand. Very few people in real estate development are Black, but what are the challenges that you have faced in your own career? Is it just about money, capital, or is it networking, all of the above, or something else?
All of the above. There's different things that contribute to the lack of Black and brown people in the real estate market. If it's networking, who do you know, or if it's from the banking institutions.
Now, you're in Washington, D.C., which, despite what I think a lot of folks think about at home, given Washington and politics, is a majority not white city. But given that the developers there in the development space are mainly white, how has that impacted some of those Black and brown communities?
It's extremely different in this area because it's probably 2% of the developers are Black and brown people that are performing some of the major projects in the city. And a lot of that is just access to capital and being able to get funded and understanding the process and being accepted in certain areas that some people don't understand on how to fund these projects. So, and that's one of the things that we're all looking at and trying to change the dynamics of, the process of getting capital. If you live in Bethesda and to get an investor or a banker to go to Southeast DC is a little bit challenging when you don't know the area, and especially if you are a Black developer.
So then let's talk about the best way to change that. What is the best way to really increase the number of Black and brown developers, not just in DC, but perhaps also around the country?
Well, it needs to be more diversity in the capital allocation of funds. And people need, it needs to be more attention to specific areas and developers and being able to grow them, understand the process, and understand the risk that's involved by giving people the opportunity. If me or someone else comes into the bank or into an investment fund, it shouldn't be any difference if we're Black or white.
So then
That's
is it
the
a
challenge,
matter?
and those are the things that need to change.
Right. I'm wondering if it's a matter of the fact that so many initiatives, have been announced just even recently, but this is not a new problem, and it's not a problem that has never been discussed before. It's been talked about for quite some time, and yet we haven't necessarily seen that much progress being made. So is it a matter of the fact that we need to start specifically calling it out and allocating these funds, saying, hey, you know what, we're going to put aside $10 billion, and we're only going to be giving this to Black and brown developers going forward in order to ensure that folks like yourself actually get the funding that they really need in order to be successful?
Well, it should be mandated, and especially large municipalities where you see a lot of the growth in reference to the development. I'll give my hats off to the mayor and the politicians of DC is that they have different programs that have become available. One such as the HIP program, which helps provide emerging developers such as myself scale, and at the same time invest in our dreams in a community of growing our companies. The HFA, Department of Housing and Finance, had started a program 3 years ago. I was building maybe 2 or 3 houses a year, and with that program now I'm doing roughly 25 to 40 houses a year. And with that program, it allowed access for specific capital and equity for emerging developers such as myself to grow. And I think that is one of the biggest things that other areas should look into.
I had a very quick question for you here. I only have about 30 seconds. Do you feel that there's been a push to get Black developers more into the affordable housing space, which of course has its own limitations?
Yes, because we know the area, and if we're in these transitional areas, who else would you turn to? Who understands the market better than we do?
Right. And of course, there's also other more profitable areas. We're seeing some of those pictures on the screen of some of those beautiful homes and buildings that you have designed. I wish we had more time to chat. Unfortunately, we don't. Harvey Yancey, owner of the construction firm H2 Design Build, thanks so much for joining us. And coming up, it is Equal Pay Day today. So we're going to be having a conversation on the wealth gap and improving financial literacy in women and girls. That's next. Welcome back to Yahoo Finance Live. Today is Equal Pay Day. Now that is the day that women need to work into the new year to make what men earned in the previous year. So I want to talk about this and more and how we can change that with Dr. Sion Beilock, cognitive scientist and president of Barnard College. So we talk a lot about the wage gap, and we usually say that we just need to essentially increase women's salaries. But some of the research and some of your research seems to suggest that it is not that simple, and that we as women also need to address fears and anxieties that we have. Parents need to address those fears and anxieties in their children. So what is the best way then? If it's not just increasing salaries, what's the best way then to decrease that gap?
Well, we know that oftentimes young girls and women have anxiety and a lack of self-confidence in their ability to do math and to think about numbers. And it's really important that we address that self-confidence in addition to addressing the gap specifically.
Now, what are the fears and the anxieties that are holding women and girls back? Because I, growing up, was great at math and at science, and I know that I was not alone. And it's not true that that girls are not as capable or can't handle, complex math or economics. So what is it then that is that fear, that anxiety, if it's not on actual skill?
Yeah, I mean, there's absolutely no biological reason a woman versus a man should be any different at math or in terms of their financial literacy. But we do know that culturally, there are often signals that girls aren't as good as boys at math. And that is not just with young girls, it can be up to adult as well. And when you hear people saying, I'm not a math person, it tends more often than not to be a woman. And this is problematic because when we're anxious about something, we stay away from it. So that could be negotiating for more money. It could be thinking about our health insurance policy. It could even be investing, which is a place where we know women tend to lack knowledge and confidence relative to men.
Yeah, absolutely. I believe the statistic, the most recent one, was that only about a quarter of women are involved in the stock market compared to about 3/4 of men. However, and for any women that are at home listening or are afraid, I do want to point out here that statistically, women do perform better in their portfolios than their male counterparts, at least when it comes to investing. So, okay, so we now know what the issue is. There's fear, there's anxiety that obviously is having a huge impact on financial literacy, on the desire to get involved in investing, get involved in taking control of finances. So now that we know that this is the issue, what can we do as, either as adult women to really tackle that fear and that anxiety? And what can parents do as, they're raising young girls into women to really tackle those fears and those anxieties or make sure that they never have them in the first place?
Yeah, well, I think there's multiple ways we can go at this. And one that we're really focusing on at Barnard College is that we're making financial well-being part of how we talk about overall well-being. So we just announced the creation of a new center, the Francine A. Lafrac Center for Well-Being, and it has 3 pillars. It has physical wellness, mental wellness, and financial wellness. And the idea being that part of being a woman and being self-confident and in charge of your future is having wellness across these areas. So it's not something on the side. It's brought in to be part of how we think about controlling our lives. And this is true at very young ages. Parents can do small things, just talking to their kids about thinking about prices for if you're going to purchase something, even just talking about number, about math, about space, shapes, we know, and my research has shown, can help young girls especially feel more comfortable and confident in their own abilities.
Is there something that we should be doing in terms of our talking to our young boys or the men that are out there to essentially prevent the perpetuation of some of those stereotypes that women aren't as good as they are at some of these topics around math, around finances, around economics?
Yeah, I think something really important is just to point out examples of women succeeding in these areas to both boys and girls. There's a real scientific backbone to this idea that seeing is believing. And when young boys and girls see women succeeding in these areas, it sends a signal that women are meant to be there. And a lot of this is really subtle. If you have a mom say to their young girl while they're doing math homework, oh, it's okay, I'm not a math person either. The mom is trying to be helpful to help her daughter feel better, but it's sending a really important signal that some people are math people and some people aren't, which is not true. And also that it's okay not to be good at math. And we know that that's simply not true. Numbers, equations, quantities, reading a graph is part of everyone's life, and we all have the ability to be successful at it.
Well, I hope if there's some women, some parents that are at home watching this conversation, that it at least sparks some important conversations to themselves, but also within their own homes and with their families. Dr. Sion Beilock, cognitive scientist, president of Barnard College, thanks so much for joining us today.
Thanks.
All right, coming up, some unemployment benefits are going to be delayed until mid-April for some workers. We'll be giving you that report next. Welcome back to Yahoo Finance Live. We have some disturbing news, sadly, to share. So it sounds like some extra weekly unemployment benefits are going to be delayed until mid-April for some workers. So we have Yahoo Finance's Denitsa Sekova here with that report and with all of those details.
Yes, we're seeing a slow rollout of some of the unemployment benefits programs. And according to the Labor Department, it may take quite some time for the benefits to get out. So we're hearing mid-April or later. Just as a reminder, the latest stimulus bill was signed just 2 weeks ago. But states need more time to restart the pandemic unemployment assistance. This is a program which provides benefits to contractors and the self-employed. And then the pandemic emergency unemployment compensations, which gives additional weeks to workers that have already exhausted their benefits. And of course, one of the most popular unemployment benefits programs during the pandemic is the additional 300s. They're seeing a delay. So far, we have the data and only 12 states have begun paying the benefits. And this is 2 weeks after the program, after the deal was signed. Some of the states that are paying them are California, New York, Delaware. But previously, when those programs were restarted, it really took more than a month to some states to get back and running and resume the payments. What I hear from experts is that this time it may be a bit quicker. Some people say that around 80% of the states will get them back and running next week. But what we've seen during the pandemic and with the unemployment system as a whole is that the response on state level is very different. So we may see a huge delay in the rest of the states. And for context, the last time that this happened, which was December, January, around 17.6 billion in unemployment benefits were delayed. So a lot of people may be waiting on a lot of money this time as well. And while we know currently there are stimulus checks being distributed, workers maybe have some cushion, those delaying payments can still cause significant hardship among those people.
All right, and if you are a worker, you might have concerns about this. You can read that full report on yahoofinance.com. Thanks so much, Yahoo Finance's Denitsa Sekova. The 2 p.m. hour is going to be continuing after the break. Alexis Christophorous will be chatting with Dr. Stephen Corwin, CEO of New York Presbyterian Hospital. That's next.
Hello and welcome to the 2 p.m. hour of Yahoo Finance Live. I'm Alexis Christoforous, and here's what's happening. It looks like $3 a gallon gas is now within sight. According to AAA, the average price for a gallon of regular is $2.88 nationwide. That's thanks to a jump in crude oil prices and growing consumer demand. It's also 30% higher than this time last year, when, of course, the country was in lockdown because of the pandemic. Experts say crowded highways and diminished stockpiles will lift gas prices past $3 a gallon into the summer driving season. Federal Reserve Chair Jerome Powell and Treasury Secretary Janet Yellen were back on Capitol Hill for a second day, testifying this time before the Senate Banking Committee. Their message to the panel was similar to what we heard yesterday when they addressed the House Financial Services Committee, that the economy is poised for a strong recovery, but that reinvigorating the labor market will take time. On Wall Street right now, stocks are mostly higher despite another decline in tech shares. We see investors piling back into those economically sensitive sectors on bets the U.S. economy will continue to recover. We have the Dow Jones Industrial Average now up pretty strongly, up nearly 300 points. The S&P gaining a more modest 16. But again, the NASDAQ giving back 94 points again as we see investors dumping those tech stocks. One sector moving big today, the EV sector. Tesla, NIO, among the top trending tickers on our site today. We've got Jared Blickery here to fill us in on all those details. Hi, Jared.
Hi there. Well, guess what? They are some of our top trending tickers, but they're moving the wrong way. And let's take a look at the Wi-Fi Interactive here, because everybody's been talking about these Elon Musk tweets overnight about Bitcoin and being able to buy a Tesla with Bitcoin. So we can see here, it's stock down about 2%. NIO, you mentioned, that's down about 8%. Take a look at that in a second. But here are those Elon Musk tweets. In the wee hours of the morning, he said, you can now buy a Tesla with Bitcoin. He'd alluded to this a few months ago. And then also following up with that, Tesla is using only internal and open source software and operates Bitcoin nodes directly. Bitcoin paid to Tesla will be retained as Bitcoin, not converted to fiat currency. But guess what? Seen some articles highlighting one potential roadblock. If you're going to pay for a car with Bitcoin and you have capital gains on it, in other words, you made a profit on that Bitcoin investment, it is taxable. So that is a taxable event. However, if you bought at the high, 61,000, guess what? You don't have to pay taxes on that. You might get a refund because it is not, let's just say it's underwater from that price. Let's take a quick look at NIO here. That stock, our number 1 or 2 trending ticker, that's down 8%. No particular news, but China stocks having a tough time today. And then I also want to touch on Bitcoin, because you can see what happened overnight after that Elon Musk tweet. There we go. That's the kind of reaction that we've gotten used to from an Elon Musk tweet on Bitcoin, Alexis.
Goodness. The power of the tweet. Don't underestimate it. All right, want to talk some of these transport stocks because they're jumping today. In particular, Jared, the cruise lines now seeking some reopening guidance from the CDC, I guess.
Yeah, how about that? Reopening trade looking good today, so benefiting from that particular tailwind. But the Cruise Lines International Association is petitioning the CDC as part of their current framework for a conditional sailing order. They want to accelerate a framework to put in place, at least by July, have a return to business plan that they can operate from. So we're seeing Carnival up over 5% today. Royal Caribbean's up over 4%. And taking a look at the year-to-date price action, really a nice liftoff from February, up 23% there. We've seen these value and cyclical trades in general really outperform the growth stock. So part of that trend as we continue to reopen here, Alexis.
All right, got to talk a little GameStop. It looks like the stock is plunging after their latest earnings report. And I think you have another meme stock to tell us about.
Yeah, pretty interesting on GameStop. The earnings report was a miss on both the top and bottom lines. But in the after hours trading, as I was reporting after the bell yesterday, the stock shot up about 7-8%. And I think that was over some excitement. They've been recruiting some top talent from Amazon and Google. And that's at the behest of Ryan Cohen, who's kind of leading the charge in their turnaround strategy. But I got to say, they're not giving any guidance for the full year. They're going to stop issuing comparable sales guidance, not only guidance, but also comparable sales data, not required to do that per GAAP. And so it looks to me like they're creating kind of a black box. And nevertheless, we've seen a lot of movement in the stock overnight and today, as is the case, as is the norm with GameStop. But I want to point out this 150 level, that is an important support level that is now broken, needs to hold. Ideally, we'd see a pop over this level into the close. Otherwise, probably looking at more downside. And I do want to point out too, interesting tidbit in the GameStop 10Q that came out. They basically said that, and this is a risk factor, that a short squeeze could, quote, dramatically increase the price and, quote, continue to lead to volatile price movements in shares. A lot of Reddit traders seeing that as some kind of tacit announcement or maybe kind of hinting that there could be another short squeeze. I've written these reports, many of them over the years, and they're just covering their bases. I don't think it means that much, Alexis.
All right, before we let you go, our Yahoo Finance Plus investment idea of the day is Netflix. Tell us why.
That's right. This is Argus Research with a report on them. And let's take a look at the stock. Now, they have a new price target and a buy holding. That is a long-term target of $650. So this is our newly rebranded Yahoo Finance Plus service. They're saying Netflix continues to produce popular original content while also expanding globally, adding new subscribers and strengthening its industry position. We believe that it has sustainable structural competitive advantages in the streaming video space. So let's take a look at what that 650 target means, substantially above the current price here. We've seen year to date kind of going sideways here, but that 650 target would be somewhere in the realm of up here. If you guys can see that, Alexis.
All right, excellent. Thank you so much, Jared. All right, time now for our ETF report brought to you by Invesco QQQ. I want to welcome in Todd Rosenbluth. He is head of ETF and mutual fund research at CFRA. Hey, Todd, good to see you. Look, before we get to ETFs, I wanted your thoughts on the market activity right now. Would you say what we're seeing is sort of end of quarter positioning? Because the best performers quarter to date are getting sold right now and some of the worst performers are rallying. It looks like sort of the classic end of quarter repositioning to me.
I think some of that is the case. We certainly saw the growth stocks that led the market to begin the year have been paring back, and now we're starting to see a shift towards value and more cyclical sectors that you touched on earlier with the prior columnist. And so what we're seeing is, I think, a repositioning heading into the next quarter with the signs of the economy improving, some profit taking on some of those high growth companies that worked out very well to end 2020 and to begin 2021.
All right, let's get to these ETFs now. I was reading through your notes and you say something called semi-transparent ETFs are growing in popularity. First off, tell us what they are and why are they so popular right now?
So these are relatively new products that are similar in style to a mutual fund in that they're actively managed and they disclose their holdings on a quarterly basis of full holdings. And they're run by firms like American Century and Fidelity and T. Rowe Price, Invesco. These are some of the firms that have launched the products within the past year. We're actually about to hit the 1-year anniversary of American Century launching products at the end of March. Collectively, these products have about $1.5 billion in overall assets. But what's exciting to us at CFRA is Charles Schwab recently published a study that indicated that investors are increasingly looking at these semi-transparent active ETFs. They've only been around for a year. They're much smaller in size. They're newer. They're a little bit more complicated. And yet these younger, more self-directed investors are willing to take a closer look. And that's encouraging to us for what it bodes for the future, because many of these products are not available on various advisor-based brokerage platforms.
Right. I want to talk a little more about that younger investor, as you put it, because it looks like ETFs are becoming a bigger and bigger part of the portfolio of millennials going forward. What more can you tell us about that, sort of even anecdotally in your own business? And then which ETFs seem to be taking hold with the younger generation?
Right. So again, using the Schwab data that they published, it was 22% of boomers, or the boomers portfolio was represented by ETFs, about 22% of the pie, whereas it's 33% for millennial investors and 29% for the Gen X that I would fall into that crowd. My nieces are more inclined to be looking at ETFs and plan to invest in ETFs into the future. So if we fast forward 5 years, they expect the millennial generation to be investing up to 43% of their portfolio towards ETFs, whereas the older generation, their parents and their grandparents, are going to be increasing usage of ETFs, but nowhere near to the extent. And you're showing on the screen some of the ETFs we think are going to gain in popularity. These are either working from home technology-oriented ETFs or clean energy ETFs that are geared towards the future, towards the potential opportunities for Biden administration and the world to be investing more on solar and wind and other clean energy technologies. So ICLN is an iShares product. CLOU is a Global X cloud computing ETF. We think thematic investing is going to gain in popularity as the younger generation is more comfortable with ETFs. Instead of picking an individual stock or two for the future, they're more likely to take that thematic approach with ETFs.
You know, now that we've got that $1.9 trillion stimulus package passed, it looks like the Biden administration will be able to focus a little more on infrastructure. We've all been waiting to hear the particulars of their plans. Are you seeing ETFs around themes of infrastructure gaining some momentum lately?
We are, and we think that's a great area of focus as well. So Global X, again, has an ETF. The ticker is PAVE, P-A-V-E. You got to love the tickers. They really paint a great picture.
You do.
This is a U.S. infrastructure-oriented ETF that we think that has been gaining in popularity. We think will continue to gain in popularity as infrastructure is, along with clean energy, a priority for the Biden administration. It's likely to be the next key legislative agenda to be tackled in 2021.
Tell us the latest on actively managed ETFs, because I think overall, if you look at the entire pie of ETFs, they really represent a pretty small slice, but they're growing in popularity. Is that what you're seeing?
We are. So thematic, which we touched on, and then actively managed ETFs. Active ETFs are about 3.5%, 4% of the overall ETF universe, but we're seeing not only more firms enter the market with active equity strategies that are fully transparent. So JP Morgan, for example, has been rolling out new products that we think are particularly compelling. ARK is the most popular of the products. So ARKK and ARKQ and ARKW are some of the examples of these high flying in 2020 actively managed equity ETFs. And again, using that Schwab study, hopefully it's accurate, but that Schwab study indicates actively managed ETFs are more popular than the traditional market cap weighted ETFs. And ARK Innovation, ARKK, is one of those leading ETFs that's seen strong inflows in the past year.
All right, we're going to leave it there. Todd Rosenbluth of CFRA, thanks as always. And coming up next, we're going to meet Prince Harry's new boss, the CEO of BetterUp, joins us right after the break. Welcome back. Well, in case you haven't heard, Prince Harry is joining the American workforce. The Duke of Sussex just landed a job as Chief Impact Officer at BetterUp. That's a Silicon Valley-based health tech company that offers professional and mental health coaching. Joining me now is the CEO of BetterUp, Alexei Robichaud. Alexei, good to have you here. You know, when I was preparing for this interview, I thought, you know what? You're now the boss of Prince Harry. How does that feel?
Well, thank you. Thanks. It's delightful to be here. I don't think of it that way. We really view it as a partnership. He's together with 300 other BetterUppers helping us to build our mission. But to the heart of your question, it feels awesome. And we feel extremely honored and delighted to get to work every day with such a luminary and to bring our mission to life and positively impact the lives of millions of more people worldwide.
So tell us how this all came to pass. Was this a position that you were actively looking to fill, or it was one that you created especially for the Prince?
Sure. Yeah. So my co-founder, Eddie, and I had long thought and discussed almost as a faraway dream that, hey, we know so much of our success of achieving our mission is really changing this global dialogue and reframing the way we as a society think about mental health to not just be the removing of mental illness, but to really include peak performance and human potential and the idea that you can proactively and preventatively cultivate health and performance. And so we thought, you know, loosely, maybe one day it'll make sense to have someone help us in that venture and that part of our mission as we grow as a company. But really, it came organically, specific to Prince Harry. We got connected through a mutual friend who had an inclination that we would hit it off, given his life's work has been so focused on mental fitness and mental health. And so we just started conversing really with no big agenda of just like, hey, you two should talk. You should see if there's any chemistry and energy here. And as we began to spend more time together, it was pretty clear that there was a lot of shared passion and energy around BetterUp's mission and his mission of advancing preventative mental health worldwide.
So I want to be a fly on the wall of that conversation for a minute, Alexei. So what happens? You actually say, hey, you know, we have this idea. Why don't you come on and join us at BetterUp? Or does Prince Harry say, I'd love to work with you guys? Because I know that he was also a client. Wasn't he a client of yours as well?
He uses the app.
He did some of your services.
Yeah, he uses the app. He's been very public. We have a post from him on our company blog. He shares very openly about his experience and how helpful it's been to him. So I think, you know, before, obviously, I knew more about him than he knew about me going into the conversation. And as you can imagine, I think our mutual contact, he had already shown him BetterUp and he was really excited and just thrilled that a company existed. He had been doing work in mental fitness in the nonprofit setting, but was really thrilled to know that someone was doing it in a conscious way using, you know, a commercial structure. So the first conversation really was more just about share your philosophy, share your worldview, get to know one another. And from there, I think really we very quickly as both doers started to roll up our sleeves and sketch out like where could he add value and what could we help. But I will say, you know, going into that conversation, I had never talked to someone of his background before. And I was just blown away by his authenticity and his genuine desire to be of service and make sure that he was adding meaningful, measurable value to the organization and to our cause.
So is there going to be a typical day for Prince Harry with BetterUp? I mean, is he going to come into the office? I mean, I know right now we're living in strange times, but sort of what will his duties be like? And is he going to have a team reporting to him?
Sure. So I would wager he hasn't had a typical day in his entire life. Right. And so he'd have to answer what a typical day for him looks like. But look, as you know, he has other commitments as well. And so we've been very thoughtful in designing his roles and his responsibilities at BetterUp. At a high level, his remit or where he's focused as a chief impact officer is around guiding our social mission, expanding the global community and the conversation around preventative mental health and the power and impact that coaching can have on helping people realize their potential, influencing the vision and the experience of our members or what we call our users, he himself being one, right, first and foremost, and then also bringing through partnerships like we announced with Peak State, whether that's content partnerships, ecosystem partnerships, customer partnerships, helping to enlist more causes and more connections in creating more experiences worldwide. He won't be managing a team. He's a talented, capable manager, but we really wanted to focus his time and impact on where he could be of the highest leverage. And it's really helping us on these matters of corporate strategy, of product positioning, and of building that ecosystem and that partnership.
Is Prince Harry investing in BetterUp in any way or getting an equity stake in the company as part of working with you guys?
Sure. As you can imagine, as a private company, we don't discuss compensation data with, publicly, but I think it's fair to say he is deeply invested in the success of the mission and the success of the business. And we're delighted to build Better Up together with him.
What does bringing somebody like Prince Harry with his celebrity into the fold mean for your company, for your brand, for name recognition? I mean, you have to your name has been everywhere the past 24 hours since this announcement was made.
It's been surreal, I would say. And what's really interesting is we'll take the PR. It's helpful, but it's really about Harry. Like, having had the opportunity to get to meet him, he has such a unique journey he's been on, and such sharp insights into where we can improve together as a society here, and how we can use what we have at Better Up, technologists, scientists, coders, programmers, artists, to bring that to life. That's where we spend most of our energy and effort, is really focusing on how we can optimize those insights and creative contributions. But certainly it's been amazing as a founder just to see more people know about Better Up. But even more importantly, I think both for me and for him, it's not about Better Up. It's really about this mission of how do we normalize that it's okay to be vocal and loud about your growth and development needs, and that we should be more conscious about mental health, not just as the removal of illness, but really about an area in our life, just like physical fitness, where we can proactively and we can consciously invest and we can see improvements. And that's, I think, where I take the most pride, is that, yes, people are talking about Better Up, but more importantly, they're talking about themselves. They're talking about some of their struggles. They're talking about where they can improve. And if we can do that together, then we've achieved our shared mission.
I know you closed your latest round of funding last month. You've raised about $300 million so far. You have a valuation of more than $1.7 billion. I have to think there's been talk there about going public. Are you any closer to becoming a publicly traded company? And any thought as to how you're going to do it? A SPAC, a direct listing? There are myriad ways of doing it these days.
Yeah, when we started Better Up, there was only one way, right? So we get closer every day. I think that's the exciting part about where we are in our journey. For us, going public is a means to an end. Eddie and I have been clear from day one that we want to create a company that lasts for generations. Just to support one of our users through their adult development journey would take 40 to 60 years, right? And so we're trying to build a 100-year-plus company here. And we do believe to do that we need to be independent, and we need to have the moral agency to really prioritize the well-being of our members and take care of them as good and proper stewards of their data, of what they confide in us, and of their care. And so we really view going public one day as a means to that end, and we back into that. So we don't know yet how we'll go public. We can figure all that out later. We'll certainly share with you at the time, but absolutely, if we do our jobs well here, Better Up will be an independent public company for decades.
All right. And, just about anything Prince Harry does makes headlines, for better or for worse. Are there any concerns that, some of those headlines may come back and somehow be associated with Better Up, because now you are, in business with the prince, so to speak? Any concerns about that?
You go into these things, I think, eyes wide open, and really where we've been focused is what's the impact, what's the good we can do together in the world. So we've been almost, I would just say, maniacally focused on that, and really zeroed in on how do we continue to impact the experience, how do we continue to impact the lives of our current users, and how do we get that to millions, if not billions, of users in the coming years. So that's where all our energy, attention, and effort has been.
All right, Alexei Robichaud, CEO of Better Up. Best of luck, and do come back when you decide to go public. Thanks so much.
Thank you so much.
All right, coming up next, the latest on the COVID-19 vaccine rollout with Dr. Stephen Corwin of New York Presbyterian Hospital. as more Americans are vaccinated and talking about post-pandemic life, new cases of COVID-19 are ticking up in different parts of the country, including in New Jersey and parts of Pennsylvania, as variants of the virus spread and people eager to take advantage of this warmer weather begin to let down their guard. Joining me now is Dr. Stephen Corwin. He is president and CEO of New York Presbyterian Hospital. Doctor, good to see you again. So how much are these new variants playing a role in the number of new COVID cases that you're seeing?
Yeah, we've seen a very slow decline in cases, and we believe that's mainly due to the variant, the New York variant, South African variant, and the British variant. And that's a critical point of information, which is we're still seeing a lot of cases. We still have a lot of cases in our ICU, and the decline has been slow. So we're playing off how many people can we get vaccinated versus how much would the variants take hold. And so I still think we need to be careful. I think we are slowly opening up. My guess is by summertime we'll be roaring again, but now is not the time to let down our guard.
You know, I mentioned New Jersey and Pennsylvania in the lead-in. Governor Murphy there in New Jersey was lifting restrictions, but he said he's going to pause those now because new cases of COVID-19 are rising in his state. But yet you have Governor Wolf over in Pennsylvania going to roll ahead with lifting restrictions come Easter weekend. Do you think that it's a little too soon to be doing that?
You know, I think that we've been balancing out how much opening can you do versus how many cases do you see. I think if you see a positivity rate like in New Jersey that's gone over 7%, you got to be really careful. If you have a positivity rate in New York State that's less, you can be a little less careful. Certainly in the city, we're at around New York City, we're around that 5% range, 4.5% or so. So you really have to be cautious. Let's not do so much too soon. Let's open it up a little, see when you open the spigot, how much good is happening versus how many infections you have. I was not in South Florida this past week, but I think the Miami Beach experience looked to me like that was probably something we don't want to replicate.
You know, there are a couple of new Harris polls out with somewhat discouraging news, and I'd love your take on this. One of the Harris polls found that of people who have not been vaccinated yet, 40% of them say they don't want to get the vaccine. The majority of them, more than half, are Black people. What would you say to them? A lot of these people are saying that they're concerned about side effects, and they don't believe that that this vaccine is really going to make a difference for them.
Well, we've done a lot of work on vaccine hesitancy, particularly in communities of color. We have some videos on that. A lot of this is education, one-on-one education, trusted community organizations, trusted faith-based organizations, and really dispelling fears. You have a lot of misinformation, unfortunately, on the internet. Some of this has been politicized, but I think you can get there. And certainly with communities of color, the question is, was this developed too soon? Are you experimenting on me? What are the long-term side effects? And that's pretty much true of everybody, really. We're seeing some resistance in white, rural, blue-collar demographics. So it's one-on-one education. We have to vaccinate the vast majority of Americans to get the herd immunity. Otherwise, we're going to be circulating this virus, and more potent mutations will come out of this. So we really have to defeat vaccine hesitancy.
You know, this other poll that came out showed that of those who have gotten the vaccinations, meaning fully vaccinated, about 25 to 30% would wait until the nation reaches herd immunity in order to go to restaurants and dine indoors, in order to fly again. Are those folks being too cautious, or they're doing the right thing?
You know, my view of it is I would be more conservative rather than less conservative. Let this play itself out. We're getting close to 3 million vaccinations a day now. The J&J vaccine is being distributed. The production of all the vaccines will ramp up. So for myself personally, I would prefer not to go out and do indoor dining until the June or July timeframe. And I would prefer not to fly commercial. Now, that's my individual choice. Many people have to fly. Many people have to work. We want to see the restaurant industry recover. We want to see the airline industry recover. I would just urge people to be more rather than less cautious. If you don't need to do it, don't do it. If you don't really need to fly, don't fly. Don't take the vaccination for yourself individually as a passport to do exactly what you were doing pre-COVID. That's sort of where my head is at on this.
You think we can achieve herd immunity by the summer, though? Are you pretty hopeful about that?
I think the trajectory I saw would be in the July-August timeframe if we continue to ramp up production and we eliminate some of the vaccine hesitancy. So yes, and I think if we get down to a low level of infection that's suppressible, then I think that the herd immunity, the vaccinations will take effect, and we'll be much better off as we get to the end of the summer, into the fall, and then hopefully we'll have a holiday season where people can get together this year and really feel a lot more comfortable than what we've been through, which has been horrific, as we all know.
We're all hoping for that. Dr. Stephen Corwin, President and CEO of New York Presbyterian Hospital, thanks so much.
Thank you, too.
Coming up next, the impact this pandemic is having on the commercial real estate industry. A skyscraper-sized container ship has become wedged across Egypt's Suez Canal and blocked all traffic in that vital waterway, threatening to disrupt global shipments. We want to check in with Jared Blickery now, who has got the latest for this on us. Jared?
That's right. A very important shipping route, and it is putting a bid on crude oil prices, but we're backing off some of those gains right now as it's coming to be believed that we'll get that skyscraper out of the Suez Canal. It was only yesterday that we had crude oil entering correction territory, closed below its 50-day moving average here. That's the blue line. But easy go, easy come. We're right back up to yesterday's highs, just off of them slightly on that news. I do also want to do an update of a story that we talked about 30 minutes ago, and this has to do with the cruise lines. They had been petitioning the government, the CDC, for some guidance to help them reopen a little bit earlier than expected, but the CDC responded and said, we're not going to move until November 1st. They were up. We were looking at gains of about 5%, 6% for most of these guys, and you can see what happened right there, Alexis.
All right, thanks so much for the update, Jared. One thing is clear over this past year, COVID-19 has fundamentally changed the way a real estate business is being conducted. The demand for space has been impacted by social distancing, shutdowns, quarantines, remote work. Here to talk about the changing landscape of commercial real estate is Angel Bruner. She is founder and CEO of EB5 Capital, which is a commercial real estate investment firm. Angel, it's good to see you. What have you been seeing in your business in terms of demand for commercial real estate and also the prices for that real estate?
Thank you for that question. Well, the prices for commercial real estate are not where they were in 2019 because prices are set by the operating income of the asset. So we really have a fall off, and the buyers are the winners. The folks that are selling are really in a forced sale situation. It's not the ideal time to sell. Our office, we closed it immediately in March, and we have not been open, and we don't know when we're going to open. But as a microcosm of the issue, we have decided to take more space, because when we return to the office, we need to socially distance, and then we need more space to socialize. So I think as we see businesses return to offices, it's going to be interesting to see what they do in terms of the commercial space that they held previously and how they use the commercial space they have and if they expand.
Where are you focusing your real estate investments right now? And in terms of even geography, what states, what cities are you looking at?
Well, that's a great question. So for the very first time, we're at 10 years operations, about 30 deals, and we're looking at one of our first suburban deals right now. And part of that is because we're seeing an expansion of people staying in the suburbs, and the center city is going to come back maybe at not the same pace. So we're definitely watching how the center city returns, and we're starting marketing in the suburbs.
What about, a lot of people said that New York was going to be down and out, unable to recover. What are you seeing in the New York commercial real estate market right now?
Yes, well, I have a large project in New York, and I would say I would never bet against New York. I'm in that group that I just don't bet against New York. So I think New York is going to come back. It's going to come back as fast as it can. I think a lot of people miss New York. I, for one, miss New York. I miss Broadway. I'm not alone, I'm sure. And New York's going to come back in waves. You're going to have to get people coming back to the office. You're going to have to get people coming back to their apartments, and you're going to have to get people coming back for tourism. And so New York is going to come back in waves, and it might take a while as one of our largest cities.
I'm with you on that. As a native New Yorker, I never bet against New York either. I too miss Broadway. But what about, we have so much commercial real estate in this city, in New York, and skyscrapers that are just sitting with, 20% occupancy, if not less right now. Is it ever really going to return to pre-pandemic levels, or is that landscape here in a city like New York just changed forever?
Well, I do think that we will find a new normal, that we've found some efficiencies in the pandemic that we won't let go of. I think that we all have to accept that there are certain meetings that we're going to attend on screen and that we're not actually going to get on a plane to attend them. And that will be part of the new normal. But I also think that people miss their coworkers. I know I have this at my company where my coworkers actually enjoy each other. My team enjoys each other, and they miss each other. And so they want to socialize. They want to be in the same space, but they want to do it safely. And so as an employer, you have to ask yourself, how are you going to make that possible? And for us, that answer is with more space, not with less.
Yeah, not everybody can do the more space, because more space is more square footage, presumably, and more rent. Where are you seeing the best deals right now in terms of commercial real estate? What are some up and coming areas that people might want to look at?
Well, your last guest mentioned spring break in Miami, and the leisure markets are coming back faster. I'm even seeing hotel deals shop to me in the Florida area, in the Miami area. People are looking at acquisitions. They're looking at building. They're looking at being in that market long term. You have to remember all the demand that places like Miami are seeing is independent of international demand because of the existing travel restrictions. So you're going to see even more demand. And places where people can enjoy a lifestyle are really booming right now, where they can enjoy living and working. And that's a new equation. It used to be that you could tell talent where they had to move for a job. And I think you're going to see a lot of pushback on that. And you're going to see a lot of growth in places where people can enjoy a lifestyle.
Yeah, I think you're right on that one. Angel Bruner, CEO and founder of EB5 Capital. Thanks so much for being with us today. And coming up next, we're going to speak with the CEO of Bethel Woods about their concert venues reopening this spring. We know the pandemic has wreaked havoc on the concert industry, but there are signs of hope. Bethel Woods, the iconic site of the 1969 Woodstock Music Festival, is reopening its museum in just a couple of weeks, and it's planning to reopen its outdoor concert venue in the coming weeks. Joining me now is the CEO of Bethel Woods, Eric Francis. Eric, good to see you. So I was looking at your concert calendar. It's pretty ambitious. You got some great acts coming up. James Taylor, Steely Dan, the Black Crows. I know these are still a few months away. Have you started to sell tickets for those events yet? And if so, what has demand been like?
So those shows are actually ones that were booked last year and were postponed because of the pandemic, but they are still on sale. We're working closely with the state of New York, the Department of Health, to concrete our plans in for this summer, but our hope is that we will be opening this summer at some point safely when we can do so.
I'm sure you've given a lot of thought as to the mechanics of reopening. Can you share with us some of those plans? Will it mean that people who buy tickets and come to concerts will have to show proof of a negative COVID test, for instance?
Well, our hope right now is that as the vaccinations are rolling out and continued lower rates here in New York, that hopefully at the end of May, some of those requirements will go away, because it's a very difficult thing to require those on the mass scale when you're trying to do a 16,000 person concert. So our hopes is that that will go away, but I think we will clearly try to operate as safely as we can when you're trying to deal with lots of people, but keeping people spaced out. And we've always been very good at cleaning the venue, and those types of measures will be in place. So, I think we're ready to do it. We have many different plans based on what comes down from Albany in terms of regulations.
hmm I mean, I've been to your venue. It's beautiful. You're lucky that it is an outdoor space, so that's helpful right in and of itself. But in very much the same way a lot of sports stadiums are doing it, are you selling tickets right now spaced quite a bit apart so that there can be social distancing?
Presently not, because most of the shows were already, some of them were already sold in 2020. However, we do have multiple plans on how to open if we were to reduce capacity. So yes, we're very lucky that we're an outdoor venue and that we have a very spacious lawn so that we could put people in pods and quarantining pods, families and things. So we have all those plans in place. We just need to really know where we're going from the regulation side before we can roll those out.
I'm curious. So I know a lot of these acts, and in fact, most of them were supposed to be happening in 2020. You've now rebooked them for now. So you do have folks who presumably held on to those tickets. Are you hearing from them? Are they planning on attending, or have they just said, you know what, nope, we're going to sit this one out?
I think we're hearing a lot of positives, especially lately, as you had referenced before. People are still buying tickets. So we have seen a lot of positivity coming out of the marketplace. And just last year being closed, at least from the concert side of our business, we've heard from those concert fans saying we didn't know what we had until it was gone. So we believe there is pent-up demand and people are very excited to return to live. And it's very important, not only just for our community on an economic basis and the artists that need to work. Many of them could not afford to take a year off. But there's also the mental health issues that we're seeing. And I think only people coming together and the arts can solve some of those problems.
Now, of course, you're at the site, like I said, when we started the piece of that iconic Woodstock Music Festival back in 1969 in bucolic Sullivan County. What does coming back, what does the venue, Bethel Woods, reopening mean to the larger community there in the Catskills?
Well, it's the cornerstone of the revival of the Catskills, which saw its decline through the 60s and 70s as the major Borscht Belt hotels closed. But this was the starting point of the growth of this area again. And I feel as though COVID proved that people from the city came up here. They've been up here since last year and they've stayed. But Bethel Woods was that beacon of hope that brought people here, showed the world what was here. But it's an important economic driver for our region. I mean, since the first shovel hit the ground here for construction in 2004, it's been $600 million plus to the economic output in New York State. So it's big. It's big for the community, restaurants, and the like around us.
In sort of the 40 seconds I have left, I know you're a non-for-profit. Having to shut down last year was very painful for you. In what ways did you pivot so that you could still have the business survive?
Well, we were lucky enough to have great donors, season-long ticket holders and members who, supported us to keep us alive. We did a couple of different things this year, like launched a holiday light show that we plan to grow in the future where people can drive through, and it was very safe, but we want to grow that. And we did things that we were allowed to do, like farmers markets and dinners at a small scale. So we pivoted to do the things where we could, jumped online where it made sense. But the future has to be reopening in order for us to be viable.
Well, we're certainly looking forward to those concerts coming back online. Eric Francis, CEO of Bethel Woods, thanks and best of luck to you. We've got more Yahoo Finance Live to come right after this. In today's Your Money segment, widespread job loss has forced some Americans to dip into their retirement savings to make ends meet during the pandemic. In fact, a new study from Fidelity shows more than 8 in 10 Americans say the pandemic has impacted their retirement plans. Joining us now to discuss is Stephanie Asimkos. Stephanie, it seems like a lot of people say they might not be able to financially recover from this for years.
That's right. We're entering month 13 of the pandemic right now, and Americans say that it'll take them between 2 and 3 years to find their financial footing again, particularly when it comes to retirement planning. However, the optimism is still there, though. The vast majority of the survey respondents said that they'll be able to retire when and how they want.
And what about in terms of what people are saying about resizing their 401k to sort of match their age, if you will, because we all have different time horizons?
Of course. So I connected with a retirement expert at Fidelity, and he was very encouraging and said that really, like, no matter where you are in your professional career or your age, that there's really not a bad time to start saving. No time like the present, basically. So with that said, the advice that he gave me that I can share is that if you are a millennial or a Gen Z, really what the best thing that you can do is retirement planning is to just pick a number and go from there. It can actually be that informal. And another thing would be to familiarize yourself with the different types of investment accounts that exist. If you are a Gen Xer, you're getting a little bit closer to retirement. And the best thing that you can do is to identify where your income streams are going to come from in retirement. So be it investments or Social Security, and then just kind of play around and figure out what you want your lifestyle to be when you get to that stage. And the best thing that, this source said to me is to come up with a financial plan. It doesn't have to be so daunting, and to just visit it regularly.
All right, Stephanie Asimkos, thanks for that sound advice. Appreciate it. Coming up in the next hour on Yahoo Finance Live, Dan Gelber, Miami Beach's mayor, on the spring break madness wreaking havoc on the city. We're going to have Adam Shapiro and Shauna Smith join us to take you through the final hour of trading right after this.
It is Wednesday, almost to Friday, 2 days to go. Miami Beach extends its curfew through April 12th to force spring breakers to obey the law. Mayor Dan Gelber will join us to update the ways Miami Beach is trying to keep the annual spring break celebration from becoming a COVID-19 super spreader, as well as the potential for casino gambling on Miami Beach. Who says bipartisanship is dead? Virginia Representative Abigail Spanberger leads the effort to change the law so young women and men can use 529 savings plans to pay for workforce training. Republicans are signing on to the Democrats' bill, and she joins us to discuss how soon it could become law. And then Playboy Group CEO Ben Cohen will join us to discuss how the new publicly traded company plans to grow beyond the legacy magazine as it releases fourth quarter earnings. We're an hour from the closing bell. I'm Adam Shapiro.
And I'm Shauna Smith. And Adam, taking a look at today's market action, a bit of a mixed picture here. The Dow is holding on to gains, although we are off the highs of the day. The Dow now up 123 points. S&P and NASDAQ, though, you can see it on your screen. Those two averages are in the red. S&P not too far from the flat line. NASDAQ, however, off just around 1.3%. A lot of that has to do with some of the selling that we're seeing in big tech. Big tech is underperforming today. Names like Apple, that stock off just around 1.5%, and Facebook off more than 2.5%. We want to help break down today's action for that. We want to bring in Gabriela Santos. She's a global market strategist with JP Morgan. And Gabriela, it's interesting looking at today's action because we're seeing big tech under pressure, yet we're seeing yields, a 10-year yield, retreating a bit. Help us understand what's going on today and what's driving the action.
Ultimately, I think we're just seeing a pause in the correlation between treasury yields and growth versus value. So it's a bit of a pause from the trend that we were seeing over the past month and a half. Way too early to know if that's really a trend. We don't think so. We think long-term bond yields are just in a pit stop here in what's going to be a multi-year move higher. And ultimately, we do continue to think that will harm the more speculative or expensive parts of the market like tech and really benefit the more cyclical and especially the parts of the market that can benefit from a steepening yield curve. And we would put financials and energy in that camp as well.
Good to see you, Gabriela. And I am curious if you can help us understand something you pointed out, that we are in the danger period for fixed income. Most of us, when we talk about fixed income, we're not really buying individual bonds. We might be buying a bond fund, or we turn to someone like you to help us purchase different bonds in a ladder strategy. So when you say we're in a danger period, what does that mean for most of us in the real world?
Yes, this is really, really important time to think very actively about the approach to fixed income. So we're in the period where yields were extremely low, and now they're in a multi-year period of moving higher. That's a period where bond yields move higher. That means prices move lower. Eventually, we'll settle at a resting place and we'll have a more positive outlook for fixed income. But right now, it's a period where we expect to see negative capital gains, especially in your higher quality part of fixed income. One could call this a period of a bear market for fixed income. And if you do have a passive approach, for example, buying an ETF or a fund that just tracks the Bloomberg Barclays Ag, you're extremely exposed to this danger period because you have very high duration of 8.4 years in that kind of product. That leaves you the most exposed to this danger period in over 30 years. So it's really important over the next couple of years, starting now, to have an active approach to fixed income, a manager that's shorting duration. We feel particularly comfortable below 2 years, where we see the curve anchored and yields staying low, as well as more extended parts of fixed income, where at least you have a coupon that can help you to cushion a bit of the fall in capital gains.
So Gabriela, as we try to figure out exactly what's priced into the market at this point, when it comes to higher yields, you're expecting higher yields. We've talked to a number of our guests here on Yahoo Finance recently who say that the 10-year yield is going to continue to push higher. So what's priced in? I mean, if we see the 10-year yield at 2%, how do you expect equities to react right now?
Yeah, so I think we should really remember we started the year with 10-year yields below 1%. That was not a good sign. So it's actually, in terms of risk assets, a good thing to see bond yields move higher. That's really on expectation of reflation, improving inflation, improving growth expectations, returning to normal. And I think really what we've seen this year is that actually reality has been even better than our expectations were coming into the year. So we have a strong growth surge up ahead, and a 10-year yield below 1% no longer made sense. With that said, we're still at 1.6%. That's still incredibly low. So that's why we say we still see the move as sequentially higher, ending the year at 2%, perhaps higher, and then continuing to move higher in 2022 and 2023 before getting to a normal or neutral resting place, which would be a 10-year closer to 3%. So we took a few steps, but what's ultimately still a long journey up ahead, something that can be good for parts of the equity market, but parts that can be very dangerous for your most expensive assets as well as for fixed income.
But if I'm hearing you correctly, and maybe I'm asking you to repeat, your time horizon, what I just heard was, look, there's no reason to make an abrupt decision this year or perhaps even next year, because inflation's not going to get out of control. We're going to settle most likely, as you point out, in about 2 years with the 10-year around 3%. I mean, inflation would have to really be going gangbusters for the Fed to step in and interfere, wouldn't it?
Yes, and here so far, I just want to clarify that I'm talking about long-term bond yields. So talking about the 10-year, the 30-year bond yields continuing to move higher. And this doesn't require any sort of inflation surge, really just a return to normal levels of inflation and growth. Very different discussion when we start talking about very short-term yields, the ones that are controlled really by the Fed and Fed interest rate policy. There, we do not see reason to believe the Fed will really start raising rates before the end of 2023, exactly because we don't see as our base case a surge in inflation. Now, we do see more two-sided risk about inflation, and that is a change. Before, it was all just inflation surprising to the downside. Now it's more two-sided risk that can keep the bond market a bit volatile. But as a base case, we don't see a surge in inflation. So it's a story about the curve steepening rather than the entire curve moving higher.
And Gabriella, it's not just inflation. I mean, it's always something that investors think of as the next big worry. But then there's also talk just about higher taxes, higher corporate taxes specifically, and what that means for corporate profits and whether or not, I guess, how big of a headwind that could potentially be here going forward this year. What are you expecting on that front? And I guess how big of a risk is higher taxes to earnings right now?
Yeah, so of course, investors always asking what's next. So we did pass the American Rescue Plan, and we think that's fully absorbed at this point in terms of economic expectations and market performance. So it's all about that next fiscal package, the Build Back Better plan. I think it's still very, very early days in really understanding what's going to be included in the package. In terms of general outlines, it seems like there will be spending geared towards physical and digital infrastructure. There will be measures aimed at lowering income inequality. And there might be some revenue-raising measures, such as higher corporate taxes. But that's as much as we know at this point. So we'll be really looking at the weeks and months ahead to get better information. In terms of earnings, of course, higher taxes would need to be factored into expectations for earnings in the future, which would need to be lower. But we talked about spending measures, so you can get it some of an offset in terms of higher growth and higher earnings. So ultimately, when we get more details, it's likely to be a mixed bag with implications much more at the subsector level rather than something that impacts the entire market as a whole.
Always good to see you. Gabriela Santos is a global market strategist at JP Morgan. Thank you for your insight today. When we come back, leisure and hospitality, transportation, utilities, even wholesale and retail trade, there is a hiring surge that is expected to be coming in the next couple of months. We're going to speak with the CEO from Manpower right after this.
Welcome back. Let's talk about the outlook for hiring and how employers are preparing for the future of work. And for that, we want to bring in Jonas Priesing. He's the CEO of Manpower Group. And Jonas, great to speak with you. We're excited to have you on the show. I know Manpower was just out with a recent survey discussing this, and looking at the results, it actually looks pretty upbeat. I'm curious just to get your take just on what the hiring plans look like for this year, because when we take a look at the economic recovery, at least the labor market has been lagging just a little bit.
That's true, Shauna. The labor market has been lagging somewhat, but we've still made up more than half of the losses that we saw in the labor market here in the U.S. So far, with significant improvement to come, I believe. So if you look at our global hiring outlook for the next quarter, we can clearly see that there is hiring optimism all over the world, but the U.S. stands out in its hiring optimism, and we are looking at a very positive outlook into the second quarter. And we think it's especially the industries that have been impacted the hardest during the pandemic that will be the next wave of job creation. So leisure and hospitality, e-commerce driven jobs, logistics, and things like that.
Some of the statistics that you shared with us, for instance, 52% of those responding expecting pre-pandemic hiring levels to return before the end of 2021. When you've done these kinds of surveys in the past, what's the accuracy? Because I think a lot of us want this to be very accurate.
Employers tend to do what they say they're going to do is what they eventually do, unless something materially changes. And we've been doing the survey for over 50 years with 60,000 employers globally. So it's proven to become a very good trend indicator of where the labor market is going. And I think based on what we're seeing, both in terms of the survey that we've just done, but also in terms of what we're seeing in terms of the rate of vaccinations, and here the US, we're doing very, very well compared to many other parts of the world, we can clearly see that there is a increasing optimism on behalf of the employers, and we expect that to translate also into significant hiring improvement over the coming months and over the coming 18 months.
Lots of questions just about vaccination policy as we prepare to get more and more people back to work, and whether or not employers are going to mandate COVID vaccinations. Is this something that you think the majority of companies are planning to do?
Actually, our survey, Shauna, tells us that employers don't intend to mandate vaccinations. They tend to encourage vaccinations. And as you've seen, some employers are including monetary benefits for those that decide to vaccinate themselves, but they're leaving it to the employee as a personal choice. But I would say general employers are encouraging vaccinations, and I would say certainly that is exactly the position that I take as well within our organization. We are strongly encourage our employees to do it. But it's going to, in the end, be their personal choice on whether they want to do it or not.
Were you surprised that, as far as new ways of working, 56% expected employees to be back in the workplace most of the time? We're hearing lots about the hybrid 2 days off, 3 days in, but does that figure seem high to you, 56%?
Well, a little bit of context, Adam, might be helpful. So first of all, in our labor market, 60% of the jobs cannot be done remotely. There are service jobs, there are manufacturing jobs, there are delivery jobs, there are all kinds of jobs that cannot be done remotely. So only 40% of the workforce can be working remotely. And what's clear through the surveys that we're making with employers is that the vast majority of employers expect their employees to come back in one form or the other when the pandemic takes a step down to the workplace. So there's actually a very small part of the employers that say, no, we are going to be implementing remote working on a permanent basis, go forward, a business model. And I think that's pretty symptomatic of what we're experiencing. We can work remotely in many cases, at least the 40% of the workforce can. But the idea that we should be together at times to get more interaction with our colleagues is also deemed to be beneficial. And I think that's sort of what employees are preferring, but they also want the flexibility, and it's clearly what employers are saying that they would like to see happen.
Jonas Priesing, great to speak with you, CEO of Manpower Group. We're going to take a quick break, but when we come back, we're going to talk to one international soccer star. He's looking to help investors become millionaires, doing it through investing in real estate. We've got that for you right after the break.
All right, when I was a kid, we used to play water polo against North Miami Beach, but it's Miami Beach that everybody's paying attention to right now. It's not only one of the most fashionable and hot destinations for spring breakers, it's where a lot of retirees like to finally say, ah, the good life. But there's a lot on the horizon that we're talking about. And to do that, we're going to invite into the stream Dan Gelber. He is the mayor of Miami Beach. It's good to see you here. I'm a Coral Gables senior high grad, by the way. I remember skipping school going out to Miami Beach back in the day. But let me ask you real quick, because I know we want to talk about the casino gambling effort on the beach, but the headlines of late. What's the status now of the large spring break crowds? Are they adhering to the 8 p.m. curfew? You extended it to April 12th.
Well, the curfew is in effect from Thursday to Monday. So the last couple of days have not been curfew nights, but they've actually been pretty good nights. We have a pretty big contingent of police, but most of the time, frankly, people are pretty compliant during the day. There's really not a lot of problems, and it's a pretty restrained area of the city. It's a 4-block, essentially by 10-block area, so it's pretty limited. But it hasn't had any of the issues from last weekend, and we'll really see what happens Thursday night.
Well, Mayor, there's so much. We've all seen the pictures and the videos that have come out from your city here over the last several days, and of course, this calls into question the message that we heard from your governor, from Governor DeSantis earlier today. He was earlier this year, encouraging people to come down to Florida, saying that the state is open. How much harder do you think that's making your job right now?
Well, it's making it very hard because, when you're the only game in town almost, and we're a wonderful destination, and given the fact that almost no other destinations across the country are open, we're getting this enormous crush of people, especially when you consider the discount airfares, which are available, and discount rooms through Airbnbs. So just an enormous number of people. We were expecting a lot of people, as we always do, and we had really bulked up on police. But at some point when guns were introduced into the mix, we just decided that there wasn't a choice. We had to take even more drastic action. And of course, we're still in the middle of a pandemic, which seems to have been totally forgotten by every person coming here.
I want to shift this just slightly because this would attract lots of people. And it's the effort possibly to bring casino gambling to historic properties on the beach like the Fontainebleau. How serious is this? I thought it took a referendum of the voters in Dade County. They'd have to approve it before it could happen. Has something changed?
No, and I hope it doesn't happen, and I don't support it. I, in fact, was head of the No Casinos effort and wrote and defended the constitutional amendment that requires a statewide approval. Voters voted in Florida 71%. They hardly agree at 71% on anything, but the title of it was Voter Control of Gambling. And in fact, they supported that. This would be really an incredible move by the Florida legislature to essentially allow casinos to come into a city whose land ordinances don't allow it. My commission almost every year passes a resolution opposed to it. So we don't want it. We think it cannibalizes the businesses. We think it would distort our economy. And I don't think we need it, given all the other beautiful things we have for people to do.
Well, Mayor, I guess the other side of it was people would be saying right now, a lot of cities, they need more and more revenue. Just looking at the effects of the last year, that doesn't change your mind at all about this?
It doesn't change my mind one iota. If you can name to me the city in America that you want to be that has casinos, I'll talk about it. But we don't want to be any of those cities, Las Vegas or Atlantic City. We don't need it. We have beautiful beaches, incredible cultural destinations, incredible cultural fairs, venues all over the place, beautiful weather, ecotourism. I could go on and on. We don't need a industry that essentially sucks the marrow out of a community's a business center, and we don't need it in a place like Miami Beach or downtown Miami or in Doral, which is what people seem to be talking about. I have no idea why anybody would support this other than the people who stand to make a lot of money at the expense of all the people who lose it.
I have a vested interest in asking you this next question, since I think my future probably has me one day back in South Florida. I am, after all, a middle-aged Jewish guy. It's the promised land. What's going on when it rains? Yeah, when it rains there? I mean, my mom, my dad tell me about the flooding sometimes on Miami Beach. Is that under control, or is sea level rise a serious threat? Because I have friends who are buying on Miami Beach, and I'm like, really? Wouldn't you go inland?
So first of all, it's serious, but secondly, we're handling it. We have engineering solutions, that we're implementing. We can't talk about sea level rise. We got to do stuff because we're an island built on porous limestone that has had sunny day flooding. But we've already started to raise our roads and redo our storm system such that we can solve this problem. And we've done it in about 6 or 7 miles of roads we've raised, and we've installed generators and new pumps, water systems. And the result is everywhere where we've installed them, there's not really flooding, or it's so substantially reduced that it just is typically what you get in a bad rain. It's not the kind of sunny day flooding that's frightening. Now, a lot of other cities are way behind, and we have been the canary in the mine shaft in the sense that we were one of the first to start a program. We've spent, $600 million on it, but we're intent on solving it. We've brought in the best experts in the world to make sure we're doing it the right way. So this is an absolutely surmountable problem. And when the Community Rating Service looked at our flood insurance rates, they actually downgraded us or upgraded us so that our rates are now cheaper because of it. And our bond ratings are actually AA plus because of our efforts at all of this. So we are handling the problem, and we can't not handle it. So come on down, live here. You won't float away.
I don't think it's hard to convince many people in the Northeast here after this winter to come down and live in Florida. But Mayor, real quick, we only have about a minute left. I'm curious just to get your thoughts. You talk to business owners all the time in your city. How are the business owners faring right now? Are they past the worst of it, do you think?
Yeah, I mean, the truth is we were sort of lucky in a sense that outdoor dining was easy. We opened up roads, we created parklets. So the restaurants, a lot of them, look, everybody suffered immensely. It's hard to stay closed for half a year and not suffer. But there's a sense around here that really there's a huge momentum coming. You can feel it already. People moving down, people opening up businesses, new hotels. The Bulgari is coming, the Aman is coming, a Carbone, an Italian restaurant moved down here. This is all in the last few months. So we are very excited and very optimistic. And I suspect that Starwood is opening up their new their new offices in Collins Park. We've got a lot going on. It's exciting. And a lot of these hiccups are just hiccups. The pandemic we're going to get through, and we're going to be not normal, but better.
All right. Dan Gelber is the mayor of Miami Beach, and we look forward to visiting very soon. All the best to you, sir. When we come back, we're going to be talking about a way to help people of color get in on the real estate investments that have made so many in the country wealthy. Time for our 2 and 2. Two stocks that Shauna's watching, two stocks that I'm watching. You may want to pay attention to. You ready for this? Alcoa. That's right. Shares popped 10% in the first half of the trading session. They're still trading up right now as we head to the closing bell, up almost 6%. New note from Morgan Stanley says the stock is trading at 4 times its expected 2022 enterprise value EBITDA ratio. But historically, it's traded around 7.5 times its forward EBITDA. So they think this is a value. The note also says that aluminum is a more important commodity than, say, copper in the global effort to decarbonize. They are giving Alcoa an overrate rating. Then let's take a look at Viacom CBS. Haven't seen numbers this low since they pulled the Mary Tyler Moore show off the air back in the 70s. This stock, look, it's down about 20%. It's getting diluted. Here's what's going on. They've announced they're going to offer 20 million shares of common stock at $85 a stock, 10 million shares preferred stock at $100 per share. They hope to raise close to $2.6 billion. Don't have to be a genius to figure this one out. They intend to invest more in their streaming platforms. Shauna?
And I'm taking a look at cruise lines. There are a couple of stocks under pressure today: Carnival, Royal Caribbean, and also Norwegian. So we just got some news out that the CDC is not lifting its order. Their order is going to stay in place until November 1st. And in terms of what this order does, it limits the cruise industry's activity and creates a phased approach to return to operations. The Cruise Lines International Association, the lobbying group for the industry, called for the CDC to drop the order and let the sailing resume by July. That, of course, will not be the case. That's a big reason why we're seeing these stocks under pressure today. Norwegian declining the most, that stock off just around 4%. Flipping over to GameStop, another stock that's in the red today. We talked about their earnings results after the bell yesterday, but investors finding reason to sell the name today. They missed on earnings per share. They missed on revenue. They didn't give enough details on their turnaround plan either, and that, of course, is adding to some of the selling pressure today. Their comp store sales also missed expectations, coming in at 6.5%. They didn't give guidance once again, so we're seeing GameStop shares under pressure, trading just around $126 a share. We're going to shift to real estate and talk about investing in real estate. There's one company that's focused on giving people access to investing in real estate, specifically people of color, with the hope of making them millionaires. And we want to talk a little bit more about this with Martin Brathwaite and Michael Phillip. They're both co-founders of NICE. And Martin and Philip, great to have you both on the program. Philip, let me just start with you, because obviously this is something that a lot of people are interested in. And we've talked about the fact we need to open up the markets. We need to give people more access to these types of investments. How do you plan to do this?
Well, one of the most basic ways, and thank you for that nice intro, by the way. One of the most basic ways to allow people to get into it is, of course, through the technology that we built. And from a regulatory standpoint, prior to a few years back, the only people that could invest in asset classes like this were so-called accredited investors, people with $200,000 in annual income who are worth $1 million. So obviously that blocks out a large segment of the population. There's been, with Reg CF and Reg A, it allows so-called non-accredited investors to get in, but it's relatively new and in a nascent stage. With what we're doing, we launched it last year. And we actually set the record for a real estate company to issue shares via the Reg CF, hitting $1 million. And we hope to go a lot higher than that this year, and thus helping more people come into owning real estate. So I hope that answers your question somewhat.
I'm actually looking at the app on my phone right now. Own real estate for $100. People can download this. Let me ask you, Martin, why you got involved in this, and then as a part two to the question, how do you make sure the people you're intending to help are the ones actually purchasing?
Well, the main reason is we always want to give back, and we want to share our success with people, and we want to give access to something that people they usually can't easily access, and we want to be able to be close to the people, and that's why we want to create this community where we're talking to people and discussing to people and leading them into investing with us, and also get an understanding on why to do it.
If I could just add to that question also and sort of piggyback off of that, in North America specifically, the lower rung of the economic hierarchy is inhabited by people of color now. It's not just for, really we're open to everybody. It's just that we've lived the reality. We've grown up as being people of color ourselves. We grew up in Denmark, and it just comes with a certain experience. Not saying that it's necessarily bad for us, but it's just that's the perspective we can speak to. But really, in reality, there are a lot of people that have more in common than they do apart. And a lot of times, and this is one thing that people say, if someone from Germany said, I'm white, can I invest? I said, white is a color too, isn't it? It's really a way to bring everybody together. But in reality, minorities here, if you look at the statistics, by 2053, Black net worth collectively will drop to zero. And one of the biggest drivers behind the wealth gap is the absence of real estate ownership. Now, add to that 90% of millionaires are made through real estate. It just seems like a great way where we can start bringing people into this financial literacy system, help them own assets and push them in the right direction.
Philip, you've also built a pretty big following on social media. You have a pretty large social media presence, as well as you, Martin, since you are a soccer star. But I guess this is a question for both of you. Philip, I'll ask you first, and then Martin, feel free to chime in here. How has social media played into and helped your success when it comes to your company?
Well, it's really interesting because, and it was actually a conversation I had with Martin last year. We have a project we built together in Philadelphia by Temple University, which ironically is something that we created so we can create micro landlords from the community. It's a historically Black neighborhood, and to allow people to typically, with gentrification and things of that nature, to allow people that live there in this historically Black neighborhood to own a piece of the new properties that go up. But last year, I said to Martin, hey, can you help? Because he is signed with Barcelona. He's always been a superstar, but world is seeing it. And I go, can you help blow me up? And he said, yeah, but you don't need it. This is literally what he said to me. You remember saying this to me? And then, so he said, just put yourself out. So I created a video right as the pandemic hit saying, hey, this is the situation. Here's how you can make the best of it. So it was called 4 Ways COVID-19 Can Make You Rich. One Instagram platform picked it up. It got 300,000 views. Next thing you know, there was 10,000 followers inside a week. And that's really came from him. And but in terms of that, it's just been a way to to build a relationship, a connection with people. And it's just grown organically, because I feel as though typically in minority communities, specifically for what we can speak from us being Black, is that the idols that you typically see are athletes and entertainers. And you see a lot of expressions of ostentatious wealth, big cars, jewelry, things of that nature, where in other communities, you have more idols that are, say, a Mark Cuban. Not saying we don't have that in these communities. It's not as prevalent. And I feel as though that was a void, and it allowed people to have something to tie onto.
What's genius about what you've done is you've taken, I'm a reporter many years here, and I can remember doing stories about microloans in underserved, underbanked communities. Now you've digitized this. You've also fractionalized the ability for people to invest in real estate. So Martin, let me ask you this. I would imagine a great many of the people who are going to look at this in the United States are people who might be football, soccer fans, Real Madrid, not Barcelona, but no, they're FC Barcelona as well. How important is it that they can relate to someone like you, if they're fans of FC Barcelona or of yours, and to have the trust to go forward with this? Martin.
You know what? I think if I wouldn't be at the level that I'm on, I would be one of them. And they can trust in me because I'm also investing in it myself, and I want to give back to the people. So I'm one of them. I'm not one of these gimmicks who are trying to just take it away. They want the money. I really want to help people, and I want to empower people and help them understand everything about it and make them in the long term financially free.
Well, Martin Brathwaite, great to have you on the program. Barcelona football star, soccer, as we call it here in the U.S., and NICE co-founder, and also our thanks to Philip Michael, CEO of NICE. Thanks to you both for joining us, and we hope to check in with you guys in the future. We wish you all the best. We're going to take a quick break, but when we come back, Congresswoman Abigail Spanberger, we're going to talk to her about the infrastructure push. She's also reintroducing a bipartisan piece of a bill here regarding 529 savings plan. We have that for you right after the break.
it is clear not everybody needs a college degree in order to succeed in our society. And in fact, there are advantages to having a skill, a trade. You can make a lot more money with some of those in a world that needs tradespeople. Let's bring into the stream a member of Congress from Virginia who is actually leading the charge to make it easier to get the necessary trade that people can go forward. That would be Representative Abigail Spanberger, along with our Washington, D.C. reporter, Jessica Smith. Jessica, why don't you ask the first question?
Thanks, Adam. Congresswoman, I wanted to ask about this plan and why you think it is necessary, why you think this will make a difference if you're giving people more flexibility in how they use their 529 savings plans.
Well, thank you so much for having me. Fundamentally, this bill is really about a way to make sure that our workforce stays strong into the future, certainly long after we are beyond the COVID-19 pandemic, and giving people the ability and the flexibility to invest in the training that may be right for them, to utilize a savings tool such as 529 to achieve that is, I think, a really important element of this. Here in Virginia, so many families and individuals depend on 529 to save for four-year college, but it's incredibly important that they be able to utilize this vehicle to save for the certification programs and the affiliated costs that would allow them greater flexibility to perhaps progress in their chosen career or to get started right into the job market out of high school.
When we talk about using that money to get a trade, and I hate to break it down to you're going to make more doing this than you are doing that, that though should be part of the consideration people consider when they're choosing what could be something that's going to take up 10, 20, 30, 40 years of their lives, isn't it?
Well, I think certainly across the country, I have seen in my conversations with my colleagues that they are hearing the same thing. But back home in Virginia, I've heard from employers who can't always find folks with the right training for the very specific jobs that they need, particularly in skilled nursing facilities and long-term care facilities. This is a growing area of need. And I've heard from constituents who have expressed, the real challenges of going into significant debt for a four-year education that actually isn't required for the career that they choose, sometimes in IT, sometimes in medical coding. I mentioned in certified nursing assistance positions. And so allowing people the flexibility to invest in these programs that will allow them with the certification necessary to enter a career of their choosing. It's one option, and certainly an option that should be available across the board.
I know this is something that you have tried to work on in the past. You've introduced this bill before. I guess what makes this time different? Are you more optimistic that this can actually make it to the president's desk?
I'm optimistic this bill can make it to the president's desk for a couple reasons. Yes, the bill continues to be bipartisan. I have introduced it in the House with my colleagues, Dean Phillips, a Democrat from Minnesota, Fred Upton, a Republican from Michigan, and Rob Whitman, a Republican from Virginia. And we also have bicameral support. So we have Senators Klobuchar and Braun, a Democrat, a Republican, who are leading their own Senate version of this bill. And I think that particularly as we are seeing still ongoing tremendous levels of unemployment across the country. And I'm hearing directly from constituents about what their next step may be as they reenter the workforce. The ability to utilize 529 vehicles to save for and finance certification programs that will either allow people to pivot into new careers, those who've been impacted by unemployment, those who want to make a change, or certainly for the younger generation that's looking at what comes next for them. Is it a longer term four-year education, or is it the certification programs that are going to allow them the skill set and the jobs that they wish to pursue?
Congresswoman Shauna, speaking of bipartisan support, I want to ask you about what the White House is reportedly planning. We're hearing reports of a $3 trillion package. Some of it will be allocated for infrastructure. Is this one area where you think we will see bipartisan support? And how do you bring the two sides together on this?
Infrastructure is a significant need. across our country, be it roads and bridges. In some places, predominantly in my district, one of the major infrastructure needs is broadband connectivity. And that's the same for many rural communities across the rest of the country. And so certainly at this point, there is strong bipartisan agreement that we need to invest in our nation's infrastructure, that our nation's suboptimal and sometimes failing grades in our infrastructure is simply not acceptable. And investing in the improvements and growth in our nation's infrastructure that we must make is a preventative measure that one in the long term will certainly be less costly than reacting to ever growing failures, particularly when it comes to larger pieces of infrastructure that could have negative impact on human life if they're to fail. In a bipartisan group I'm a member of, the Bipartisan Problem Solvers Caucus, 28 Democrats, 28 Republicans, we've been focused on this issue. We've got a task force engaging aggressively on issues related to where there is bipartisan agreement for real needs moving forward as it relates to infrastructure. So I think the bipartisan agreement that we need to invest in our nation's infrastructure exists. Then what is that infrastructure becomes the next question. And I think we're still in the throes of hammering that all out.
You know, $3 trillion over 10 years isn't quite as enormous when you're thinking 300 billion. But let me ask you this, and we only have about a minute. Should it be paid for, or should we be willing to deficit finance this?
I think it's going to depend on what the broader package is, the scope of the investments that we're looking to make. You know, I am always someone who advocates for being incredibly responsible with our nation's finances so that we aren't looking to future generations to always pay for the things that we invest in now. But this is truly an issue of being preventative and not reactionary later down the line. And so I think that once we have a better scope of what it is that we intend to invest in, then we can more directly refine how it is that we intend to finance those investments.
Representative Abigail Spanberger, thank you so much for joining us. Jessica Smith, always good to see you. We'll be right back.
Time for Crypto Corner. Elon Musk tweeting that you can now buy a Tesla with Bitcoin. Yahoo Finance editor-in-chief Andy Serwer is here. And Andy, this isn't a huge surprise because of Tesla's investment in Bitcoin last month, but still, it's another big company embracing Bitcoin.
Yeah, hardly shocking. I mean, Elon is Mr. Bitcoin, and you're right. It sort of is like helping his own book, but I don't think he's doing it for that reason. I mean, really, he's just trying to broaden out and appeal to his user base. One thing to watch out here for, it could hit you with a tax bill because the IRS apparently is looking at spending Bitcoin as the same as selling it. So in other words, if you had a gain in your Bitcoin and you spend it on a Tesla, you may have a capital gains tax on that one, you guys.
Andy, it's still blockchain, but it's not crypto, or at least Bitcoin. Help us understand something with these non-fungible tokens, the NFTs. And I have a specific question, but go broad with this. If I buy something, if I've got the NFT, do I have the licensing rights to the digital art or whatever I purchased?
Yeah, essentially so. I mean, basically you own basically an NFT, a non-fungible token, is sort of a letter of authenticity in a digital form. And it's mostly done through Ethereum these days for now. And yeah, you have the rights to whatever this digital thing is, an image, a video, or a song. Other people can copy it though and use it. So you may have trouble actually recouping monies from that in the digital realm. All this is being sorted out.
All right, Andy Serwer, thanks so much. And it's really amazing when you take a look at how popular NFTs has become. We have celebrities, influencers, everyone here jumping on board. But we've got to take a quick break. When we come back, we'll have the closing bell for you. just around 3 minutes until the closing bell. We have the Dow giving up some of its earlier gains, now up just around 40 points. We want to bring in our panel. We have Brian Belsky, BMO's Capital Markets Chief Investment Strategist, and Tim Quinlan, Senior Economist with Wells Fargo. Brian, let me go to you first because we've seen the market bounce around quite a bit since the last time we had you on the show. Concerns, of course, about inflation driving some of the action here. What's your view on the recent action that we have seen in yields?
Thanks for having us, Shauna. You know, we need some perspective on this, and we tend to be a little bit more long-term than daily gyrations and bond prices and stock prices. If you go back to 1950, I know people love to go back in time, but if you go back in time and look at the average 10-year Treasury since 1950, it's 6.3%. If you include the Great Financial Crisis, it's 5.7%. And so I think we need to kind of take a deep breath. I think too many people are fixated. I call it OCD. I wrote a piece last week about it on this 2% number. It's already basically baked into stocks, we think. And we think this is all good news. Remember, stocks lead earnings, which lead the economy. Earnings are going to be up 35 to 40% last year. We had unprecedented moves in stock prices last year. We've had unprecedented moves in bond prices so far this year. It's following script. The good thing is that earnings are coming in. And we're seeing a broadening of participation in the market. In terms of the gyrations, Shauna, we warned you last time we were on to not give up on technology. And it really tells you that you need to be diversified. The stock market is a market of stocks. You can't be just all in cyclicals or all in growth. And a more diversified stock picking bottoms up approach is clearly helping portfolios that are marked that way, quite frankly, to be
Brian, I got to interrupt you. Because I'm going to stick to script. We're going to come back with Tim in just a second and Brian, but we got to get to Jared Blickery because we are just a minute to the opening bell.
Rally to the closing bell. The rally today losing steam. Dow is the only one in the green right now. You can see giving back almost all of the gains here on a 2-day basis, testing these lows that we had from yesterday. So we'll have to follow that in the final minute of trading here. Russell 2000 and the NASDAQ each down almost 2%. Well, I want to look inside the NASDAQ 100, and let's actually take a look here. There we go. Here's the NASDAQ 100. The mega caps under pressure. Apple, Amazon, Facebook all down more than 1.5%. Facebook down nearly 3%. Tesla down over 4.5%. And we got some news regarding Disney. They are upping their price on the Disney Plus package and also the bundle. It's only $1, but you can see on the news the stock spiked a little bit and now came down, and we are at the session lows right now. And also got to check out the energy sector. We have 14 states now suing President Biden due to the fact that he is blocking federal leasing on land. But as you can see, they are largely in the green today. And guess what? There's a closing bell on Wall Street.
All right, we have a closing bell, and here's where it looks like we're going to settle in the markets. Apparently, the Dow is going to be down. Going to be down just barely, but about 10 points when all is said and done. The S&P 500 will be off about 22 points. NASDAQ's going to be off about 265 points. We'd started the morning strong, as Jared was just saying, but here's where the sector action looks. Energy was up 2.4%. That sector, the only other sector that even came close was industrials, up almost a full percent. Want to go back to our guests, and I want to bring Tim in, Tim Quinlan from Wells Fargo, because, and forgive me for looking off, I'm looking at a Wells Fargo note where you talked about manufacturing in the United States has a supply problem. And it's the fact that supply chains, we see it with the chip shortage, but we see it also in petroleum products not being able to get to the manufacturers in the United States who need these things to keep building. Is this a long-term problem that's going to then reinforce our long-term outlook on inflation?
Yeah, I think that it's, first of all, the short run problem is going to get worse, right? With a 200,000 ton boat blocking the Suez Canal. But even without that, this is clearly going to be a problem. And what we're facing is, I think, fair to say, unprecedented. I mean, we've had global downturns before and seen the global economy come back online. But this will be the first time that every country in the world is emerging from recession simultaneously. And the Fed and other policymakers are banking on this idea that it'll be relatively, short strain on supply chains, but eventually things get up and running again, and you get the input components where they're most needed. But, I think one of the underappreciated risks is the scope for this to create more of an inflation shock in the short run than they're banking on right now.
Hey, Brian, in your recent note, I was reading, you said breathe, improving earnings, rising rates, expanding economy. It's a marathon. It's not a sprint. So how should investors then be positioned right now? Because I think there's lots of questions out there just in terms of what's going to lead the way higher from here.
Well, again, we think the second half of our 20-year bull market started March 23rd of 2020. So the next 10 years, we think it's going to be, again, more stock picking for the next 12 to 18 months. We're overweight areas like financials, industrials, materials, and consumer discretionary. 70% of our economy is driven by the consumer. We are telling clients to maintain their positions in tech and telecom, or communication services, which has been our call for a long time. Our three favorite sectors for the next 3 to 5 years are technology, communication services, and consumer discretionary. We do think we're going to get an infrastructure bill, which actually I think could even dilute money out there even more. And I think actually yields could fall. People aren't talking about that, but I think that we could actually see that. And I think the Fed's going to be on hold. Don't fight the Fed. And I think the Fed's going to be on hold well through 2023.
Brian, sticking with what you've just said, I mean, now more than ever is the case for actively managed advice as you're trying to shift your portfolios. That said, the pressure we see on markets, forget the 10-year yield and interest rates. The pressure we see on reopening. I mean, today we found out the cruise lines aren't going to be able to really get back to where they want to go now until November. Is there a chance we're not out of the gate yet with the reopening, Brian?
Absolutely, positively, Adam. And I'm glad you brought that up. In November of last year, when we published our 2021 outlook, we talked about this return to normalcy not being as easy as everybody thinks. It's not just as easy as flipping the calendar to 2021. We think this is going to be well into 2022 before we're in elevators again or walking from Port Authority to my office in Times Square or getting on an airplane, period, more regularly. So I think this is going to be bumpier, and that's why you need exposure to the stay-at-home stocks, to the tech stocks. And again, be more diversified. I think too much of investing, quite frankly, the last 3 or 4 years has been so binary. We picked one area and just blown through it with respect to momentum. You have to be diversified. You have to be an active stock picker, and you have to be much more fundamental, less macro.
Hey, Tim, when we talk about the economic recovery, still lots of questions out there, but I think overall the pickup that we've seen, the activity that we've seen is certainly faster than we expected. Have you changed your forecast at all? And I guess, what are you most closely watching at this point in the recovery?
Yeah, we did. After the January retail sales report, we sort of used that as a catalyst for revising up our outlook for the broader economy. And that was largely predicated not just on the propensity to consume with those stimulus checks that hit most bank accounts in January, but the rising expectation at that time of the coming stimulus bill, which has now become law. And we've kind of built that into the forecast. I think other shops have as well. Even the Fed, in their latest forecast, took up their full year GDP growth figure to 6.5%. So you've got most folks now penciling in the fastest GDP growth we've seen since 1983, 1984. So, a lot of that's predicated on this big stimulus plan. That obviously comes with the curse of it adding to the budget deficit and creating some long run financing obligations for the federal government. But yeah, I think that the scope for the economy to grow much faster later this year is getting a lot brighter for not just us, but a lot of forecasters.
All right. Tim Quinlan, Wells Fargo Senior Economist, Brian Belsky, BMO Capital Markets Chief Investment Strategist. I look forward to doing that walk, by the way, not from the Port Authority, but from my side of town to the office in the near future. Both of you, thank you so much. Jared Blickery, you got more for us on that Disney news.
Yeah, let me just go through the numbers here, because a base package, which was previously $6.99, is now $7.99 or $7.99.99 per year, compared to the $69.99 per year previously. And this is a report I'm reading. It's the first time the company is increasing rates. Yes, the first time they've ever raised rates for U.S. customers, and this is after they debuted a couple years ago, November 2019. Also, the three-way bundle that includes Disney Plus, Hulu with ads, and ESPN Plus, and these are only available in the U.S. They are increasing to $13.99 per month. That is also up $1. They most recently reported that they surged above 100 million subscribers I think it was earlier this month. And here's another factoid: about 30% of global Disney Plus subscribers have come through Disney Plus Hotstar in India and Indonesia, which has a lower average price point than other regions. Didn't know that. Bottom line, we saw the stock take a little bit of a hit, but it was already down for the day. So prices are going to go up, but I think we can say modestly, $1 per month, guys.
All right, Jared Blickery, thanks so much. We're going to take a quick break, but when we come back, we'll talk Playboy's fourth quarter earnings with their CEO. That all starts in just a couple of minutes.
What's old is new again. What we used to know as Playboy is now publicly traded as Playboy Group. Went back on the market back in February. And to talk about their first earnings report and where Playboy Group is headed next, we invite into the stream the CEO of Playboy Group, Ben Cohn. Good to have you here. I mean, your first report, revenue up in fiscal 2020, 89% year over year to $148 million. We wish you the best. I got to ask you, though, and I'm looking at the notes on here, if what we know is Playboy drove $3 billion of global consumer spending, how do you grow outside of the iconic Playboy brand?
Great. Thanks for having me again. Look, this is one of the most unique platforms in the world. You know, as you said, consumers spent in excess of $3 billion last year buying products in over 180 countries. We're organized around 4 fast-growing, multi-billion-dollar product categories. Sexual wellness, which today is a $240 billion industry, projected to grow to $400 billion by 2024. It is highly fragmented. There is no dominant player in that industry, and we believe, given the DNA of this brand, it's right down the middle of the fairway for us, and we can become a dominant player in that industry. Our apparel business was up 15 times over the last 2 years. Our streetwear business in the United States did in excess of $100 million just with 2 partners, and consumers spent in excess of $1 billion buying our products in China last year just on e-com. We've also acquired 2 other companies, so we have a robust balance sheet today, something we have not had historically. We bought a company called Yandy in late 2019, and we just acquired Lovers, which is an omni-channel retailer, 41 stores plus e-com in the sexual wellness space. And so it's not only Playboy, but it's what you can put on the back of Playboy and leverage that international distribution that we have.
Hey, Ben, you just mentioned that you acquired 2 other companies. When you talk about scaling your business here, what's in the pipeline? I guess, are you looking to continue to grow through M&A going forward?
Look, we have great organic growth internally. Our business, again, last year up 89%. There's some really interesting categories that we're looking at, such as NFTs, starting our lingerie line that are not in our numbers right now, including cosmetics. But we also have a very robust pipeline of M&A. That's my background. I spent 25 years in the private equity industry. We also have $180 million in NOLs that we can shelter income that we buy. And so I think the growth is going to come twofold. It's not only the organic growth that we're seeing, which we can now really accelerate given the cash on our balance sheet, but it's also with inorganic growth through the acquisition pipeline we have.
Ben, I had wanted to ask you about gaming and lifestyle, and if whether a new iteration of what some of us remember as kids, those iconic Playboy clubs, might be in a new version. But you said NFT. Help us understand what on earth you have on a digital side that could become an NFT, a token that you could sell to generate the kind of revenue on a recurring basis.
Look, we have a catalog that is 68 years young, is the way I like to think about it. We're talking about millions of pieces, some of the most iconic photography over the last 68 years. We also have a 5,000-piece art collection, but I think our NFT strategy will go beyond that. Our NFT strategy will also include new works. So people don't know Leroy Neiman was on staff at this company, painted a lot of paintings for the company that we used as covers and other pieces of art within the magazine when we did have a magazine, which we don't anymore. And so we're working with a whole host of new artists as well to continue to expand that library we have. And so, again, it's the library, it's new arts, and then it's working with some of the great influencers we work with where we think we can create unique, one-of-a-kind NFTs.
So let me ask you a follow-up on that. The original first cover, Marilyn Monroe, if you were to make that into an NFT and I was the purchaser, do I own the rights now? Nobody can use it, and if they do, they got to pay me, or do they still pay Playboy Group?
So, it depends on how we do it, right? We own the original photos. It's a question of whether we're selling those or we're selling something new coming off the back of it. What's really unique about the NFT market is not only do you get paid on the first transaction, but you get paid on every subsequent transaction. So if these increase in value over time or trade hands over time, you continue to get paid on that. So we're looking at setting up the business really for the long term. We're going to enter the space slowly, but we think there's a massive opportunity for us long term. And there can also be a very long tail on this. And so that's what excites us.
Hey, Ben, when you think about Playboy, at least historically, I think a lot of people think the majority of the users, the majority of the people that it appeals to is men. I understand that you're focused on capturing more of the female audience. How are you doing that?
Look, we brought in a largely female team. 100% of our content team are made up of women. Over 50% of the employees today are made up of women. And that was something I did when I took over as CEO. I thought that this brand, as powerful as it was, would be better told from a female perspective. And so if you look at what's happened over the past 2 years since we've done that, our average age of our audience has dropped by over 10 years. 90% of our audience today is under the age of 40. Our female audience has grown 70%. And then when you look at the sales, which, for me as a CEO, that's what I really look at. I look at the growth of our Misguided business, again, up 15 times selling women's apparel. And so that coupled with what we're seeing in color cosmetics on our lingerie side, this is a brand that resonates with everyone.
Ben Cohn, great to speak with you, CEO of Playboy. Thanks so much for taking the time to hop on here and join us today. We want to get to some breaking news. We have earnings out from RH Restoration Hardware. Jared Blickery has that for us. Jared?
That's right. The stock is up about 3.5% in after-hours trading, and that's because we're seeing beats on all the key metrics here. For the fourth quarter, RH adjusted EPS came at $5.07. That is higher than the estimate, the street estimate of $4.73. Net revenue also beating $812.4 million. That's up 22% year over year and higher than the street estimate of $797.3 million. And then adjusted gross margin was 47.4%, and that beat the estimate of 45.9% by 150 basis points. And they did give some guidance for 2021. They expect revenue growth of 15 to 20%. And for the same time period, they expect adjusted operating margin to expand by 100 to 200 basis points. According to Bloomberg data, there's 11 buys, 6 holds, and 2 sells on them. I just want to read something from the shareholder letter by the CEO, Gary Friedman, kind of interesting here. I believe many on Wall Street are managing their portfolios in piles, looking through their reading glasses when they really need a microscope and telescope. Since we, the people of Team RH, generally moved in the opposite direction of the herd, are allergic to hunkering down, and surely don't believe we belong in the pandemic pile, we've taken a shot at 4 simple headlines that require neither a microscope nor a telescope. 4 Ps that can give you an insight into what you might expect for us to do, because while the world, most of the world, spent this past year sheltering in place, we spent the time reimagining and reinventing ourselves at a never before seen pace. All right, hope I got that in. Anyway, stock is now up about 3.5%, beats on across the board, guys.
Jared Blickery, thank you very much. When we come back, meet George Jetson. That is so 20th century. How about meet Robert Rose, the co-founder and CEO of Reliable Robotics? We're going to talk about they're already flying AI, don't need someone in the pilot seat airplane.
Reliable Robotics is a startup company that's been working on autonomous flights. They actually reached a new partnership this week as they look to build and I guess perfect, I should say, the next gen flight automation systems. For that, we want to bring in Robert Rose. He's a co-founder and CEO of Reliable Robotics. Robert, it's great to have you on Yahoo Finance. You're a leader in this space when we talk about aircraft automation. You've been testing flights from my understanding. I guess the big question, what everyone wants to know is how close are we to this becoming something that's widely adopted and widely used?
Closer than you think. I think it's going to take a lot of time to get there. We have a lot more testing that needs to be done and certification processes that need to be worked through. And I think the transformation is also going to occur in cargo first. And that's why we're focusing on small cargo operations, specifically operations that enable vehicles like the Cessna Caravan to operate remotely.
In fact, you flew that Cessna Caravan not too long ago. It's a Cessna 208, I think, and I'm not a pilot, but it's just so cool. There was no pilot in the front seat. They were doing this from a control tower 80 miles away, correct?
Well, to be clear, we're still in an experimental test phase, and so we do have a safety pilot on board the plane. But we have demonstrated unmanned operations on a previous vehicle, our Cessna 172, which is a 4-passenger aircraft. We did demonstrate unmanned operations of that vehicle over a populated area in the United States. The Cessna Caravan, we still have at least a year, more likely 2 years to go on certification of this system before this can become a routine technology that can be used on a regular basis.
Robert, the new partnership that you reached this week, I guess, how is this going to enhance the safety and the confidence, do you think, in autonomous flight?
So we're working with a number of partners, and this week we announced a partnership with, I believe you're referring to Dedalian. This is a company based in Switzerland. Their founder, CEO, Luc Van Dijk, I've known him since 2010, over a decade now. We work together at SpaceX. He's working on a particular portion of this problem, focusing on sense and avoid and using vision-based systems for detecting surrounding aircraft. It's a complementary technology to what we're developing. We're focusing primarily on automation of the vehicles and the remote operations. And obviously, sense and avoid is a key component in enabling these types of operations.
Can you give us a timeline where we as passengers, if it'll happen in our lifetime, might be able to fly aboard a plane where we don't have to be a pilot, where it will be totally autonomous?
It's going to happen sooner than you think. I want it to happen tomorrow, trust me, but it's going to take time for us to work through the regulatory processes. Again, this is why we're starting first on cargo. I think the transformation is actually going to occur on small aircraft initially. I think it's going to take some time before the large transport category planes, the large passenger jets are fully automated. I actually believe that there's a great deal of opportunity in the near term enabling regional travel. So, for example, we currently use about 130 airports today on routine basis in the United States, but we actually have 5,000 airports available for public use. And for someone like me, I want to be able to travel out to these regional airports. I've got my mother-in-law and my family live in Oregon, and there's no major commercial service for us to get there. And my wife and 3 boys, it takes 12 hours to drive or 12 hours on a commercial plane. And that's because you got to go all the way up to Portland, Oregon, and then drive several hours. But there's a municipal airport right next to their house. And so in the near future, you'll be able to rally a plane, perhaps using your phone, and fly out of your local municipal airport and take this to any place in the country that you want to go.
A lot of this technology, though, in some forms, doesn't it? It's existed for years. Correct me if I'm wrong, but haven't planes been, computers have been landing planes for decades, or is that just computer assisted?
I know the military has been doing this for decades, and even in the commercial world, there's a great deal of automation that enables the en route portion of an aircraft to be automated. And much of landing is automated, but one thing that's not apparent to most people is actually automated landing is only made available at a small handful of airports in the United States because you need infrastructure at the airport in order to enable it. This is one of the first problems that we solved at Reliable Robotics, is this navigation problem of knowing very precisely where the aircraft is relative to the runway. And with a system like ours, you can put an aircraft down onto a runway in zero visibility, total whiteout conditions at any runway in North America.
Hey, Robert, just real quick, because we only have about a minute left here, but how much do these systems cost, and how long does it take to install something like this?
The installation process in the early days, it's going to take time, and the equipment is going to cost a fair bit. This is one reason we're focusing on cargo first, because these small aircraft are easier to integrate with. And we can recover the costs of bringing the technology into these aircraft systems somewhat quickly.
All right, Robert, great to have you on the show. Robert Rose, co-founder and CEO of Reliable Robotics. I think we're all very excited about this. We want to take one more look at how the market settled here before we let you go. We saw Stocks giving up earlier gains. The Dow was in the green just in the final minutes of the trading day before flipping into negative territory, closing just shy of the flat line, off just around 3 points. So not a heck of a lot of movement there. S&P closing off about 0.5%. The Nasdaq was a big loser today, off just around 2%. That's good for a 265-point drop. In terms of the sector action that we saw today, communication services was the worst performer. The XLC closing off just around 2.5%. Consumer discretionary also coming under pressure, and technology was another laggard here, with the XLK closing off just around 1%. Taking a look at the bond market, because we know investors are closely watching yields. Yields pulling back a bit today, with the 10-year yield off just around 1 basis point. Keep it right here, though, on Yahoo Finance Influencers with Andy Serwer. He's speaking with Ray Dalio. That all starts right after the break.
Finally, the end of the pandemic is in sight, but the uncertainty about what comes next and who will benefit has thrown the market out of whack. You can be sure Ray Dalio sees through the chaos. Over nearly 5 decades, the hedge fund billionaire and investing legend has built an iconic set of principles for how to thrive in the market and in life. He made his first stock pick at age 12, and at 26, launched Bridgewater Associates. Now it's the biggest hedge fund in the world, with about $150 billion in assets under management. On this episode of Influencers, Ray joins me to talk about what the COVID-19 stimulus will do to the stock market, whether the government could outlaw Bitcoin, and what worries him about a wealth tax. Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Ray Dalio, founder, co-chairman, and co-chief investment officer at Bridgewater Associates. Ray, welcome.
Good to see you, Andy.
Let's start right in and talk about the markets, Ray. There's been a tremendous amount of volatility this year. Why is that happening, and how do you expect things to pan out?
Well, it's simple. You know how the thing works. If the pulse of the economy goes down, then the policymakers, like doctors, rush to the patient and inject it with a whole lot of stimulation. And so what they did is they wrote out a bunch of checks, and they're writing out a lot of checks, which are about 7 times, 5 to 7 times the size of the hole. And they got that money out. And what that did was, of course, the government doesn't have money. They get print money. So they have to borrow that money, but the Federal Reserve can print money. And so the same thing that is happening like on March 5th, 1933, is the same thing now in terms of that big stimulation. So the way it works is real interest rates are so bad, money's so cheap, and it's so abundant that it changes a lot of financial assets, and it causes those financial asset prices to rise. And when they rise, future expected returns go down to start to approach those of bonds and the risk-free return. And so that's what we've gone through. So you see it domestically, you see it also in the currency, in the dollar, you see it in other assets, gold, Bitcoin, and so on. So the world has got a lot of liquidity. And now we're in a spot where we're going to have the supply-demand question. The big question is the supply-demand question, because we're going to have to sell a lot of debt. And I don't know if you want me to go into that, but we're going to have to sell a lot of debt. And then the question is how that goes. Will the demand be there, or will the Fed have to monetize more? That's the dynamic.
Yeah, I do want to get into that debt question, but first of all, I want to go back to stimulus, which maybe is before that. And am I to understand then that you think there's too much stimulus coming from Washington at this point, Ray?
It depends, like you say, too much for what? Too much for the supply demand? Yes, probably. Okay, we'll get into that. Too much because like fast, a lot of people needed to get a lot of money. Okay, if you look at the needs and a lot of things like, okay, err on the side of too much. There was, we have a big wealth gap. We have a big opportunity gap. We have big gaps that are issues. We see it here. I work, my wife, particularly in the state of Connecticut, works with disengaged and disconnected students, high school students in poor neighborhoods and so on. And you see their conditions and what the budgets are. There are a lot of needs. So I'm not saying the needs are not there. I'm saying just the way the machine works, the reality of it is, you're making this big supply demand move, but that it's not like it doesn't have risks and costs associated with it. So from the market's point of view, it's a real big deal.
Yeah. So does that mean you sort of flood the zone to mitigate and obviate these sort of social problems, and sort of by definition you're going to overshoot, and then we have to deal with those consequences?
Yeah, because like debt, at the end of the day, it's going to be one way or another. It's either going to be when somebody borrows and you're using that debt, is that going to produce productivity so that in hard money terms that money can be paid back in a way where, okay, it paid off in a productivity increasing way? Or is that not going to be paid off? And somebody's always going to pay, but it's going to be the bondholder, it's going to be the cash holder who is going to pay if that doesn't come back with real productivity. And right now, it was an emergency situation with COVID mixed with a political situation to disperse a lot of money. And that's what we have. But it's not ending there, because that's the new policy.
So can I infer then that you're suggesting we're going to have an inflationary period ahead because of this, what you just outlined?
There are two types of inflation. Okay, let me just clarify. There's supply demand inflation, like if demand is pressing up against capacity to produce things, and maybe that's labor, maybe that's capacity constraints and so on and so forth, prices rise because of that. And then there's monetary inflation. And monetary inflation is because the currency and the value of money goes down. And so you can see, like in the 1970s, stagflation. You could see inflation is not coming from the first of those types of inflation. It is coming from the second of those types of inflation. And the way that would occur is because people don't want to own bonds. To me, it's pretty crazy to want to own cash or bonds. Okay, we can get into why that is. But if you have that movement out of like that type of financial assets to other assets, which we are seeing, then that has the effect first of causing financial inflation. In other words, an investor shifts it to another investment and they go up in value. And then that wealth effect has an effect on those items that those people who acquire the money want to spend on. So maybe it's on penthouses or maybe it's on something else, but it depends how that's spent. I'm more worried about the monetary inflation, which would look something like a currency defense. It means that what happens is, as money, let's say people don't like bonds, and then they start to sell bonds, and bonds then go down in value because they have a capital loss, and they don't offer anything in interest rates, negative real interest rates, and so on. They don't like that. Then the Federal Reserve or other central banks are faced with the choice of either rates rise, and that is bad for financial asset prices and it's bad for the economy, or they make the purchases. They make money and they make the purchases of that. And that then produces more of a monetary inflation. So it's the second that I'm more concerned with. But the supply demand of debt will be, I think, the big driving influence. And I want to emphasize this because so many people say, okay, well, here, they look at this stock or they look at this. But what you saw was the V bottom in all markets and so on. And that was due to debt and money dynamic happening. So that's the biggest dynamic to pay attention to.
We'll be right back with more from Ray Dalio, founder of Bridgewater Associates. Welcome back to Influencers. I'm Andy Serwer here with Bridgewater Associates founder Ray Dalio. On the one hand, you're seeing this rotation in equities from growth stocks to cyclicals. Number one, is that going to continue? And then number two, the 10-year is up, 100 basis points this year. Is that going to continue?
Well, what's happened is that a lot of, like these cycles go, a lot of new ideas, new technologies, new things come along, and they make fabulous revolutions, and they grow things, and that's great. But there's a tendency of investors to extrapolate the past and get and not pay too much attention to price. And when that happens, you start to emerge as somewhat of a bubble. By our measures, the bubble is not as what it was in 2000 and not what it was in 1929, but it's kind of like halfway there if I look at the types of qualities. In other words, and so what that means from a value point of view, if you're calculating, what can I realistically expect? Its expected returns shrink relative to the others. However, the kind of the meat and potatoes type of companies didn't benefit as much from those, and they're fairly stable and so on. And so that's why you're starting to see that kind of rotation. Now that can change, it can come and go in these phases, like when people get stimulus checks and then, they might be hot on, the exciting things and they run up again and so on. But that's going on. And of course, there's Bitcoin and other things that are going on. However, the big thing is plenty of liquidity and ridiculously low interest rates. Now, you ask about the 1.6%. I think we have been in a 40-year bull market in bonds. So now you look at that 1.6%. That's a negative 1% about real. Okay, so you're guaranteed. And you ask yourself, if you're going to hold a bond, any investment, the only purpose of an investment is so you can sell it to buy something you want. And so when you look at what is the length of time it's going to take me to get my money back, if I give an investment nowadays in the United States, I'm going to have to wait about 50 years to give back the buying power to start, and then I'll start earning money. If I'm in other countries, some Europe and Japan, I will have less. And if I measured in all those countries in real terms, I'm going to have less money. So basically what that means, if I just bought anything that didn't depreciate in real terms, if it just matched inflation, I'd be better off than to have those things. And so now, I don't think those rates will only stay down there, I think, if the Federal Reserve does what it did like in the 1930s in the war period, which is to put a cap on rates, to make short-term interest rates low in relationship to the cap. Like back in the 30s and the war years, they made 1% was the short-term interest rate and 2.5% was the bond yield. So it was profitable to buy those bonds, funding it with 1%, and you got 2.5%, that could put a lid on it. But because those two assets, cash and bonds, were such bad investments relative to other things, there was the movement to those other things still, and then the government outlawed them. I mean, things like gold, they outlawed gold. That's why also outlawing Bitcoin is, a good probability. And that they also established foreign exchange controls because they don't want the money to go elsewhere.
We're going to take a quick commercial break. We'll be right back with more from Bridgewater Associates founder Ray Dalio. Welcome back to Influencers. I'm Andy Serwer, and I'm back with Ray Dalio, founder of Bridgewater Associates. What is your take on our relationship with China right now, and how do you perceive it moving forward?
Well, every empire rises and declines. For those who are interested, I studied this. I needed to study for reserve currency, so I studied this going back 500 years. And it's on LinkedIn. It's called The Changing World Order. You could see the patterns, and you could see what's happening. China has gone from, I started going there 36 years ago. They were dirt poor. I would bring a calculator and give it to gifts like CEOs, and they thought they were miracle devices. Now they are, in many ways, in AI and quantum computing and so on, at a comparable type of level. So China, by all measures of its power and prosperity, is a very, very strong competitor. So now you have the leading empire. 1945, we created the American world order because we won World War II. And so we had a new monetary system and so on. And now we're having a challenge of that, partially because of Chinese, but partially also how we're handling ourselves. I mean, we're not doing great in handling ourselves in a lot of the most basic ways. So yes, we have that conflict. In China's, I would say it's I've had a lot of contact there over decades, and I really believe it's an evolutionary process. There are certain things from the Chinese perspective. They would believe if you can't suppress or compress me, that would be their view, that the United States is trying to do that. I suspect there will be tensions. And the question is whether, one side becomes too confrontational to let evolution take its course. But it's true that evolution is more on China's side than our side, although it really depends whether we can get our basics right. And our basics are things like broad-based public education, the quality of education, civility of the people. Do people work together in a civilized way, or are they at each other's throats? And, innovation and, those things. So China is a very exciting place. If you spend time there, and you see what's going on with entrepreneurship, the creation of new businesses, new investment in things, and there's an energy, and it's quite something.
What about some of the thinking that you're now famous for, Ray? Meditation, radical transparency, your principles. Have any of those changed in recent history, maybe because of the pandemic, changes in society? What is your latest thinking when it comes to some of those facets?
Well, I just want to, the things you mentioned hasn't changed at all. And I really want to pass that along. At my stage in my life, the main thing I'm doing is want to pass things along that have been valuable to me. I mean, that's why I'm doing the interview. And so meditation, wow, that has, I started that about 50 years ago, and that has given me the equanimity when things come at me to deal with those well. It also gives creativity because one goes into one's subconscious, and that's where the creativity comes from. It's like if you take a hot shower, the great ideas come to you, and it's not because you muscle it. So that's been valuable. And this, the Bridgewater, the culture has been and is an idea meritocracy. In other words, let the best ideas win out, in which the goals are meaningful work and meaningful relationships. So you're excellent at the work. And then also, if you have the relationships, that reinforces the work, and it reinforces, and the mission with people you like and you care about, that's powerful. And through radical truthfulness and radical transparency. Radical truthfulness means like we're going to be totally honest with each other. It may be brutally honest, but misinformation, because you've got this scenario going on in your head, you don't really know what the other person's thinking is dysfunctional. And it also means that you don't build trust. If you're in a political organization and you know that guy's acting really nice guy, high five and so on, but it's not going on the same behind the scenes, that undermines trust. So those have been the things. The thing that I learned the best, and I learned from failure, I learned from my failure. 1982, I expected a big debt crisis that was going to cause problems. That was the bottom in the stock market. I couldn't have been more wrong. And that gave me the humility to realize that what I think in my head, or what any one individual thinks in their head, might be wrong. And the markets help you understand that. And so the idea of having others stress test each other with that radical truthfulness and that strategical transparency raises the ability. So I'd say whatever Bridgewater's success has been, it's been because of that way of operating.
It's a good segue to my final question to you, Ray, and that has to do with your legacy. Would you want to be known as a thought leader or as an investor, or maybe it's both?
I don't care what I'm known as. I don't think anybody will actually remember anybody, because think about, like, how many people do you remember from a generation ago? Think about the rock stars, the movie stars, the other famous people. They all disappear. We all disappear. The legacy, the way I view legacy, is what is the gift that you're passing along? And the things that I want to pass along in that are these kind of principles, like how does the machine work? How does reality work? And how does one interact with reality to get what one wants? Those are what I mean by principles. And they don't have to be my principles. We're all on a discovery to try to find out what is reality, how does it work, and how do we interact with it well. And that's those are the things. So I wrote one book, Principles. I wrote another book, which is Principles for Understanding Big Debt Crises. I'm writing the other ones, which has to do with the changing world order, those principles. And I'm writing these actually like for my grandkids. As well as everybody else. I've got them in mind, like when I'm not around, it can almost deal with anything. When you're thinking about your job or whatever, here's some of the things that might be helpful. But most importantly, you should have your own principles and think about them well. So I pass along those principles, like pain plus reflection equals progress, and so on. Don't get caught up in your own head. Have radical truthfulness and radical transparency. Those are the most important things. Your approach to life, one's approach to life is the most important thing. And when you start to understand that each person has their nature, what do you know your nature? And then once you know your nature and you're on a journey to find your click, find the fit, that is the thing that allows your nature to flourish and deal with other people when they know their nature. Those are the most important principles, I think. That's what I'm trying to pass along. If it lives beyond me without ever me being referred to, that'd be great.
Okay, Ray Dalio, founder, co-chairman, and co-chief investment officer at Bridgewater Associates. Thank you so much for your time.
Thank you, Andy.